Capitol Hill to F Street's light, we gather where ideas take flight.
At the summit, we're writing the code for the future of Capitol's road.
CfPA stands strong and clear, uniting the dreamers gathered here. Voices rising, vision spun, the crowds are power. We act as one. We are shaping the future together. Storms may change, but our bonds hold forever. Innovation, trust, and might will light in the dawn of investor rights. At the summit, we raise our aim. Came frapping now has a brand new name. From passion to policy, heart to purse, we're rewriting the story, verse by verse. From dealmakers spark to king's crowd's view,
We measure what's bold, we build what's new.
DNA drives the message clear.
That the people's capital starts right here.
With purse at the table, the SEC its voice.
Guiding our growth, defining our choice.
From impact investing to blockchain's thread, the crowd funds hope where angels tread. At the Professional Association,
We're the builders of a brighter nation.
from community to regulations art, every rule begins with heart. We are shaping the future together.
Dream by dream, it's now or never.
From DC's halls to Main Street's verse, all rise with CfPA's universe. We're shaping the future. The summit's our song. Together we build it where all belong. From Capitol Hill to F Street's light, we gather where ideas take flight.
At the summit, we're writing the code for the future of Capitol's road.
CfPA stands strong and clear, uniting the dreamers gathered here. Voices rising, vision spun, the crowds are power. We act as one. We are shaping the future together. Storms may change, but our bonds hold forever. Innovation, trust, and might will light in the dawn of investor rights. At the summit, we raise our aim. Came frapping now has a brand new name. From passion to
You are, folks. Find your way to a seat and let's get going. We've got an action-packed program today. We are going to keep things moving quickly. For speakers and for everyone, if you look back here to the back table, there's a timer. I'm going to give a 2-minute warning for all us sports fans. And we're going to be super hardcore on getting people on and off stage. But first off, just welcome to the second annual Investment Crowdfunding Summit. And wonderful to see all you folks here. And we know that it's not easy traveling many miles. Some of us have come from Australia, Africa, and it is truly a global crew that we have here. So thank you all for coming. We're going to have several panels. We're going to have, during the course of the day, some opportunities to get together and network. We are going to also do some stretching and keeping people, awake, even though the program will do that in itself. Now, some housekeeping details. On the on the fifth, second, and first floors are bathrooms. Everyone, if you need Wi-Fi, it's over here. We are, sorry, just a sec. Sponsorship tables can be viewed in the room that you just came from for coffee, tea, where coffee, tea, and snacks are. That is open all day. Just be mindful if you're coming in and out to be quiet, as people will be continuing to talk. At the end of the day, we are going to have a cash bar happy hour at Dirty Habits. Dirty Habit, actually. We only need one Dirty Habit. And that's at 555 8th Street. It's in the Monaco Hotel. It's literally 2 blocks away. So that would be a great time to get together and recap and get to know each other a little more. So as we know, in crowdfunding, it takes a village, and we would be remiss if we did not thank all of our wonderful sponsors. Our platinum sponsors, Dealmaker, CrowdCheck. Please wait till the end for your applause. DNA, Potomac Growth. In the gold category, we have King's Crowd, Minot, Phelps, and Phillips, LLP. Silver sponsors, the Super Crowd, Clearing Bid, Capital Department, Kunstler, Bean, and Adamson. Bronze sponsors, Brainsy, Crowdfunding Lawyers, Revalue, Smith Anderson Digital Offering, Halyard Compliance, Going Public, Gordon Feinblatt, LLC, GECA, MZ Digital, Small Change, Net Capital. Our platinum media sponsor is FinTech TV, which is live streaming. You can go to YouTube, or in the program, there's also a link for the live stream for all your friends and family who are wondering what you're doing today. And we're also grateful, of course, for the CfPA board, which is all volunteer. I am Vincent Bowen. I am on the board. I am the owner of a social media startup called Maven. Would love to talk to you all about that. And speaking of the board, I am going to introduce Jenny Casson, our board-elect, president-elect. President, yes. Well, you're so vibrant. It's like you just got elected. Jenny has been in the impact investing space for a long time. She has almost 3 decades of experience as an attorney and an advisor for mission-driven enterprises. She's helped her clients raise millions of dollars from values-aligned investors and raised over $3 million for her own businesses. There's a lot more about Jenny. She's written Raise Capital on Your Own Terms, How to Fund Your Business Without Selling Your Soul. She served on the Security and Exchange Commission Advisory Committee on Small and Emerging Companies, and she told me to keep it short. So without further ado, Jenny, come on up. I'm gonna make sure you don't trip here.
Welcome, everyone. Oh my God, thank you. Yes, this helps. It's so wonderful to see everyone. I want to ask you to stand up if you can and look around, see who's here. You are so amazing for being here, because you're not just going to get incredible education opportunities, networking opportunities. You are also part of a growing movement to democratize investing in the US and globally. So please give yourselves all a hand. Uh-oh. What happened to my slides? They were working until I got up here. You can have a seat. Well, okay, I'm going to just keep talking while they figure out what's going on. So, So yes, we're part of a growing movement. To me, it feels like it's taking way too long. I got involved in democratized investing starting in 2006, and that was when I first learned about securities law. And I learned that there were so many limitations on the ability of regular people to invest in the things they most care about. And there were also so many limitations. There's something with the mirroring. Oh, it went to sleep. Okay. There were so many limitations on the ability of the vast majority of businesses in our country to access capital that was a good fit for them. So there's trillions and trillions of dollars invested by regular folks in our country, and there's a need for trillions and trillions of dollars of investment in businesses in our country. So, gee, what can we do to create connections between those two? And that's what we're trying to do collectively as a movement. So, yesterday, some of us went and spoke to some legislative staffers. Unfortunately, we didn't speak to any legislators because they're mostly not in town. But, the staffers are really the ones that make things happen, I think. So, we had some excellent meetings. Everyone we spoke to is incredibly supportive of what we're advocating for. Oh. Um, I apologize. Okay, plug it back in. Oh, can you plug it? Sorry. Hopefully it should work now. Usually there's a pop. Oh, here. Oh, no. We need that mirroring pop-up.
Talk amongst yourselves.
Usually it just pops up, but if you know how to make it mirror. There we go. Start mirroring. All right. Got it. Yeah. All right. Sorry. Okay. Stop talking among yourselves. You're going to have plenty of opportunities to talk. I just need a few minutes of your time. All right. So, the Crowdfunding Professional Association is the premier trade association representing the regulated investment crowdfunding industry in the United States. So, you really are in the place, if you care about democratizing investing, you are in the right place. Our mission is to foster the growth of the regulated investment crowdfunding economy by supporting issuers and investors and potential issuers and investors, and by working with portal operators and other crowdfunding professionals in the broader crowdfunding ecosystem. So we have an amazing group of leaders. Every time we do anything, I'm so amazed how people just step up and work really hard, and everyone's really collegial. If you want to get involved in an organization that you just feel good to be a part of because the people are just so amazing, I really recommend you get involved with the CfPA. And the way we work is that so I was elected to be secretary 2 years ago. And then I moved up into vice president, and then this year I'm president. And then the vice president this year moves into president, and that's Brian Belay, who unfortunately cannot be here. But a lot of his King's Crowd colleagues are here. So we really need leaders to step up to join our activities. What we love to have people do is to become members, start getting involved in our meetings. We have amazing committee meetings that focus on different things. Mostly we are focusing on policy. and of course, community education. But once you get involved, then you could maybe join the board, and then maybe eventually you could become an officer. And it's, you know, I always complain, oh my God, being president is so hard. But to be honest with you, it really wasn't that hard because of all the amazing people that just step up and help in so many ways. But I am looking forward to Brian taking over soon. um, you know, I don't know if everyone knows, but crowdfunding has been around for a really long time. Actually, you could say it's probably been around for millennia, right? Like, how many times have communities gotten together, pooled resources to make amazing things happen? But one of the famous milestones in our movement was when Ben and Jerry got together and actually, I think it's actually, was it 1986 or 84? I can't, anyway, maybe if I said it's 86 on the slide, that's probably right. But anyway, they found a way legally to raise money from the residents of Vermont. They raised $750,000 to start their first factory. And of course, the people who invested in that did eventually make some decent money because they did go public. So it's been going on for a while, but in 2016, we got a new law, regulation crowdfunding, that made it possible to do it nationwide and not have to deal with each state and all those legal filings. So it's something that we worked on advocating for. This is the White House signing ceremony in 2012 for the Jobs Act. But still, in spite of the fact that we have made a lot of progress on the legal side and also on the side of people being aware of even the possibility of investing in things off of Wall Street, there is still a crisis of undercapitalization in our country and probably throughout the world for the vast majority of businesses, change makers, artists, people who need funding to achieve their dreams. So we need to keep working really hard to grow this industry so that we can capitalize these amazing businesses. And so I wrote a book about how to raise money from your community, and some research I did showed that it's only 0.3% of the population of the United States that are professional investors. And when I say professional investor, I mean an angel investor who's an active angel, part of an angel group, VCs, anyone who manages, investment advisors, people who manage funds. The vast majority of people in our country who are investors, and sadly, fewer and fewer people in the US are investors because of our growing wealth gap, but still, we do have a lot of investors in the US, and the vast majority of them have all their money invested in a tiny, tiny part of the economy, which is the public companies listed on Wall Street, and that's not right. People need to have the right to invest in all the different things that they care about. So we're doing a lot of policy advocacy. This is a picture from last year when we had a lot of amazing visits with the regulators and legislators. We are starting to get a seat at the table. We are starting to be recognized by the people in power as the voice of the industry. We were invited to a closed-door meeting with the House Committee on Financial Services. Luckily, Brian and Megan were able to attend. And we're building an ecosystem. This, as we all know, because we're in this world, it's not easy. We can have the laws in place. Even if we had perfect laws, it would still be challenging because it's a whole change in mindset that to educate people that yes, it is possible to invest in things out of the stock market. And how do you do that? And how do you make it fun? And how do you make it not overwhelming? We really need to just change the whole mindset, both on the entrepreneur side and on the investor side. And we don't have perfect laws, so we do also need to get the laws improved. So it's a lot of work, but we're the people to do it. So I hope you will get involved in our organization. Definitely become a member. You can join for free and be a part of our online platform, but it's very affordable to become a member. And by becoming a member, you're not just getting access to really cool insider meetings and information, you're also showing that you care about this movement. And the more people we can say are paid members, the more credibility we're going to have with the folks we're advocating with. So let's see. And of course, I'm so impressed with all of you who stepped up to be sponsors of this event. I couldn't believe how long the list was. So thank you so much for doing that. If you did sponsor, and if you're not yet a sponsor, you can sponsor at any time, sponsor the organization, sponsor our events. So please let us know if you want to talk about that. And this is a picture from our event last year. I think we have even more people here this year. We're a growing movement. So thank you so much for coming, and we really look forward to spending the day with you. You know what? I did want to just share something super quick. On the program, it says that I am part of the Casson Group, which is my law firm that I had for 10 years, but I actually just joined a new law firm called Jason Weiner PC, a public benefit corporation. So I just want to make sure folks know I'm part of a new law firm now. So there's many lawyers here, but if you want to talk to a potential lawyer for what you're doing, let me know. Thank you. Thank you. I got it.
Terrific. Thank you, Jenny. I can't help but think we are going to mark progress by seeing tax deductibility at some point signed in the big, beautiful ballroom, hopefully, and not crowdfunded as that thing is. Okay, so next we're going on to Chris Lustrino from King's Crowd. I think of King's Crowd as the S&P of crowdfunding. Chris may not say that, but it really is a wonderful resource for providing data, information up to date to allow us to understand where trends are going and how this industry is growing. So without further ado, Chris, come on up.
Is there a clicker? No problem. Well, hey everyone, as I'm waiting for us to get the clicker over here, just as he mentioned, I actually would absolutely say we are the S&P. I also use Morningstar, Bloomberg, really whatever resonates with you. We are the data investment research company for the industry, and we've been doing it for over 8 years now. So we've been here pretty much since the beginning, and we've backfilled our data to the beginning. So today, my goal will be to give you kind of an overview of where we've come as an industry, and we've come a long way, and there's a lot to be proud of. Also talk about the evolution of the space and what we're seeing, not just from a data perspective, but also from a qualitative aspect. We'll get into the challenges that we do see. It's not a perfect industry. We still have a lot to work on, right? And then where the opportunities are for us to continue to grow as a business. So really excited to have the conversation with you. We'll get that clicker over here. We'll get rocking and rolling. Please, questions? Good question. This year, if you look, so I'll be very specific about kind of our data coverage. Our data coverage is pretty much 100% of Reg CF and Reg A equity and debt offerings in the United States for operating companies. So this is not going to involve things like Fundrise Reg A's for real estate, ground floor Reg A's for real estate, fractional, collectibles, artwork, all of that stuff is not in here. So this is focused on operating businesses. But as we'll see when we get the data slides up, there's literally, we're going to pass the $1 billion mark this year for dollars raised via Reg A and Reg CF into equity and debt offerings in private companies in the United States, which will be the largest year we've ever had on record. So the answer is yes, and I think that's pretty exciting. Yeah, please. Good question. So yes, that is also growing, and we'll get into that in a second. We've had over 1,400 raises this year, raising capital. So the number of issuers each year is growing. And it's pretty interesting to see not only are they growing, the average dollar size or raise amounts are growing. there's a lot of very interesting trend lines up and to the right, which is pretty cool. All right. There we go. Beautiful. Thank you, Devin. His superpower is tech. Or good, either one. Awesome. Thank you. So yeah, as we're kind of hitting on, you'll see over here, right? This is year-to-date 2025. We're just under the $1 billion mark. I think this is the year where we could actually surpass $1 billion raised via Reg CF and Reg A, which I think would be a really big deal. We should definitely have a clock counting down the dollars till we hit the $1 billion mark. That's nothing to slouch at, right? I mean, how many venture funds out there are $1 billion funds, right? This is a big part of the private market capital stack, and I think they're doing some pretty incredible work across the industry and a really positive sign for where things are headed. So one of the things that I want to hit on, right, is how the crowdfunding market is evolving. There's a lot of perceptions about our industry that little by little are changing, but there's still a lot of work to do, and I kind of want to highlight where we're seeing some of those changes. So crowdfunding is not just an early stage anymore, or early stage market, right? Yes, there are a lot of day zero companies, as I put them, right? Ideas on a piece of paper, just have a pitch deck. That is a big part of the market. But there's also companies with $1 million, $10 million, $50 million, $100 million, $300 million in revenue and prepping for an IPO. So there is a wide breadth of companies in this market, and we need to talk more about that. Crowdfunding is much more than just consumer products. And again, we'll get into each one of these, so I'll just kind of glance on them here. But people think this is just like Shark Tank ideas, and that is simply not true, and the data spells that out. Negative selection bias is something that I hear time and time and time again. I'm pretty much at the point where I just want to hang up the phone if someone says that, like, you're not interested and I don't want to talk to you. But the reality is we have to talk to those people because they have a feeling, and we need to change that feeling and help them understand that's not the case. And we'll get into that. The capital raising ecosystem is evolving. This one I think is probably one of the most important things. The marketplaces, we need them, right? We need the deal makers, we need the we funders, we need the Republics, the start engines, and net capitals, but we also need the ecosystem pieces around it. How do we actually get money into these deals? We need capital raising support providers, and we're seeing way more of them pop up, some of them that are in the room today. Crowdfunding capital drives real growth. People think, oh, you put your money into these things and it's not actually helping anything. These are grifters just, grabbing money where they can. Well, I'm going to show you some examples of the amazing companies that are building in this space. And exits are coming, but it's still early. I think there was a time where exit timelines were 5 to 10 years. The reality is you just see the IPO markets, right? People don't exit. It's 10 to 15 years, in some cases 20 years. So if we're being realistic with ourselves, we are getting to a part of the market nearly 10 years in where we're just starting to see those exits come. And I think in the next 5 years, we'll start to see a really nice flow of exits occurring all the time as the market continues to mature. So just hitting on that, the main stat that I want you to get from here is that nearly 26% of issuers have between $500,000 and $100 million plus in revenue that are raising via Reg CF and Reg A. So again, this idea that every company in this space is just an idea on a piece of paper is simply not true. And the data spells out that like a quarter of the market, and if you look at the dollar volume going into those deals, it probably makes up nearly half of the market is later stage deals, companies with $1 million, $2 million, $5 million, $10 million, $100 million in revenue. And I think that's a really great thing because these rules can work for a wide breadth of companies. And that's really powerful because the entire private capital market stack needs support, and Reg CF and Reg A are providing that support. The other thing that drives me absolutely nuts is this idea that everything is just like a Shark Tank idea. And, I'm sure it's just food and bev and it's just breweries and, that's not going to be a good investment. And tired of hearing that. Yes, it is true. It works great for those things. It does. But actually, investors in this market are looking for much more than that. Look at the top 5 categories this year. Real estate has raised $160 million. SaaS has raised $99 billion. Healthcare has raised $70 million. Transportation has raised $66 million. These are the top 5 categories. Do you see food and bev there? No. Do you see consumer products there? No. The reality is investors in this market, yes, they're crowd fans. They love what they're doing. They're community people. that's great, and I love that aspect. But the reality is the investors in this market that are driving real dollars into these deals are investors, and they're looking for returns. And they want to invest in things where they see return opportunity, like SaaS, right? Where they know venture investors have made money for tens and decades, whatever you want to say. So anyway, all of this is to say is this works for much more than just a consumer product, and we're seeing that spelled out in the data. Constantly, I hear that, oh, this industry is full of bad companies, none of the companies in this space are any good. And if you could raise venture money, you would never raise from the crowd. If Andreessen Horowitz, the best investor in the world, technically, right, in the venture space, has backed 2 companies that have literally gone on and had some of the most successful Reg CFs of all time, and has supported that, has been a proponent of that, has written about the Reg CF industry and thinks it's a good thing, then I think everyone else just needs to fall in line, right? Arrive has raised from the Bezos family office. Picasso just had one of the most successful Reg A's of all time. They raised almost $75 million. They're backed by Greycroft, Maverin, Fifth Wall. I mean, these are some of the biggest names in kind of the venture and private equity ecosystem. And they're saying, yeah, there's a value to doing Reg CF and Reg A. And then we're seeing the capital support stack, right, build around us. Capital Department, Maverick Brands, Potomac Growth. A lot of these guys are in the room today. Please go and meet with them. These folks are the ones who are helping to create sophisticated strategies around how to actually raise capital from the crowd, whether it's top of funnel, running Facebook ads and Google pay-per-click, to email funnels, to how to engage your community, to how to do really good ongoing IR to re-engage folks to come back for future rounds of funding. All the tools around our ecosystem are being built to really help founders be successful. And this is going to be a very powerful piece of the next evolution of our industry, is actually having capital raise support providers. And then we're just starting to see those exits come along, right? And it's low and slow, don't get me wrong, it is. But we're starting to see some really interesting examples. So just to give you a few, Mevo, they did a round at a $12 million valuation on WeFunder in 2020. And a year later, quite literally a year later, they sold for $50.4 million to Logitech, right? Logitech's a real company, a 5x exit in a year. I think a lot of people would take that. Beta Bionics, they were one of the first companies, and I think this is perfect, right? May of 2016, so we're just about a decade in, and they IPO for $1 billion. So that tells me that if you give things 10 or 15 years, you're gonna start to see more stories like this. And then Revolut is the best crowdfunding example to date. To be clear, it was out of the UK. They raised on Cedars, which is now owned by Republic. But the reality is their investors are up 645x on their investment. And folks have already had an opportunity to sell a portion of their shares last year at like a 500x in their last secondary sale. So are there good companies in this market? Are there returns to be had? The answer is absolutely yes. And then I'm not going to go into these in too much detail, but here are 4 companies that we track. Either we've invested in them or we know them really well, who have done multiple rounds of funding in the Reg CF and Reg A space. Just look at ShiftPost, right? When they did their first round of funding on crowdfunding, they had $37,000 in revenue. Last year, they did $14.4 million in revenue. If you look at Liquid Piston on the bottom, they've done $50 million plus. They're like a deep tech company. They've done a lot of really interesting things. $8 million in revenue is solid, but what they've built, the technology they've built, how they're working with the Department of Defense is really, really impressive. And these are companies that are really leaning into crowdfunding as a main mechanism by which they're growing their businesses. And I think there's a lot to say for that. Nonetheless, there are challenges, right? There are challenges in this market. There's still capital raising struggles, especially for very early stage companies who don't have the resources to work with capital raising providers. There are still reporting issues in our industry. One of the biggest turnoffs to our space is founders not providing timely and thoughtful updates, right? Quarterly updates, it's what people should be doing. They should be filing their annual report every year with their updated financials, just so people know what's going on with the business. And folks aren't doing that. Limited returns. I think a lot of people, even if they thought 5 years, they didn't think 10 or 15, or maybe they thought conceptually they understood that. But now that they're 7 years into holding something, they're like, when can I get rid of this thing, right? So people want to see liquidity and they want to see exits. And then lastly is that restricted liquidity. So we need to see a secondary market where people have the opportunity to get into and out of these investment opportunities. So just to give you a sense of where the challenges are, right? In terms of dollars raised, folks who were raising up to a $1.24 million Reg CF shot to raise $1.4 billion historically, and to date have only raised about $413 million. So they've only hit about 41% of their goal. Under Reg CF, they've shot to raise $8.5 billion, but they've only raised about $2 billion, so about 30% of their goal. And under Reg A, they've shot to raise about $13 billion, and they've only raised about 2.2, about 20% of their goal. All of this is to say is there's still a lot of capacity in the system that isn't being met by investor demand, and there's a question of how do we solve for that? And I do think there are major opportunities to do so. On the reporting compliance and investor updates, look, at the end of the day, if people are going to continue to invest in these markets, they need to know they can trust the market, right? And one of those key pieces comes after a raise. We just see far too lower rates of people, A, providing their annual reports, which are legally required by the SEC, and B, providing general investor updates. And I think we need to see a lot more of that. We are building tools at KingScout to help with that, but we need more people just buying in and doing the right thing for investors. And then there are just mechanical pieces of this industry, right? Like, I'll give you an example. When you invest in a company and they IPO, and your shares will be with the transfer agent, like computer shares, you may have heard of them. And then you have to move those shares into your brokerage account to actually sell them. And there are fees associated with that. And typically you're getting a piece of mail, and it can take days or weeks to get access to your shares. And then the share price could be wherever by that time, right? And people don't know how to get them into their brokerage account. So there's mechanics around, once you have an opportunity for return, you actually need to be able to get that return. We need to create more seamless processes around that, because we hear a lot of friction and pain points with that for investors. And then let's talk about the liquidity part, right? So I thought this was the best way to hit on it. At the end of the day, there's been 6,200 unique companies that have raised in this market. There's been over 10,000 raises, but many of them are follow-on raises, right? We've only had 95 mergers and acquisitions. We've had about 500 plus failures. We've had 38 IPOs. Now, first off, that 560 number is exceptionally good from my perspective. If you look at the 5-year survival rate of companies in the United States, it's like 90% fail. It's a very high rate. So the fact that we're around an 8 to 10% mark is like really, really good. But only 2 to 3% of companies have returned yet, right? So we are still in the very early days. And if we want velocity in this market, people need to start to get their money back so that they can reinvest into the market. So there's a lot of work that needs to be done there. So where are the opportunities for growth going forward? We see more liquidity, right? We need standardized secondary markets that work for people. We need mainstream, streamlined ways of people being able to sell their shares when there are IPOs. We need more transparency around secondary markets so people know what they're buying into and out of when they're doing it. We need more returns, and that just takes time, right? That one is like not a hard problem to solve. It's wait long enough and you'll see the returns come along. If you think about it, really the bulk of companies starting to raise in this market came around 5 years ago. So we're only 5 years into the meaningful window of companies that have raised money. So I'm thinking another 5 to 10 years from now, it'll become very consistent that you're seeing, fairly decent returns come about, but it's gonna take time. But as more of those stories come out and people go, oh my God, this is real, then I think we're not only gonna see more people redeploying capital into the market, but we're gonna see more new people coming in saying, wait a second, I can actually make money here. We need better access. So I always say we need to get these opportunities where people are already at, right? The idea that you have to go to 50, 100 unique marketplaces, find them online and make individual investments, it's actually a crazy concept. Like, that's the idea of like, you have to go to like Google to invest in Google shares and Facebook to invest in Facebook shares. You just wouldn't do it, right? And I do think there's gonna be a future where you open up your brokerage account, your SoFi, your Robinhood, your Charles Schwab, and you find these investment opportunities alongside public equities. And I think that's the real mainstreaming of this asset class. Now you say, hey, that's a pretty crazy idea. I don't see that happening. Well, I think we're starting to see the first steps of that actually happening. SoFi, right, which is one of the largest brokerages out there now, has actually started offering access to the Fundrise late stage venture fund and the Sweater Ventures non-accredited venture fund. So they're offering access to alts directly within their brokerage account. Now they're diversified products because they're venture funds, but I think it's the next step towards getting to individual deal flow. Where do I think that plays out? Somewhere in the 5 to 10 year range. I don't think it's an overnight thing, but we're seeing more and more folks like Vlad Tenev at Robinhood talking about the need to offer access to alts in private markets. It is coming. And then we need more deal flow. And when I say more deal flow, I don't even necessarily mean number of deals. I mean quality and type of issuers. So we talk a lot about raising the caps on Reg CF and Reg A, right? And the naysayers will say, hey, why would you do that? People aren't even raising nearly how much they're shooting for. But it's not about the companies that are trying to raise right now. It's about the companies that would say, hey, I would do this if, right? We hear a lot of companies, 5 million is not enough. I can't do a real Series A with that. But if you could do 10 million, I would be interested. So I think what we're going to see is as we raise those caps, more companies will be willing to come into the space. We saw when the 5 million cap happened, right? That's when the Mercuries of the world and the Substacks of the world said, hey, okay, this is real and legitimate. I think when we see that cap raised again, we could see that happen again as well. And then, end of the day, we need more time, right? We're 10 years in. And by the way, I think for 10 years in, it's actually pretty impressive. $5.3 billion deployed. Over 6,000 unique companies have raised money. 2.9 million individual investors have made investments in this market. And it's probably well over 3 because not everyone reports. And look at those figures at the bottom. 25.7% of the companies backed have been female founded. 24.5% have been minority founded. We know that the venture ecosystem has pretty much completely failed this group of folks, continue to fail them, and are systemically broken to the point of never being able to solve it, clearly, after 20 years of trying. This market provides an opportunity to start solving some of these capital stack problems in the private markets. We've come an incredibly long way. I think there's a lot to be very, very proud of, and an incredible amount of opportunity ahead to really grow the industry. Thank you.
Wonderful, Chris. Thanks so much. 2-minute break. Come on back and we'll start talking about formation, changing the capital formation playbook. Great transition.
Streets light, we gather where ideas take flight.
At the summit, we're writing the code for the future of Capital's Road.
See, they stand strong and clear, uniting the dreamers gathered here. Voices rising, vision spun, the crowds are power. We act as one. We are shaping the future together. Storms may change, but our bonds hold forever. Innovation, trust, and might will light in the dawn of investor rights. At the summit, we raise our aim. Came flapping now has a brand new name. From passion to policy, heart to purse, we're rewriting the story, verse by verse. From dealmakers spark to king's crowd's view,
We measure what's bold, we build what's new.
DNA drives the message clear.
That the people's capital starts right here.
With purse at the table, the SEC sits voice.
Guiding our growth, defining our choice.
From impact investing to blockchain's thread, the crowd finds hope where angels tread. At the Professional Association,
We're the builders of a brighter nation.
from community to regulations art, every rule begins with heart.
If you can just find your way back to your seats.
Test.
Okay, so welcome back. So this panel, we're going to have Devin Thorpe. I'm going to introduce Devin, and then Devin will introduce the panelists. But Devin, in his bio, says he sees himself as a social innovator, but we see him as a social innovator. And we're going to hear about the next stages and the developments in the capital formation playbook. So go ahead, Devin.
Thank you so much. I am really honored to be here and really thank you for all being here. I want to, as the co-chair of the CfPA, I want to join my colleagues in thanking the sponsors. I know The sponsors are really what make this event possible. They're, as I know those of you who bought tickets might have felt like you contributed a lot. You did. We're grateful for that. But we really could not do this without our sponsors. So, and thank you. I think all of our panelists today are sponsors. So, thank you guys. I want to introduce our panelists in this order. Megan is an extraordinary human being. She is, she is the, she's the chief legal officer at Dealmaker, one of our platinum sponsors. Which is of course a leading platform, a very tech savvy, marketing savvy, and really, I don't think there's a platform with a larger average raise size than Dealmaker. It's a phenomenal platform. She's a seasoned attorney licensed both in the U.S. and Canada. She has over 20 years of experience, which I find amazing given that she's 14 now. And she has worked both in securities, corporate law, and IP law, and has worked at McCarthy, Tetro, and Spear Woodward, as well as in her current capacity at Dealmaker. Marty Tate, well, let's see, Craig Denlinger is the managing partner at Artesian CPA, and he does a tremendous job. He serves on the board of the Crowdfunding Professional Association, and his firm is a leading auditing and accounting firm in the crowdfunding, Jobs Act world. He's kind of specializing in those Reg A and Reg CF offerings. He's, of course, a certified public accountant. He's recognized nationally as an expert in crowdfunding finance, SEC reporting, and startup financial strategy. And Marty Tate is an old friend of mine from my Utah days, and we're glad to have Marty here. He's a partner at Kunzler, Bean and Adamson. He specializes in corporate finance, securities, fintech, blockchain, and crowdfunding law with over 25 years of experience. He represents leading funding portals, broker-dealers, and service providers and issuers nationwide on Reg D, Reg A, and Reg CF offerings, and serves as the chief legal officer for Core Inc. So we have really an expert panel, and we'll give you some time to ask questions before we're done today. But I want to start with a question for all of you, and maybe invite you just to go through the roster as you're sitting on the panel. But with the change in administration, change in regulatory leadership at the SEC, it's easy to anticipate some changes. What are you expecting to see from a regulatory change standpoint? I know, Megan, you've been working on the Hill. What are you seeing?
Yeah, this is not going to sound like a surprise to most people in this room, and we're going to hear about it later today, but there is pending market structure legislation on the crypto side of things that we expect will be passed this year or early next year. There's a House version called the Clarity Act. There's a Senate version called RIFIA, and the results of that passage will have profounding effects for the capital formation industry across the board, not just crypto. What is refreshing to see, though, is that some of the old rules that have really tied down entrepreneurs and capital formation are getting a lot of attention right now. They need to be changed as well, so that things like digital assets can work better in the system. So whether you're working with digital assets or not, expect to see some changes as a result of those bills moving through the system now.
Yeah, in addition to what Megan said, I with every administration change, we obviously can expect changes. Some of these changes have been bigger, more ambitious than other changes. I was telling a colleague that I was excited to come to this because I'm excited to hear kind of maybe some direction. And one of the things and just get a little bit more clarity, no pun intended about the Clarity Act, but just clarity on exactly what it is, because there's been a lot of talk about this happened. We've had clients call and say, hey, well, now with the new law, we can do this, we can do that. Well, we still need things to pass. We still need regulations. We still need some more direction in exactly what is. And I'm trying to tell my clients we still need to follow the law. Is still the law. We still need to continue down this path. Hopefully some changes will take place. We'll have more direction, more clarity, and understand exactly what we can do. But and I keep reminding people that I've had a few clients that said, "Hey, well, we think we can that doesn't apply to us anymore. We can just kind of do whatever." I said, "Well, I wouldn't go so far, and administrations can change, and you never know what can happen in the future." So anyway, that's my thoughts.
Craig, do you want to add anything? I don't want to leave you out.
I sit on the policy committee with Megan, so I just defer to her expertise in this role.
Okay, fantastic. Megan, as a quick follow-up, you have been coordinating the activities, really leading them on behalf of the CfPA. We had some great meetings yesterday that you led. I'm grateful for that. Really interesting to see the progress. But at the same time, we were doing this in the middle of a shutdown. The members were all gone. It begs a question, right? I think 6 months ago, 9 months ago, we expected big changes. Are we going to see changes? Are we? What is your take on just the mood and how Congress is going to operate? With all the control sort of in the hands of one party, looked like this was going to just roll through a bunch of changes. What do you expect?
Yeah. So we at the CfPA have kind of been working on anticipating a lot of changes this year because of the change in administration. So it's been a group effort. Yesterday was still a great day, even without members on the Hill. And history of what the last years looked like and how it was different yesterday because of the current shutdown. When we were here meeting with staffers and legislators, we heard the same message, and that was, well, we can't really do anything right now. It's kind of a dead Congress. We can't get anything passed. And so there was interest in speaking about issues that were important to entrepreneurs and small businesses, but there was a recognition that little was going to actually happen, given the current state of the government at the time. The election, obviously that changed, and there was this really renewed optimism that things, as Devin implied, really fast across the board, and that included capital formation. And that did happen. What you saw on the capital formation side, the House Financial Services Committee, which is a very influential committee in Congress, is led by Chairman French Hill. He's spoken at a lot of events across the board. He was very aggressive about making sure that bills that had been sitting kind of dead for many, many months, up to 18 months, actually got pushed through as quickly as possible. So he's been working with Congresswoman Wagner, who is the chair of the subcommittee on capital markets, and they've been working to push through between 14 to 28 bills that were just sitting dead from the last administration. Ideally, they're trying to push those through by the end of the year. So the first message I think to take away from this is on the capital formation side, which impacts all of us in this room, we have a really great group of legislators who are very passionate about making progress, pushing through progress, and doing what they can while the House and the Senate are both controlled by the same party, because it's just much easier to push through legislation, no matter which side of the political aisle you sit on, when it's one party in charge of both houses. So that's a great thing from the industry perspective. In terms of the shutdown, there is going to be a delay. We had a bunch of meetings yesterday that Jenny and Devin have mentioned. Bills that have already gone through approval by a committee or approval by the House will most likely still get pushed through this year and end up in a package for President Trump to sign. If the bill hasn't gone through either of those processes yet, it's very unlikely that it will be pushed through this year, and it will be pushed to first quarter next year, which means, of course, there'll be a backlog next year, and there's really going to be a fight for attention next year in terms of which old bills and which new bills actually get attention in the first 6 months of the year, because then attention will pivot to the midterms. So, if you're thinking about wanting to go and meet with congressmen and women on the Hill and staffers, think about what issue is really important to you and how that impacts the broader industry, because there is going to be an opportunity for 1 or 2 issues to get some attention next year that haven't already gotten attention, but not 10. That would be the message that I would leave people with.
Excellent. Craig, you deal with the accounting side, right, at your firm. And the reality is accounting is really, I think, way underappreciated by entrepreneurs. They see it more as a burden than as a strategy. And so I anticipate that you see a lot of problems that you go, both from the standpoint of what your clients are doing or not doing, and the regulatory challenges they face as a result. How do you see that situation, and what are the challenges they're facing? What are you hoping for in terms of policy changes to adapt to that?
Yeah, piggybacking off what Chris said earlier about the issuers in Reg A and Reg CF being further along, that's the number one thing I'm seeing. So same problems that we've been dealing with all along in this world, but everything's getting more advanced and more complicated when we got, companies coming to us with 20 revenues versus those first or very little revenue type of companies. That makes for a much more difficult. Getting everything cleaned up and caught up, that it's just a very complex process of bringing things from cash basis QuickBooks to SEC rules, especially on the Reg A side. There's a lot that goes into that, and that's all being balanced with the zillion questions that the entrepreneurs are being asked of the lawyers, the portals, brokers, and various other steps along the way. A new thing we saw first time this year was one of our early Reg A clients crossed a $50 million threshold that forced them to full public company reporting. That was something that was kind of a wait and see for many years, and this is the first time we've seen that tripped up, and still working through that process with them. But it's a very big deal to move to full public company reporting, and I think at the stage we're in as an industry, that's going to be kind of a good problem to have. You're hitting 50 million revenues, you're probably pretty happy with things, but it's also a huge process and an ongoing, huge time and financial burden for companies.
Do you think it would make sense to reduce that public reporting burden for those sorts of reporting companies to semi-annual? Would that make sense to you as a CPA?
They have thresholds for what you need to do and when. It's quarterly right now for the full public reporting, and for the smaller ones, I certainly don't think that'd be a problem, and especially when they're not trading, which my client is not planning to be. So timeliness of information isn't as important. And for a private company like this that's not trading, it's really not any benefit to anyone to be going through this. So be a beautiful change to carve out some more exemption there, maybe increase the cap on that revenue to something that's not as easy to trigger for us.
Yeah, inflation has made that less meaningful of a threshold.
Other things, the accounting standards setters are always slow to react. We got finally crypto valuation guidance. That was something we wrestled with for years and years. There's a number of other things that have been out for a long time that remain unaddressed, like safes and like royalty-based or revenue-based debt structures. Things we tend to see all the complex stuff first in this industry, and then it's smelling like we're going to be waiting 10 years for rules and guidance on a lot of that stuff as it comes up. And I'll finish with my wish list for change. The accounting and auditing rules are a lot easier on the Reg CF side than Reg A. So a lot of companies go to Reg A that otherwise wouldn't need to if we had a higher Reg CF threshold. So I know with the various bills being pushed through, that's something on the table. If that got increased from the 5 million to 20, 50, heard a bunch of different numbers thrown out there, but that would be a good thing for the industry from our side of things, that make things a lot lower cost and more timely for issuers working with the Reg CF rules.
That's great. Great feedback, Craig. Thank you very, very much. Marty, I'm curious, you work with all the different players in the industry. So you've got this great perspective, and I imagine you're seeing some real innovation. Tell us about what some of you're seeing that's innovative, new kind of in this marketplace, and where you see the kind of the puck heading.
Yeah, so you're seeing a lot of the innovation. So I'll kind of approach it from the Reg A side and the Reg CF side. On the Reg A side, and it's not a new innovation, but what is new is how it's being used. But the use of a series LLC, that was sort of first introduced, I don't know, maybe 6, 7 years ago in with collectibles. That's where we really saw the use of a series LLC. So you could have a car, a racehorse, a pair of shoes, whatever it was. We worked with spirits companies and wine companies and different collectibles, art in an individual series. Now that's expanded. So now you're seeing real estate. We worked with one of the first real estate companies that used the series LLC. That was a heavy lift with the SEC getting through that process. Now companies like Arrived are doing that regularly. And so the use of the series LLC has been, like I said, it's expanded a lot. We've seen some innovation on the Reg A side also, just with companies that would be qualified as an investment company are typically prohibited from using Reg A unless there is a sort of an exemption from that. But we've seen some creativity with how a Reg A is used to basically do investment type structures. So investing into a Reg A company that then goes out and does microloans and so forth. On the Reg CF side, you're seeing a lot of creativity. You're seeing typically initially it was a lot of equity offerings. Use of a safe probably has been the largest security that's been offered there. But now you're seeing things like bonds, seeing things like revenue sharing. We just are working with a crowdfunding portal that's going through the FINRA process that's going to be doing revenue sharing on video games and apps and so forth. So that's pretty unique. And then within Reg CF, you're seeing some creativity with even having offerings with multiple sort of offerings within that offering, so that the investor has a choice of, hey, I want these terms or these terms or these terms, and one of them had up to 16 different terms that they were offering. The other thing, the last thing that I'll mention is we worked with a company that was using Reg CF and Reg A to provide equity to their members. So they were a membership club that was I want to say similar to Amazon. Nobody's similar to Amazon, but you get the point. They were an online retailer that was, and they wanted to reward their members with equity in the company. So they used Reg A and Reg CF to allow people, you'd buy a membership and you would get equity in the company. That's what they did on the Reg A side. On the Reg CF side, you would buy equity in the company, you'd get a membership. So they used both of those to basically give away equity in a company, which I thought was unique. And again, they're still in the process of doing that capital raise, but it was a pretty unique and innovative structure.
Yeah, that's there really are a lot of innovations coming down the pipe. I'm really excited about the app and video game platform. There's one doing something similar with YouTube creators, and so there really are some cool things going on in the Reg CF world, and I appreciate you sharing just a taste. Megan, let's come back to you. I mentioned that you and your colleagues at Dealmaker, I think you have the highest average Reg CF raise, certainly the highest average raise among all the offerings you're doing. Big raises, which is great. Very cool. Are you starting to see institutions play along and participate as investors? is some sort of a playbook beginning to form for institutional participation or not?
Yeah, I don't know if I would go so far as to call it a playbook, but certainly the tides have changed. So if you look out even a couple of years ago, or potentially less, Reg CF in particular was kind of seen as a last resort. You couldn't get VC funding or institutional funding. Now it can actually be seen as an asset if you structure that Reg CF around community, and you're able to show sort of proof of concept. It validates the business. We're going to hear a little bit about how to establish that community from a marketing perspective later. We've got a whole panel on that. So that strategizing around building your community and how you do that is a really core component if you're going to try and combine Reg CF with institutional funding. What I would say is that if that is something that you're seeking to do, planning is really key. So, finding some good advisors like the gentleman here next to me, lawyers and accountants who can really walk you through the steps that you need to think about. For example, a lot of our issuers will spend a lot of time thinking about what their cap table looks like. You want it to be appealing. Using an SPV is one of the primary ways that typically we see issuers use to control their cap table. Thinking about how you're going to value your capital. Valuation is really important. And then, also just thinking about how you track your metrics. How are you going to show that proof of concept? What do you need to bring that institutional capital in the door?
Excellent. Craig, I want to come back to you. Marty was talking about some of the innovation he's seeing. You obviously are coming at this from a very different vantage point, both geographically and professionally. What are the innovations you're seeing from your desk?
The big thing with our client base was the Series LC, as Marty touched on there. Likewise, 6-7 years ago, people like Chris Ransom over here with the racehorses, lots of real estate, collectibles, variety of things have rolled through that for years, and still getting new types popping up on my desk over the past couple of years. When NIL deals for college athletes started becoming a thing the past couple of years, of course that pops in. Is got a couple different clients working on Series LC structures to allow those student athletes to kind of early cash out on their potential future earnings. Pro athletes contracts have also been going through the Series LC structure. Music royalties, we've had a few over the years. We've got a couple new ones coming through that seem to be getting a lot of traction. So it's just been really cool to see a lot of unique, cool things that people can invest in if these things take hold.
Yeah, this is really cool. Such a fun conversation. Marty, I want to come back to you. How are the fintech innovations altering the landscape? What do founders, investors, and other practitioners need to do to adapt, to take full advantage? I mean, there's a whole room full of people who want to know, really, what are the action items that they should be taking?
Yeah, and I think we have a whole panel later on, so I don't want to steal too much of their thunder on the fintech and crypto side. But I think that one of the things that we're seeing, and this isn't new, but I think there's sort of a renewed excitement about it, is when people are coming and saying, hey, we want to do this offering and we want to tokenize it. So, which is really just a technology. It's still going to be a crowdfunding offering. It's still going to be a securities offering. It's just how are those, for the most part, I guess, it's how are those securities, how are they going to be registered? How are they going to be tracked? Is it going to be done just on a traditional ledger, or are you going to move that to blockchain and you're seeing, obviously, you're seeing major exchanges moving towards the tokenization of their securities. You're seeing other companies that are and other players in this field that are looking to adopt the tokenization of digital assets as part of their protocol. So I think that that's something that when you're asking about what can people do, I think it's just having that eye towards that future and answering those questions maybe sooner rather than later instead of, down the road where you think, okay, hey, we're already a mature company. Now we want to move towards that. That would be my thoughts.
Great insights. Well, I've got about 72 more questions for this group, but I want to give you all an opportunity to ask questions. What do you want to know from this super panel? You got any questions for them? Okay, in the back.
Absolutely. Hey, good morning. Thank you so much for your insights. What are you seeing on the international investor side as far as Reg A is concerned? Is it as limited from a taxation standpoint as well as from a regulatory standpoint? Or are you seeing some innovation happen there policy-wise?
I'll take a quick swing and then I'll pass around. But so with regards to Reg A, international investors can invest in a Reg A. A lot of times people think that you need to do a Reg S or something, but you did hit a good point, is that sort of taxation. Depending on the structure of how they're investing, so if they're investing in something and it is something like a Series LLC, then there could be potential tax consequences based upon that structure. If they're but if it's set up as something like a REIT or a corporation, then they don't necessarily, unless they're paying dividends, they wouldn't have to pay U.S. taxes. So that's just something to think about. So structures to get around that. I haven't seen a lot of creativity at least in the Reg A space about that. That's just something that, if you want to invest in those deals, you're going to have to, you potentially will have to pay taxes on it. We do a lot in the fund space, and so there's a lot of, blockers and so forth that can be put in place. But I really haven't seen that put in place in crowdfunding. Want to weigh in on that?
Thanks, Marty. Great question. Thank you very much. DW, you got a question for us. Thanks. Appreciate that, Elizabeth.
Hi, DW Farrow with localfund.org. And my question would go back in history a little bit. 100 years ago, we had something called curve exchanges that matured, and bucket houses, which was leveraged investment, which was shut down. There's been, especially in certain, I'll say, poly markets, leverage investing or speculative investing where there was no underlying cash, essentially getting a loan to put money in. How do you see things going forward? Is that going to kind of, I have my own opinion about whether or not that's good for the market, but how do you see that going forward, especially as regulation pushes to deregulate?
Great question. Megan, do you want to jump in on that?
Yeah, I mean, we're not seeing a lot of that in the space that we work in specifically. I think where you're seeing a little bit of hedging that's similar to what you're describing, but not exactly the same thing, is certainly on the tokenization side of things, where you're really seeing tokens that in some cases represent underlying value and in some cases don't. So that's where we're seeing a lot of chit chatter in the market. And to the point that Marty made, it's not quite clear yet whether or not some of those things are going to be treated as securities or not. There's certainly a gray area there and lots of people on both sides of that argument. So that is one area where we're seeing a lot of chit chatter.
Okay, great question, DW. Mezzi, I think you had a question, didn't you? Thanks, Elizabeth.
Thank you, Devin. Meseret, running crowdfunding from Africa, Ethiopia. So I wanted to ask you the reverse. You just answered the question, international investors investing in the issuers here, but how about the reverse, people investing on international issuers? Is there any even movement, Megan, especially yesterday we were running around the capital, if there is even any movement in terms of regulation, but what your take looks like on the reverse side of it.
So I'm not going to dare speak to international crowdfunding rules. I know that there are, certain countries have approached that. But what I will speak to is the use of U.S. crowdfunding to fund things that are not within the US, so international projects. Regulation CF is limited to US issuers. Regulation A is limited to US and Canadian issuers. We did do work on a Reg A that was a US company that was providing microloans to companies in Africa. So that was something that was again, US entity, US funding, but was actually benefiting projects that were outside the US. So again, that speaks to sort of that creativity of being able to use Reg A. But I'm not sure if that answers your question or just creates more questions. I don't know. But anybody else want to weigh in on that? Okay.
Excellent. We have time for probably one more question, if someone has a question. Okay. Okay, over here. Yeah. You're getting your workout, Elizabeth. Thank you.
I'm Chris Ransom with My Racehorse, syndicate horses. Are you guys seeing some creativity in the use of revenue contracts, which seem to be kind of taking place, both from the Reg A space and the Reg CF, which generally I think were kind of a challenge in the prior administration, but seem to be possibly popping up? Is that something that you are seeing more of in the space?
So I have seen that. So I mentioned before that we're working with a app development gaming company that's using revenue sharing. Interesting, we just spoke with a precious metals company, and the idea for that, and it's similar to almost like a futures contract, so we've got to think about that because there are prohibitions on that, but what they want to do is basically they're trying to not only fractionalize and securitize these mines, but they're wanting to tokenize it, so there's all of these things, but that would be based upon a revenue. So rather than it being owning the actual mine, it would be you're buying an investment contract that would title you to rights in the future revenue of that. So yes, we're seeing stuff like that, but it'll be interesting to see how the SEC approaches it. I know during the past, in the previous administration, and again, things go up and down, but initially, even with digital assets, there was a lot of pushback, then there was more of an acceptance. It'll be interesting to see what is allowed. A lot of times it's also just the luck of the draw, what examiner you get. Some people have their pet issues and they just won't let you get it through. So those are my thoughts.
Yeah, and we are seeing a lot of revenue deals going on in the Reg CF space now. It's really quite common. I've invested in some myself. We've started doing them deliberately about 2 years ago, and Honeycomb started doing them a year ago or so, and so it's becoming a thing for sure. I think it's a great trend. I want to thank this great panel. Oh my gosh, what a tremendous roster of people. I think please give them a big hand. I mean, these guys are great. Thank you all, and thank you, Vince.
Thank you. Really wonderful insight into regulatory as well as deal structures. 15 minutes, courtesy of Kunstler, Adamson, and Bean, and clearing bid. Be back by 10:29 so we can get started promptly at 10:30. Thanks.
What if we could get some of that money that is, from the more prosperous members of the community to invest in local business instead of sending their money out to Wall Street? That could really build wealth. And of course, to the extent lower income folks can afford to invest in campaigns. And if those businesses survive, and if there's a whole set of wraparound services to support those businesses, then we can build wealth for everybody. So I hope I plan to get more involved in the community wealth building movement as president of CfPA. So then the third thing that I was going to mention is that we need new business models in this space. And this is where I don't have a lot of answers. As I've said, I have seen many players in this space really struggle. It is such a highly regulated space, and it's very unpredictable what you're going to need to do to continue to be approved to operate in the space. And so you really need a decent amount of revenue to survive. And the revenue model is really challenging if you're a portal. The amount that you can take from the successful campaigns is rather small. And if you're working all businesses that are maybe only raising 100,000 or 200,000, you're really not making enough money to have a viable business. And that's why many of the more successful platforms are targeting the bigger kind of wannabe unicorns that are raising 5 million, which is great. We want those businesses to be successful, but it's really disappointing to me that the businesses that I was most excited about helping when I worked to get the law passed in the first place are really challenging to help because you just cannot make a living when you're taking, 7% of 100,000 and you only have a few campaigns. And it takes time. I work with a lot of entrepreneurs to raise money under regulation crowdfunding. It takes a lot of time and handholding for them to get ready to do it. So it's a very expensive, labor-intensive process, and the amount of money you can make doing it is very small. So we need to get creative. We need to ideally bring in some philanthropy and, nonprofit models. So I look forward to hearing others' ideas about how to kind of save this industry, because I'm seeing an industry that is really getting more and more focused on the large raises and kind of leaving behind the ones that need this the most, to be, in my opinion. Let's see. I think that was about it. I was just going to say, please join us. It's such a wonderful organization. This is us at our summit in Washington. And there's many ways to get involved. We have a free crowdfunding ecosystem that you can join where you can share a lot of knowledge and ask questions. You can become a member. It's only $10 a month. If you want, you can become a sponsor where you can get some recognition for your business. Oops. And also, one of my goals this coming year, will be to do a lot of listening to players in the industry so we can really understand all the challenges and successes that are happening. So please email me at jcasson@cfpa.org if you'd like to share feedback about your experience in the industry. Thank you.
So Jenny, we have some questions, and so people I think are curious about the Capitol Hill lobbying strategy, the timeline, things that will happen, whether or not the organization has identified some likely champions that could advance our agenda. You were really the head of the policy committee for the past year, so you were the one who was among the team forging consensus around those issues that we've selected. But now it seems like we're moving more toward execution on those ideas. So do you want to talk a little bit about that sort of execution strategy and the organization?
Yes. So our policy committee has broken up into subcommittees to focus on a few of the different areas. For the legislative side, we're working on setting up meetings with the key legislators, and we are also looking for other organizations to join forces with that share the same goals. Obviously, we're more powerful if we can say we're representing a coalition, so there's some work happening with that. And then in terms of meeting with the SEC, it'll be, there's going to be big changes at the SEC. But the good news is, thanks to Brian, we have some great relationships at the SEC with some of the commissioners. So we'll be continuing those, even some of the ones that are staying. And they've been very receptive to what we're talking about. In fact, Commissioner Peirce did come to our summit and was incredibly receptive to what we were asking about. Crowdfunding is designed to get funding, patient supportive funding, right fit funding into the hands of businesses that are doing good in their communities and often don't have access to more mainstream sources of capital. like banks or venture capital funds and that sort of thing. So I think it's an exciting thing to explore how the two worlds, I mean, there's a major ecosystem of CDFIs and there's a major ecosystem of crowdfunding. And I'm excited to explore how those two can work together. So I was able to get Yulia Tarasova to join us from C-Note. And I immediately thought of C-Note when I was trying to think of creative ways that crowdfunding and CDFIs can work together, because C-Note did something very innovative, which is to use crowdfunding to make it easier for everyone to invest in CDFIs. So that's one example of how the two worlds can work together. There are other examples as well. I wanted to share that there is a small but growing movement in the world of CDFIs for CDFIs to help their potential borrowers to use crowdfunding as a way to bring in equity that can be used to leverage the CDFI loan. So there's a couple of examples of that that I'm aware of. One is Spring Harvest Co-op in Massachusetts, which is a hydroponic greenhouse that raised $400,000 using crowdfunding, and that enabled them to do a $2.7 million project with an investment from a CDFI. Democracy Brewing in Boston raised $370,000 using crowdfunding, and that leveraged a $3.5 million project. So that's also a really exciting way that we can be working together. So this is just the beginning of the conversation, and we definitely want to hear from those of you who have experience in crowdfunding and or CDFIs about your creative ideas about how the two worlds can support each other. And we do have someone who just joined our board of directors who's very active in the CDFI world. So there will be lots of opportunities to have those conversations. So that's my introduction, but let's hear from Yulia. So Yulia, tell us about you, how you came to co-found C-Note and what C-Note is all about.
Yeah, thank you so much, Jenny, for having us and hosting the webinar to the association. So I would just start sharing that I'm an immigrant to the United States. I actually come from Eastern Europe, Belarus, and my interest was always around finance and understanding how finance can be a tool for change. I consider myself a math nerd, and I'm a finance nerd, and I literally can spend like days just thinking about different financial products and how we redesign them to be more inclusive and to be more in line with the needs of communities that we all care about. And so I came to the United States. I had a pleasure and opportunity to work on Wall Street, and definitely learned a lot on how traditional financial system is built, worked, kind of pluses and minuses. And then at some point in my career, I decided that I want to bring those financial skills into impact investing, community development space. I started working with an institution called Acumen Fund. Some of you might be familiar. It's a very prominent fund in the impact investing space, and with them, worked on different projects in Africa, and then eventually, I think having that experience, and I always say, like when you can see how your skills and your knowledge and your experience can actually change people's life, you cannot unsee that. And so then after that experience, I was looking to find ways to continue on that journey. And that's sparked that idea for C-Note. And so C-Note was founded in 2017 by myself and my wonderful co-founder, Catherine Berman. We both come from traditional financial field, both bring quite different experiences into the company. But the idea has been, how can we use financial innovation to close the wealth gap? There was realization that traditional financial system might not be exactly designed to serve everyone in an equal, fair, and just way. And so a lot of it was around how can we redesign it, reallocate the capital, be more thoughtful of how the capital is being allocated to really close or attempt to close the wealth gap in the communities. And right now, what C-Note has evolved into, and as you can imagine, has been a journey, has been a process. We started about 10 years ago, and as any company, we've been trying to listen to the market, to understand what dynamics are happening, how it influences community development space.
It's such a win-win what you're doing because community financial organizations, whether they're CDFI certified or not, need capital. They know how to deploy it. They have those relationships. And so you are creating this new stream of funding for them. And, it's a great way for a place for people to put their cash where they can really have a positive impact. Given that one of our themes, CFPA's themes for the year is potential partnerships between the crowdfunding world and the CDFI world, or maybe we want to broaden it to community financial organizations. Do you have any other ideas of how those two worlds can intersect with each other? We do have a couple questions. One person asked about, would a CDFI ever want to use Reg CF instead of Reg A? You can only raise up to 5 million at this point, but any thoughts on that? You're obviously very creative, so any other creative ideas of how we can continue to be working together?
Yeah, I have to admit I haven't been up to date on Reg CF, so I don't know if I would be able to comment on that. I mean, happy to take that offline and have this conversation if someone has an idea and just to see how, based on what we know, based on our work with CDFIs, how it could land. We're always open to those brainstorming conversations. I also see the question about debt versus equity. I would love to bring more equity to CDFIs. I think it really takes again another kind of like the design process to figure out who's going to buy that equity product and what is the market out there, who is right, what the expectations for that equity, what type of results we can create. I think when we started and why we kind of like started this debt is because it felt like a nice step up from someone doing donations to CDFIs and kind of like understanding what they do to now a little bit higher. It's like, okay, well, there's like obviously a little bit of risk because it's an investment, but also, the whole history of CDFIs, their incredible low level of defaults. And, even though CDFIs are not rated, but, we have tons of data to support that if they would be rated, they would be like AAA or like, AA plus. And so like that allows us to create kind of like that product that even without being rated has very strong credit quality. And then we can demand a certain type of return. And again, it could really nicely fit in your portfolio, especially as for non-accredited investors, right? When we talk about equity investment, right? It's about, okay, like, well, who's going to invest it? Who's willing to invest it? Who understands CDFIs, right? Well enough to commit to that. Where in your investment for portfolio that product would fit, right? So you kind of like start putting that investment management, my CFA hat on, by CFA charter holder. I was like, how am I going to, talk about this to the clients and explain to them, and again, how big that market is. And we do, as I mentioned, like we do work with individual investors. We also work with institutional investors. And so some institutional investors might be more open to go into that, right? Because again, they have more different pools of capital to play with, and they might want to get more experimental, right, with certain capital. And that's also the work that we can be doing with them, again, given all their experience in the data and behavior monitoring, right, that we've done over the last 10 years by working with CDFIs and these investors investing in CDFIs.
Yeah, and as you pointed out, there is an association of CDFIs that are VC-style funds. What is it called? It's like the National Venture Capital Community Development Venture Capital Association, I think it's called. I have to admit that I am a little frustrated because from what I can tell, most of the folks who do equity investing out of CDFIs, they often use the venture capital model, which is not a fit for the vast majority of businesses. And so I would love to see more CDFIs that are doing equity investment looking at alternative forms of equity, like revenue-based equity with structured exit. So
Keep going as people trickle back in. Really excited to announce the next panel. The moderator is Brian Christie, who is the founder of Brainsy as well as Biotech Social. He's also a former CfPA president. And I think I'll just turn it over to you. Go ahead.
Thank you, Vince. Appreciate it. Everyone has a chance to file in. I'm going to grab my glasses because I'm at that age where I need them. It is my honor to introduce the two panelists today. I'm going to basically just let them do more of a detailed introduction about themselves, but let me just state who they are. We have first to my left, Andrew Field, who's the executive lead UK of the Global Equity Crowdfunding Association, or GECA. And then we also have Angela Barbash, who's COO of Revalue, and she's also on the board of directors of CfPA. She's been very instrumental in making this whole thing happen. So we really owe her a lot of gratitude for the input she's put in this year. So the title of this is Patchwork and Plumbing, the Regulatory Fragmentation Abroad and Fiduciary Constraints at Home. And we're really looking at a couple issues. And these are issues that we look at as an organization, as CfPA. We look at things that are related to the plumbing that's related to crowdfunding, how, and I think Chris Lustrina earlier talked about the mechanics of the industry sort of coming together. We sort of talk about it in terms of plumbing, things fitting, and we look at things in terms of the policy, because that's what we do. That's one of our mandate, is to advocate on behalf of the industry. And so we look at the policies, and we oftentimes try to put things in one bucket or the other to determine, how do we approach this? How do we advance the industry? And so crowdfunding, while CfPA is US focused, we actually have a lot of people who are here today who are from all over the world. It's of global interest. So we have people who are from Ethiopia, from the UK, we have from New Zealand, we have people who have come from Mexico, from Australia, I mean, really all over. And those are just the ones I know about. So it really does speak to the fact that although we're very US-centric in focus, crowdfunding is really global by nature. So I'm going to let each of the panelists just give a little bit of background on themselves and their organizations, and then we'll turn it over to questions. So,
thank you, Brian. Fantastic to be here, and I just want to thank everybody for allowing me to speak and be on this panel. It's a true honor. So, as Brian said, I'm here actually in my capacity as the steering committee lead for GECA. GECA stands for the Global Equity Crowdfunding Alliance. I also work for DaxiChain. DaxiChain are building an infrastructure layer to help connect platforms across the globe. And well, at GECA, we have close to 100 supporters now. And we are run by a steering committee, an independent steering committee. It consists of 15 real high-power individuals in the industry from across the globe, many of whom are in this room, actually. And we have one shared vision, and that is to create a truly borderless global equity crowdfunding ecosystem. So it's an honor to be on this discussion. The patchwork, I can see why you've probably asked me to be in this discussion, because the patchwork actually it's a global issue, not just something in the US. So thank you for that.
Good morning, everyone. I am the COO and CCO, Chief Compliance Officer of Revalue and co-founder. We're a registered investment advisor. We're SEC registered. We're based out of Michigan. We serve clients nationally. And we've been around for, we're in our 13th year. So we were here in the very early days and launched the firm specifically to serve local investors, which is what we called them at the time. And no longer, because community investing and investment crowdfunding has really spanned beyond the locality of people and to define community in a different way. So I'm really excited for the conversation today to take you a little bit behind the scenes on what the challenges are.
Great, you guys can keep that mic. I have my own now. So, Andrew, GECA brings together leaders from Europe, Africa, even the US, and the goal is sort of to promote greater alignment of equity crowdfunding. What is the global opportunity for crowdfunding? And what are the sort of challenges? What are the inconsistencies? What are the things that make it difficult when people are looking at cross-border participation, whether it's as a portal or an investor? Like, what's the opportunity? What are the challenges we see today?
Sure, that's a really broad question, so I'm going to try and keep this as succinct as I can. From a global perspective, the opportunity is huge. We've already mentioned, Jenny mentioned earlier, there is a multi-trillion-dollar gap in funding for SMEs, and it's that's from around the globe actually. It's exactly the same from around the globe. These are the businesses that create jobs, that encourage innovation, yet they actually are still locked out of traditional financing methods. So it's quite difficult. Crowdfunding has proven that it can connect investors to these businesses, and it's also proven that investors are hungry to invest in these businesses. So this is retail and community investors that are hungry. The technology exists to make this happen now, but the regulation hasn't always kept up with the pace. So what we're seeing is a real patchwork of rules when we look at it from a global perspective. In Europe, the EU has tried to harmonize crowdfunding to a certain extent for its 27 member states. They introduced something called the European Crowdfunding Service Providers Regulation, or ECSPR for short. And the whole idea of that was to help harmonization and to enable cross-border activity within the EU. The implementation of that has been not quite as expected, though. The guidance wasn't there, and that's resulted in really it not serving the purpose that it was intended to do, which was to provide that harmonization. The UK, of course, since Brexit now sits outside of the EU, so there's no real functioning passport within Europe at the moment. Africa is pretty similar. It's probably less developed in that respect. There are countries, Meseret is here, who's involved in developing the Ethiopian regime, and there are several other countries that are looking at that as well. But it's still quite sort of early stages there. Asia's a bit of a mixed bag. You've got Singapore and Malaysia that have very well established regimes, but then they've got neighboring countries which don't allow crowdfunding at all. Ironically, the US is probably one of the most comprehensive sort of unified crowdfunding regimes in the world, but it's probably one of the least accessible internationally. So Reg CF, as we've all already discussed today, only allows US-based issuers to raise. It's built around SEC and FINRA regulated portals that can't easily onboard non-US investors because of things like KYC, AML, and tax rules. So the US still functions as pretty much a closed system globally, and a single well-regulated marketplace. We haven't got that connected to the rest of the world yet. I'll just two more points if that's okay. Yeah, sure. Result is we can't easily scale across borders, and investors can't easily participate in deals outside their home markets, and that's one of the reasons that GECA exists, to try and sort of start that harmonization process.
Okay, and you mentioned U.S. issuers have a problem. So for U.S. or foreign issuers who are trying to raise money from outside their home country, what are some of the practical and maybe regulatory barriers that exist? So lots of issuers want to raise money. They want to get money from investors abroad. What are the challenges?
Well, if we talk about the regulatory incompatibilities, first of all, again, for Reg CF, I've kind of just mentioned that non-US investors do face barriers. Reg CF intermediaries, funding portals, the broker dealers, they are subject to strict SEC and FINRA oversight. They can't easily onboard investors. They can easily onboard investors who meet the US KYC, AML, and tax requirements, but that's a little bit different if they're from international. They're not easily compatible with international investors necessarily. There's also no clear passporting rules or, and I always struggle to say this word, but reciprocity. Meaning that a UK platform, which is, for example, fully authorized and able to trade in the UK, although it may have really high investor protection standards, it can't operate in the US. There's no mutual recognition between national regimes. So if you're a UK or an EU issuer wanting to raise from US investors, you've got to comply with two completely different sets of rules, and that's very laborious. And the result is that US investors can't easily invest abroad, and global investors can't easily access opportunities to access US offerings. So again, going back to the EU, even within the EU where they have attempted some kind of harmonized framework, the member states are still waiting for each other to really align themselves on how that framework's been adopted, because they haven't sort of integrated it in the same way. The good news is that progress is happening. We've got the ECSPR framework. It's probably still, despite its problems with implementation, it's probably still the most advanced attempt at providing unification. And there are encouraging developments in Africa and in Asia with sandboxes, model laws, and some sort of cooperation between regional regulators as well. And technology will also play a key role. So we've got projects like DaxiChain, who I work for, who are looking at providing that infrastructure layer. Tests are already happening for that to actually happen right now. Initiatives from Gecko supporters. You asking me to wind up, yeah? Yeah, no, it's really exciting that conversations are happening. There is progress being made. Yeah.
Great, and I want to turn to Angela here for a minute. So Angela, you represent the Registered Investment Advisors, your company, and there's an association of the Investment Advisor Association, which says that of the wealth managed in the U.S., 150 trillion out of 270 trillion, that's about 55%, is managed by RIAs. But we're not seeing any of that money making its way to crowdfunding. So what's stopping it? What are the barriers? Are these custody, operational? I mean, give us some insight into why we're not seeing some, not even a trillion, just a little bit coming over.
Yeah, it's a huge opportunity. To give you some context, there's a little over 15,000 firms in the United States with over 1 million employees, a little over 1 million employees. And 200 of those firms control 2/3 of the assets. About 95% of assets are custodied at just 4 custodians. So this is an interesting opportunity. We have the choice as an industry to either go for the small firms, which 95% of firms control less than $1 billion in assets. We can go after the small firms that are working with boutique custodians who are willing to create the plumbing to make this possible, or we can go after the large firms with the large clients working at the large custodians. And I think the former is the smarter play, given the purpose of what we're talking about here, aggregated and investment across distributed networks. But that means that the groundwork has to be done to reach those advisors. There's a number of hurdles that we are facing in our industry to make that possible. The first and foremost is awareness. Most investment advisors have never heard of Reg CF. They think still that crowdfunding means Kickstarter. And that is an education issue in our industry. Once the advisors become aware of it and become educated, then the investors have to become aware and educated about it. So once we clear those 2 hurdles, awareness and education, then we're on to perceptions about risk. Now, there's a number of things that lead to risk perceptions that are plumbing related, they're infrastructure related. The first is lack of a secondary market. Now we have secondary markets that are starting to emerge, but it's nothing like the dozens of local stock exchanges that we had 50 plus years ago, 70 plus years ago. So we need a return of real systemic secondary markets. We need unified custodial systems like the ACAT system. Does anybody in the room know what the ACAT system is? Right. One person knows what the ACAT system is. That is 2. That is the way that firms transfer assets, custodians transfer assets from one place to another. And it's all seamless behind the scenes whenever you submit that transfer form to go from Fidelity to E-Trade. That doesn't exist really for private placements. And then the offerings themselves are not so standardized. They're bespoke, they're unique. There's safes. What is that really? There's structured notes and private alts, and there's a number of different ways that these things look besides a bond with a QSIP and a stock with a ticker that's traded on an exchange. But once we clear those risk for those things that are leading to risk perceptions, and now the custodians are willing to do it, and the advisors are willing to do it, and the investors are willing to do it, then we have the burden of due diligence. So as investment advisors, the 15,000 firms, the 1 million employees, we have the fiduciary responsibility to know what we are recommending to our clients. And the burden of due diligence for these offerings is high. not only does it require the advisors to be knowledgeable about how to do that due diligence, when most advisors don't know how to do due diligence on an exchange traded fund or a mutual fund or an individual stock, let alone a private placement. But the cost of that is quite high because we don't have DD providers in the marketplace, especially for funds. So we now have King's Crowd out there that's doing some DD. We've got other folks that are starting to come into the industry, but there's no real clear outsourced partners that the small firms can go to offload that cost the way that I can go to ETF.com and Morningstar and pull the analyst reports that I want for the publicly traded positions. And last is that because all of these offerings are beautiful, unique unicorns, they require a bespoke process. So each custodian, each firm has to figure out what is the process to get things listed. I can give you a real world example. We have been working on this for 13 years. It is not until we moved to a private trust company out of Philadelphia who was willing to play ball with us to create a bespoke process and it took 3 years of us working with them. It took them acquiring a fintech firm that had the back end systems that they needed. It took us 9 months to create a process for structured notes and private alts. And we now have 10 offerings on their platform that we can put into accounts. And that's what our clients want. 9 months to get 10 offerings, and none of them are individual companies raising capital. They're all funds. So this is the series of hurdles that we are facing in our industry. It's very real, very challenging.
I say kudos to you guys for going through the hard work to
Somebody had to do it.
Get it done. So I mean, so do you feel that this is just mainly education, as you mentioned, or is it the regulatory angle?
Yeah, I think that it really is education and awareness at the start, because the regulators and the custodians and the advisors are not going to take action if they don't understand what we're talking about or what this is. Now, yes, the SEC and FINRA technically knows what this is, but they don't necessarily understand the challenges in the trenches that every single person in this room is experiencing. So there's an educational mandate on that front as well. But yeah, I think it starts with marketing and awareness and education, but we have to be committed as professionals in this room to come right behind that with the structural solutions to make it simple for all the other firms that are going to come after us.
So want to open up questions for both of you. And this really is, we're seeing momentum behind crowdfunding. We're seeing a desire for harmonization, but one of the benefits of crowdfunding, one of the things that many of us love about crowdfunding, is it's also something that empowers companies and communities locally. The investment takes place locally. So where's the trade-off? Where's the tension? If you start thinking about going global, are we giving something up from, in terms of, and this, either one of you could sort of jump in on this, are we giving something up from the beauty of that local investment as we think about going global?
Yeah, so as we're thinking about harmonization, it is a really good question, actually. It's something we think a lot about within GECA, because obviously keeping the locality has, there's a lot of value to that. I think the key to it is that harmonization, it doesn't need to mean uniformity. We don't necessarily need one global rule book. We just need interoperability. So, frameworks that can recognize each other and talk to each other. And that's not something that's happening at the minute. And that's everything from sort of, each jurisdiction having different definitions for, disclosure standards, or there's many examples where the definitions differ from jurisdiction to jurisdiction. And what we're saying is that they should really be able to talk to each other and communicate with each other and work together. So local control is obviously really valuable. We've mentioned that it's allowed markets actually like the UK, Singapore, and certainly parts of Africa to run their sandboxes, which all work really well in their local areas. And those pilot programs really fit well within their own economic areas. And it's that flexibility actually that drives a lot of the creativity and innovation and actually investor protection as well. So I completely get the point that there is some kind of trade-off potentially. But I think the goal isn't to impose that single market. It's to align the fundamental definitions, transparency, KYC.
So, Angela, do you have a perspective on this question?
Yeah, I think that the challenge or the tension point here is that we need standardization in the industry in order to reach the advisors, which are controlling a large amount of assets. But through that standardization, we lose the ability to have these really bespoke, unicorn, unique offerings that are tailored in just a way that meet the needs of the issuers and the investors, their target investors, exactly the way that they need to meet their needs. And I think that may lead to some, even if we had all the solutions and all the plumbing and everything worked out, I think that could lead to many people opting out of that standardized system and still choosing to, do it groundwork style, not using a portal, so they choose Reg D, and opt out of Reg CF so that they can be more hand to hand on this and not, use that standardized system. So I don't know that it's really going to solve the problem in the end.
Okay, interesting. As we look at what the policymakers or industry leaders could do, where do you think they should focus their energy to sort of unlock scale? What could they be doing to unlock scale? Either one of you.
Yeah, so I guess, are we talking about sort of what the bottlenecks are here? And yeah, I think like the regulation that we've talked about, that is moving, albeit slowly. The real bottlenecks, I completely agree actually with you that the education piece is absolutely key, but also the infrastructure as well. The regulation, like I said, improving. The frameworks exist in the US, the UK. They just need to work together a little bit better. But what ties everything together is that infrastructure and information education. We still don't have shared digital systems for KYC. We don't have custody compliance shared systems. We don't have, functioning secondary markets that we've already spoken about. And there's still a huge education gap, both for investors and also for founders as well. Just about the notion of the fact that crowdfunding exists as a means to raise capital. So that information sharing and education is absolutely key. So I think policymakers should focus on facilitating the infrastructure layer, but I think we as an industry really need to focus on education. It's one of the key pillars that GECA has is to really focus on education, making sure everyone has the awareness and information they need to be able to participate in this.
Yeah, I'm going to point to something that is not a CfPA policy position, to be clear, and that is the accredited investor rule. A lot of what is imposed upon us as registered investment advisors stems from investor protection, rightfully so. And the basis for those opinions and that guidance from the SEC and FINRA goes back to the accredited investor rule and who is accredited and who is not, which is based upon assumptions about how sophisticated or knowledgeable investors are and how much risk they're able to take. And the very definition of risk, sophistication, and knowledge is being challenged in practice. We serve cross-class. We have no account minimums. So we have about 260 clients, and I've been an advisor for over 20 years. I have seen in practice that the vast majority of accredited investors are less knowledgeable than the clients who are non-accredited. That is a truth in the field that our regulators have not acknowledged. And I think there's an argument for changing how we define risk. There's an argument for changing how we define knowledge and sophistication. And so I think it goes back to that. There's many different ways we could solve this. I'm in favor of scrapping it all together. I don't think it's helpful.
And I would say you have, I'm sure you have lots of people in the room who agree with that perspective as well. I want to leave a little time for audience. So just in 30 seconds, if you could each say, what one fix would you, if you could sort of propose or suggest one fix, and I think maybe that's your one fix.
That's one fix. The other thing that is not on any of the panels in this conference, which is at every single industry event that I've been to in the last 24 months, is AI. No one's brought it up. And I think that that could be a huge game changer for many of the challenges that we have here. But we still have got regulatory awareness and education that AI doesn't necessarily solve.
My guess is it'll be a pretty prominent in the panel next year, in the discussions next year. So, Andrew, one fix quickly.
Yeah, okay. So it's to create a trusted, connected infrastructure layer that links crowdfunding ecosystems globally. And that includes AI, actually. And it's something that Dr. Jane are working on right at the moment.
Good. So, questions from the audience. We want to give people a chance to ask a couple questions about the plumbing. Yes, Maria.
Thank you so much. My name is Maria Springer. I'm the founder and CEO of Capital Department. Earlier, Chris Lustrino of King's Crowd talked about how we've deployed about over $5 billion through Reg CF offerings. And today you spoke about how crowdfunding is considered Kickstarter. So if we're going to unlock these trillions of dollars in private capital, do we need a rebrand? Because I'm not sure about crowdfunding.
That's a great question. I think for the marketing folks in the room, I'm curious to hear what they would say, Jason. But I think it does create a lot of confusion in the marketplace among investors. And I don't know how we backtrack on that after 13 years. But if, when we consider that, as I said at the opening reception last night, this is 100 years work. This is grandchildren's grandchildren work. 13 years is a drop in the bucket. And it may be wise that we completely rebrand what we're talking about.
Yeah, and I think we've, as an association, have tried to make some attempts at that, maybe not successfully, but it's definitely an issue. That we've
The only thing I'd add to that is I can completely get the point, but I think the education piece that we talked about, a lot more effort needs to go into the education, and that could potentially solve that issue without a full rebrand, if you like.
Okay. Other questions in the room from the audience? Yes. Go ahead, project, Marissa Ray.
About Reg D, the international, well, me being based in Africa, the community-based element of the crowdfunding, I think even globally is a community. If you look at the African diaspora, that's sending like over $100 billion as remittances, but then we cannot use that as investment. So even as CfPA, is there advocacy in terms of even having those communities to include in the regulation Reg CF or A to be able to invest? Why our VCs and PE firms can go to anywhere in the world and have the opportunity to invest into anything they want, but not the retail investors can have a diversified opportunities, and what our Geico and others could do, especially from education perspective, to include that so that there are many communities that we can build.
This is the last question. Succinctly, do you guys, either one of you, want to take that on?
I'll answer a question with a question. Why can we all go to the casino and lose all of our money and nobody asks a question about our financial positions? It's nonsensical. It's a nonsensical system.
Yeah, it's an example we always use too. It's absolutely right.
Okay, well, we have to wrap up. We are beyond time, so thank you very much. Give a warm welcome to our panelists, or a thank you to our panelists, and we'll turn over to Vince.
Just watch your step. You're good. Okay, it's wonderful to hear so much about education. I'm going to invite up the folks from Potomac Growth. They are a investment crowdfunding agency that really focuses on educating issuers. So come on up.
Okay, so I'm opening up my stopper so I don't go over 3 minutes. I'm Eitan, co-founder and CEO of Potomac Growth. We are a B2B D2C marketing agency that accidentally got into crowdfunding 3 years ago, fell in love with it, and today we're doing like 30 to 40 raises at a time. Dealmaker, Start Engine, Dalmore, WeFunder, and lots of smaller great platforms as well that focus on niche spaces. We do ads, we do content marketing, we have teams of SDRs that can actually do lead outreach, we have video production in-house. But instead of talking about digital marketing and paid ads with the 2 minutes I have, I want to first address Maria's question because I think it's a great one. Talking about rebranding, you know, even within the ecosystem, not everybody calls it equity crowdfunding. WeFunder calls it community rounds, for example. The term I like to use, and I'm just throwing this out there as food for thought and we can all discuss it later, is I actually like to look at this as retail investor opportunities, right? This is about the structure and class of the investors. And I think by using that term, I hope I can see wider adoption. So I just want to try to evangelize sort of that approach. And I'd love to hear what other people think about it. But I now have a minute left. And I want to just leave the beginning of a conversation that my co-founder Shelley will discuss more with Maria on a panel later this afternoon, which is what's the most important thing from a marketing perspective platforms can encourage their issuers to do. And it's not spend more on ads. Yes, advertising is important, especially if you want to go beyond the investor's existing ecosystem. But when we look back on our data in campaigns that we're running, and we try to correlate how much money was spent on ads versus how much money came into a raise, we discovered something really, really surprising. It's not driven by scale, so you can have a much higher return on ad spend on a much smaller raise, or vice versa. When we really look back at the behavior of a campaign, what matters most is creating consistent, recurring, authentic connections between the founders and prospective investors and existing investors. And so we, over the past 6 months, have started to really, really double down on page updates, on making sure founders are organizing webinars, answering investor questions, going after their community really, really strong in the beginning, and then going back to everyone at the end. And that is the single most important variable that I think can lead to more money. I'm out of time. For these issuers, which then leads to success for the platforms and for the ecosystem as a whole. Thank you all so much. Happy to talk during the breaks and looking forward to the rest of the day. CfPA, thanks for organizing this.
Thank you. Okay, we'll keep that thread going of innovation with Scott McIntyre, Matt Venturi, and Andrew Stevenson talking about crowdfunding and adjacent innovation. Thank you. And by the way, Scott is a 10-year chair of the board of CfPA, so he's been driving innovation and also with his We Economy nonprofit.
Thank you, Vince. Ooh, I'm going to pull up my notes because we have a lot to talk about, and I may talk fast, so if I am, just tell me to slow it down. So hello, everyone. My name is Scott McIntyre. I'm currently vice chair of the CfPA and the only standing member, founding member of the CfPA still here. Although one other of our sponsors, Brian Korn, is in the house from Manet, Phelps, and Phillips. He's also one of the legacy members of our board. So I just want to thank everyone for showing up for this old guy to talk about new stuff. So here we go. As much as it's been a profound pleasure to help democratize investment for the 90% of Americans who were previously, unable to invest in equities. As a side note, I'm also founder of weeconomy.us, which is another nonprofit, and we're focused on the 70% of Americans who are living paycheck to paycheck. They have no option to invest in crowdfunding, and that's a massive part of our country that I think we really need to focus on next. So that's part of why I'm here, is to also introduce that. So today, thank you again for all joining us. We've got Matt Venturi and we have Andrew Stevenson. Let me just start out by saying we've had a fair share of proposals queue up in the financial ecosystem in just the first few months of this new administration, most being framed simply as innovations. I use that quote on purpose. It's been a challenge to keep up with the pace of change, especially with a Congress that seems, well, unavailable. And so fortunately, the CfPA board and committees are stacked with some of the most passionate and productive people I've had the pleasure to work with over these last 13 years. And the priceless value of our nation derives from this all-volunteer organization, I hope is not lost on anyone here. So before we begin, I just want to thank all of you who support our mission, and thank you to our sponsors for helping make this event possible, and thank you to my fellow volunteers who've made this organization what it is today. So joining me on this important conversation are two people I deeply respect. Matt Venturi is returning again as a sponsor of this event and our organization, and is the CEO of Clearing Bid, redefining how new issue securities are broadly marketed, priced, and settled in real time, all while employing existing securities industry practices. And also joining us is Andrew Stevenson, a fellow CfPA board member and attorney at CrowdCheck Law, who ensures that compliance doesn't get lost in the rush toward innovation. So let's set the stage. We're hearing more about interoperability between private and public markets, secondary trading, ATS platforms, and blockchain-based registries. How realistic is a near future where Reg CF or Reg A securities can fluidly interact in this expanding marketplace? So let's start with what I think is a bellwether event, the recent EO, executive order directing the Department of Labor, Treasury, and the SEC to remove regulatory barriers limiting how fiduciaries invest retirement savings, including in private markets and alternative assets like crypto and real estate. Critics argue this overturns the Biden-era caution that urged extreme care with risky, illiquid assets, and is being framed more as expanding choice. But what are the real implications here? So, Matt, from your market perspective, how do you interpret this EO? Is it truly democratizing investment choice or just deregulation in disguise?
Well, thanks, Scott. It's great to be here with you all, and thanks for the opportunity. I'm here with my colleague, Cale Watson here, big, tall guy, former Navy SEAL, so don't fool with this guy. But he's my wingman. Anyway, I think, candidly, the change in administration and the sentiment toward capital markets reform is a positive move. We'll talk a little bit about what we're doing later, but I see a bit of a convergence that's taking place here between what the crowdfunding, Reg CF, Reg A, and full-blown S1, registration statement, IPO opportunities exist. And it's all about wealth building. I think you hit on it, Scott, that, there's this large segment of the populace out there that don't either understand, have the opportunity, haven't had the education to be able to engage in these markets and these opportunities. And that's where it's going to start. So that's number one, is I think the education and access. And the word democratization is a bit overplayed, but I think, the whole point there is as people become aware of these opportunities and as a result, the regulators begin to be a little bit more realistic about what it's going to take to be able to create that engagement. We've got Senator Chris Dodd on the team who's been helping us with the advocacy on the Hill, which has been great. He may not be as relevant right now with the new administration, but the fact is, we've got both sides of the aisle that want to see capital formation and investor protection. And the convergence of those two is really what we're looking at right now. And I think these different departments, it's kind of like Wall Street. Wall Street's silos, and every facet of Wall Street has its own constituent, and unfortunately, there's conflicts among all of them. And I think the same thing goes with the regulatory bodies, is that they have, different constituents they're trying to appeal to, but at the same time, there's a common goal. And we got to make sure that common goal resonates and that it is broadly recognized and realized. And that's, at the end of the day, going to create the wealth building opportunities and truly kind of get back to the American dream. So it's up to them to do it, but I think it's incumbent upon us to be out there and helping to educate them on it.
That's great. Thank you. Andrew, so does the Employee Retirement Income Security Act, the ERISA, still offer real protection here? Or are we shifting to a caveat emptor model under this administration?
Well, I think ERISA is a very complicated area of law, and it's something that plan sponsors, and really, first you have to understand who that applies. ERISA is, so it applies to sort of funds, plan sponsors who have sort of holding assets for retirement funds, for healthcare funds, and so they're all subject to specific rules. But the most challenging one, the one that they get the most sort of litigation and enforcement, is things about applying their fiduciary duties. Every plan sponsor in ERISA has a fiduciary duty to all the investors, all the members of that plan. And so that's where, and so as it stands, actually, ERISA plans could invest in private companies, could invest in Reg CF, but in their interpretation, in their understanding of the law and their fiduciary duties, because remember, these are funds that are they're not just taking money in to hold, they also have to pay out, and they're regularly paying out for retirement as people retire, as people use healthcare plans for expenses. And so in their understanding fiduciary duties, they need something that they can liquidate quickly if needed. They're going to, but a proper balance is going to have some long term, but they also need to be able to liquidate. So the focus then becomes public markets. And so what we're seeing then in the August 7th executive order, it's telling you democratizing access to alternative investments. That's kind of speaking our language. It's coming. It seems like it's coming right at us, but it's really about it. But just shows the kind of this brokenness in markets, that there's so much more going on in private. And I think the SEC, when they first did Regulation D, they saw it more as a punitive measure for companies. Hey, if you don't want to comply with the disclosure requirements, you're limited to who you can sell to. But over time, it's really become punitive on investors, that if you're not accredited, you don't have access to these opportunities. Yes, they're going to be riskier. You don't have all the disclosures, but that's where the money went, and so companies don't need to go public. So it's kind of so when those plans, but those in those ERISA plans, just they don't feel comfortable with putting money in. I think but if inside the CFPA, we're going to have to sort of pay attention to the rulemakings and how they come through, and sort of kind of be on the advocacy side of making sure that that we submit something, have some sort of voice in the process. Because if we can get some sort of statement in the rulemaking that identifies that here's how a plan could satisfy their fiduciary duties, or when the plan invests into something Reg CF potentially, or Reg A, that could open up possibilities. It would even just a fraction of a percent. It's a $14 trillion market, so a fraction of a percent could dramatically change what we're seeing in the crowdfunding space. So it's it's a matter. All comes down to fiduciary duty. So I think so it's not going to be caveat emptor, because these plans have deep pockets. They get sued a lot, and that's where the enforcement typically is. So they need to know that they can do what they're doing and still satisfy their fiduciary duties.
A great answer, actually. I think there's two themes that came from both of you, and it seemed to me that advocating for policy change, advocating for good rulemaking, these things are done behind the scenes, and that's something that we had a great experience at just yesterday on the Hill. And holding these politicians who love to claim that it's all about job creation and I'm representing my constituents, it's a lot of lip service sometimes when you get right down to it. So holding them to account is really a critical function of the CfPA. And I have to say, having been here since day one, we've never had a more accomplished, more forceful, more deliberate body of leadership than we have right now. And I am beyond honored to just be part of the team that has assembled recently. So I hope that that's evident from some of the contributions that you're hearing today. One quick question on that one, Matt, I don't know if you want to chime in, or Andrew. We've even seen a bill recently, cleverly titled bill, the Retirement Investment Choice Act. It's a clever name, but does it actually safeguard worker savings? Do you have any thoughts on that one, Andrew?
Which bill is that one?
It's the Retirement Investment Choice Act. It's pretty fresh, so I'm not.
Oh, is that the one? Yeah. Is that the one that just codifies the executive order?
Yeah.
Okay. Yeah. So same idea. So the executive order is saying, hey, Department of Labor, do this rulemaking, work with the SEC, get it done. I think that bill is really just saying, hey, now we're going to say, from the point of view of Congress, we're going to make it statute that Department of Labor, you have to do this. But again, a lot of the timing is sort of kind of been thrown off by the shutdown, and they haven't yet sort of posted any information about the rulemaking process. It will need to go through. Department of Labor has different ways that they handle sort of ERISA sort of guidance and interpretations and regulations, but it likely will have to come through a rule, which will be through the Administrative Procedures Act. So there will be a notice and comment period associated with that. But it's likely that they are talking to the players who have money in the space already, who have more interest that they know of. So we just have to kind of pay attention and try to get our voice heard when we can.
It takes people on the street, like who we have on the board, of course, and those who live in Washington, D.C., to see through these cleverly named acts to really find out if it's going to make a difference or not. Do you have something to add?
Yeah, real quick. So, usual customary way, Wall Street's ahead of it, but Larry Fink's letter to shareholders was the democratization of investing. And this whole, getting back to Andrew's point, qualified plans have been sacrosanct. You look at how pension funds are managed, it's all match funding liabilities with assets, et cetera. But you're going down to the private markets, and one thing I beg to differ is that there's not going to be a lot of liquidity. They profess there's going to be liquidity in this market. There's not. But they're saying, look, you get higher returns in exchange for it. You don't need to necessarily get your money out of it. But with all due respect, it's a bit of a money grab with additional fees, and they see it as a ripe market. $13.5 trillion that BlackRock's got to keep growing, and so this is the next frontier, and we better pay attention to it because we'll all be impacted in a positive or negative way. But I think it can be positive if, for example, from the grassroots efforts here, you look at the community sponsorship and what the theory and philosophy is here. This is a really, really important message to get across, and the regulators have to hear it. And I think you're doing a great job doing it.
And that's a perfect segue, actually, because while retirement assets now estimated, depending on who you ask, between $9 and $12 trillion, maybe the biggest pool of untapped capital we've seen in our lifetimes, right? And the innovations we're talking about, around tokens and digital assets are perhaps the most understood. So let's move into this space and mention that earlier this year, Republic announced plans to use Reg CF exemptions to issue so-called mirror tokens, essentially equity securities claiming to match performance of not yet public companies. It sounds good, and it's all good until you kind of get into the weeds of it. So the CfPA voiced a strong concern to this development, not to mirror tokens themselves, but to how they were being issued, and that was an issue. So I'm glad to see that the offering was paused, and yet they continue to collect indications of interest. So they are still going to move forward doing it, and we anticipate that that's going to be the case. So Andrew, for those less familiar, what exactly is a mirror token, and why does it raise red flags?
Well, so the mirror tokens are kind of speak to is also this sort of bifurcation and brokenness between sort of the private markets and sort of public offerings of securities, which can include Reg CF and Reg A. And so the mirror tokens are kind of a kludgy tool that sort of kind of packages an elegant solution to give investors access to private deals. The structure is actually it's an unsecured debt note issued by Republic X, so an affiliate of the Republic platform. That basically says that we're setting that sort of recent private markets and public reporting on the public reporting that exists from news outlets, countries, whatever, on these deals, values it at about this, which would put a share price at this level. So when an exit event occurs, if it's above that price, you get a return. If it's below that price, you will kind of proportionally take a hit. Yeah. But you still don't have. But for investors, you still don't have the relevant institution is that private company. That's what's going to determine if that investor is going to make a return or not. And that's where there isn't sufficient disclosure for investors that would be curious about purchasing a mirror token to really understand the risks and the investment opportunity, because all they get is what the mirror token is telling, is what they hear from the mirror token, plus whatever public reporting came out in the news about the underlying company. But it's not enough to really make an informed investment decision.
So do you think the SEC is going to step in and enforce existing regs?
I think it has. I mean, we've seen it already. Republic went out and said, hey, we want to do this under Reg CF. And right now we're just in testing the waters period, collecting interest. But they've seemed to abandon that. Now there's just Reg D that they're doing it for. So I think they've probably heard from somebody about it.
I give Republic credit for being innovative and, smarter than your average bear when it comes to product innovation. But, this is kind of a continuation of what we're seeing in Silicon Valley, because you know, you got the SpaceXs, you got the Databricks, you got the Stripes, and people want a piece of these, you know, high visible companies. And so what's happening is you have folks like Zimbardo, which is Joe Lonsdale's firm, his family office company, and they're setting up special purpose vehicles to then go out and make investments in these private companies, and they charge a fee for it. So they become a registered investment advisor in order to get those fees. Now, what you have no collateral, you have no governance, you have no controls. It's a wing and a prayer, because those issuers that want to keep the capital stack or a number of investors in their capital structure down, and so it's a special purpose vehicle, but they're not commissioned and they're not blessed by these companies. So there's a real kind of conflict and dynamic that takes place there, one. And number two, you really don't have anything at the end of the day. So I think this is just another way to say, hey, we want to monetize these types of, quote, you know, tokenize these securities, but you really have to look through to see what you have. And if there's no reps, there's no warranties, there's no governance, there's no assets, no collateral, you know, that's telling you something. So just wake up when it comes to this.
It's the impatience with the retail investor to want to get a piece of a private company that's not yet publicly listed, and yet these type of offerings look pretty attractive when you consider the upside. But what you don't consider is it's still a private company managing a private fund about a private company. So it's a lot of gray area there. So let's pivot to another adjacent innovation that's been gaining real traction, and one that's arguably more productive. So securities as a service. I'll be talking to you, Matt. So despite the early promise of funding platforms emerging for any and all verticals, we've actually seen crowdfunding portals struggle to reach profitability. And now nearly all investment limited to a handful of platforms. So even as technology promises to streamline issuance, let's hear from Matt on his securities as a service model. So Matt, ClearingBid is positioned at the intersection of traditional capital markets and digital innovation. Can you explain what a SaaS means in practice, and how it's changing the way issuers access investors?
Okay, well, thanks, Scott. We won't make it a long commercial, but SaaS is, we just recently got the trademark rights to securities as a service. No one ever had it, so I figured, hey, look, you know, we might as well patent something that, or trademark something that has relevance to where we're going. But we're right now, our revenue model is a transaction fee-based model, which we're going to migrate toward a SaaS, securities as a service model, once we gather more data on user preferences, behavioral patterns, and we can monetize that. Because you know, at the end of the day, that's what it's going to be all about. So what we developed is a platform that basically democratizes the IPO process by following the same pathways as a secondary market limit order. So through your broker has to do the KYC, suitability testing, make sure there's money in your account. You put your order in just like you do today with the symbol, stock price, limit price, and number of shares. And that order gets reflected in the master order book. Everybody sees in our public portal how that price and volume is building. It's full disclosure, full transparency. And each broker gets paid at the end of the day for every order that gets filled, because they're getting paid from the selling concession from the underwriting fee. But all brokers can participate, all investors can participate, and every single order that is in the money, in other words, it's at a bid price that's at or higher than where that IPO gets priced, is guaranteed to fill. And that fill rate is based upon the timestamp in your order. Earlier orders get a higher fill than later orders, but that's the way we're building this price discovery. So it's ubiquitous, it's seamless, it's just like the secondary market, and not only how orders get placed, but also how they get settled through DTCC in our case with a same-day cash settlement. We effectively mitigate underwriting risk. So what we're doing is we're saying, look, we want to take companies to the next level with the Form S1. We want to be able to go out to the market and broadly disseminate the information, and we want to have it totally inclusive. And through this price discovery tool that we have an algorithm and 13 patents on, we're going to open up to the masses. And it's not just retail, it's institutional, it's across the board. But we think, you know, in the spirit of capital formation and disclosure and transparency, that this will be kind of the next level from Reg CF to Reg A to the Form S1, and we could talk more about it.
You discussed a lot about investor protections kind of wrapped into your model and disclosure. Let me ask, you've also described ClearingBid as helping fix a broken IPO market. How does that intersect with Reg CF and Reg A, and could crowdfund issuers eventually graduate onto your system?
Yeah, so we have one that's now a buddy who's on one of the crowdfunding platforms, a second time round. He had a corporate sponsor as a lead investor originally as an investor, and now he's doing a follow-on, and he's doing it at another 50% uptick in value. And we're talking about taking them public next year. And, you know, what we're seeing is that, on one hand, you can tap an affinity marketplace for investors, but at some time you do get sort of tapped out because there's only so many affinity investors. So this gives a company like this the ability to take the next step and more broadly market. But I think I wouldn't underestimate that affinity investor benefit. I saw on Chris's slides here, Picasso, that was one good example. They reached the 75 million limit on Reg A. They were struggling there for a while, but they, been able to go to their customer base and be able to sell this fractional high-end home ownership model. But now to get to the next level, they got to take it out to the broader market. So that's that convergence here, Scott. I think that as companies do grow, I always say deals are sold, they're not bought. So having that distributed sales force to be able to market is important. And that's the one thing that's just a challenge with the crowdfunding Reg A, is that you really don't have there's no real selling tool. And when we did our Reg A, or when we did our crowdfunding, we were very lucky because we had some sponsorship, but that catalyst goes a long way. And that's one of the things I think is missing. If there's a way to kind of plug that hole, that would be a big difference for a lot of people.
Good point. Andrew, did you have any thoughts on how this self-service model will maintain investor protection in this environment?
Just anytime you have, so when you have price discovery, it means you're having, so there's transparency in information, there's an access to information, and that's what our securities laws are based on, that everybody has access to the same information. So in the IPO process, it's the monopoly of the prospectus. If for Reg CF, we have the monopoly of the offering page. We need all investors get to go to the offering page and get the same access to all the same information as every other investor. And so with that discovery process, it should just continue. It's just utilizing new tools to bring more transparency to an offering, which is ultimately always benefits investors.
Thank you. So, of course, all this activity only matters if it's framed within a coherent policy, and that's where Andrew's experience comes in. So let's talk about policy and market outlook. Andrew, I've always appreciated your ability to clarify pretty complex ground for us on the board. So between the new executive order, mirror token proposals, and fintech platforms rewriting the playbook, what's your read on how policy and practice are evolving?
So as Megan was discussing earlier, like there's a lot of interest on what can we do that sort of policymakers from the SEC, what can we do next? What can we do to facilitate this, but still in a way that is that sort of protects investors. Taking a look what has been working, what hasn't been working, what is sort of unnecessary that hasn't been a benefit, so when it gets to digital assets, I know in our experience, we've had a lot of challenges just in what is this thing? Is this equity? Is this debt? Where does it fit on the balance sheet? And I think we're going to start to get a little bit more clarity on that for issue. So in Reg CF, it's easy. We don't necessarily have to make that determination yet. It's usually when you get into Regulation A, where you're going through that SEC review, and you've got, as Marie mentioned earlier, like sometimes your particular examiner is gonna matter too. Does your examiner have particular bugaboo for what you're doing? And so we see deals get hung up there. But I think so I think we're going to get a little bit more clarity, a little bit more streamlining of those things as they just get more complex, more comfortable with it. Because there is some of you have kind of two levels of what we were doing for digital securities. Or is it just a token that's just a representation of a traditional security? That's easy. That's we do that a lot, and on the back end, that's really already being done. So transfer agents are moving to advancing their ledger technology, so that way, to ensure sort of clearing and settlement occurs more quickly and in a streamlined fashion. But what's being sold is still traditional security. It's just when you get into what's being sold is something different. The security itself is a digital asset. But I think we're going to start seeing it, but there are real benefits to that, especially for ones that are making payouts. So any debt instruments, things like that you can, it simplifies the process of sort of kind of putting interest payments, putting revenue share payments sort of into a digital wallet that then that investor has immediate access to. And I think that's an area that because of that investor benefit, that's probably something that we'll start seeing more of, and something that the SEC and regulators will start being more accepting of.
That's an interesting point too, and it reminds me to mention one of the things that I don't think our colleague Andy from GECA mentioned when he was on stage, and that is that most of the crowdfunding in Europe is debt-based, as we've seen, very different from the US. Their focus is really on that constant return, that revenue generation, that protection to a degree, because it's incremental, it's over time. You can move those investments perhaps more in a liquid fashion. So I'm curious, hold on, sorry. I'm curious if you see a coordinated agenda. One of the things that I found astonishing, because I assume that rules are rules and laws are laws. And when I hear that the SEC has discretion to simply publish a position or not, or to issue an issue against an issuer is a problem. And do you see an agenda emerging between the Department of Labor, Treasury, and the SEC, which are all now directed under this EO to ease the process? I mean, do you see any coordination coming down the pike?
Well, publicly we have not seen that yet, just because they've not gotten to that sort of full announcement of the rule proposal and its solicitation of comments. But again, there are requirements that they have to go through. If it's going to be a rule, it does have to go through the Administrative Procedures Act. So there has to be sort of public discussion, public coordination. I'm sure what we're seeing right now, and actually what we saw even with the SEC when they were doing rules for expanding Regulation A and for regulation crowdfunding, is they still talk to industry participants, people that they believe are knowledgeable, that can give them information on what further questions to ask of the industry. So we see a lot like a discussion proposal is often a starting point, where sort of industry, what do you think of this? And so there's probably has been some of that already. There's still behind the scenes, but that's not yet the rules. The rules don't come until there's actually been been public discussion, public comment process, public feedback, and then announcements of final rules.
Were you surprised to see the Department of Labor involved in this discussion?
Well, no, and the Department of Labor is the main regulator for ERISA, and so if you're going to get that ERISA money into private markets, that's where you have to go.
Interesting. So Matt, with $1 trillion sitting in retirement accounts, do you see a viable path for regulated crowdfunding to tap into that capital responsibly?
I do, because I think, as a prudent measure, you want to have diversification. I think, again, this grassroots community funding effect has a lot of merit, and I think everyone can kind of relate to it. It's a question of how the pathways are established to do that. So some modest amount that's earmarked from qualified plans that have certain benefits. I mean, they're talking about the tax deductions that could take place with an investment through Reg CF. I mean, these things are important, and any kind of a incentive along with just a practical way with which to provide access is going to be, I think, well received, and it's all relative. I think the comments made about sometimes the investors, the advisors aren't even as informed as the investors. I mean, at the end of the day, it comes down to sophistication, and within certain levels of materiality, you get concerns, but below those levels, I think the access should be much broader and more ubiquitous and fairly. Where people can make their own decisions.
Yeah, that's pretty good advice. I think, as an innovator and as a sponsor of the CfPA, do you have any advice on how CfPA can help ensure that innovation doesn't outpace investor protection?
Well, we've been on the Hill a little bit with some of these initiatives, like trying to increase the size of Reg A to 150 million versus 75 million. One of the big things that we encountered with our first IPO candidate was we were going to do a Reg A offering, but Wall Street underwriters don't want to do them. So we migrated to an S1, and S1 requires a PCAOB, Public Company Accounting Oversight Board audit, which is a much higher stringent and standard than GAAP. And we talked to a lot of accounting firms. 30 of them, and maybe 5 of them said we're still doing PC AOB audits, but the other 25 said we're not going to do them because the SPACs, we got our head handed to us, we had got liability exposure. So you couldn't get the accountant to do it, couldn't get Wall Street to do it on the other end. And the regulators are sitting there, twiddling their thumbs thinking that there's no problem here. Well, there's a big problem because it's all about, registration, cost, reporting requirements, and really how burdensome it is. So they got to stop and be reflective about the self-imposed restrictions that are really inhibiting the ability to truly enhance capital formation, which is one of the 3 underlying tenets of the SEC. It's investor protection, it's capital formation, and it's fair, orderly, and efficient markets. And I think what we're doing here is he's got to just keep those ideas in mind, and we're going to have the right goals ahead to strive for.
Cool. Well, I wanted to leave some time for comments, and I see we're down to about 2 minutes. So instead of talking about, or at least imagining what the next election cycle might feature in campaign promises in this space, I'm just going to open it up to Q&A. So any questions from the audience for these fine gentlemen? We've covered it all. That's good. In which case, I will say thank you, Matt and Andrew, for your insight, and thanks to everyone here for your engagement. On behalf of the CfPA, we invite you. Thank you.
Thank you.
And we hope to see you all at the CfPA and on our various media channels continuing this engagement. So thank you all.
Thanks. Thank you. Yeah, you're moderator. Okay, moving right along. Interesting time to be talking about capital formation. Let's take a look at what that means on the college campus. That's this platform. This panel will be moderated by Jenny Kassan, and we have Stephanie Geller and Dr. Jason Cherubini. Hope I got that right.
Thank you. Hey everyone, it's a super short panel. We'd love for you to hear it. So this is going to be a big contrast from the previous panel. As you know, investment crowdfunding is a big tent. We want to be able to be a home for all kinds of businesses. And so what we really want to focus on for this panel is the smaller businesses that probably will never go public, may never do a Reg A, but they need to raise 100,000, 200,000 to grow and be healthy. And a lot of these businesses, even though, there's been a lot of talk about exits, you really don't always need an exit for investors to make money. As was referred to in the previous panel, many of the folks who are offering investment opportunities under regulation crowdfunding are offering revenue-based payments, debt. So this is a great fit for a huge number of businesses in our country, and they can actually pay really good returns. We actually have one issuer right now who's paying like a 14% interest rate on her offering. So I also want to mention, hey guys, can we keep it quiet? Thank you so much. We also want to mention that the 3 of us all are living in Baltimore, so we're representing Baltimore right now. Does anyone here have ties to Baltimore? Woohoo, great city. All right, so I want to start with Stephanie Geller, who is an amazing leader in the world of investment crowdfunding and making it accessible for so many people. I would love to ask you, Stephanie, I don't want to be too negative, but I want to start out by asking you, what do you see that are the challenges for these super small businesses that need to raise money using investment crowdfunding or would like to?
Thanks, Jenny. So I'm going to begin just by sharing a little bit about why investment crowdfunding could be so important for these small businesses in Baltimore, because these are businesses that can't access Main Street capital. So this is really the only way, particularly in Baltimore, for small, local, and Black-owned businesses to get the capital they need to start, or for existing businesses to get the capital they need to grow. But on top of that, right, like this model could make so much more sense for them than a traditional loan, even if they could get that, because they could set the terms. And also, this enables them to really create bonds with their customers and community. And when we think about what could make Baltimore a more sustainable, stronger, more vibrant city, it's really connecting the residents with these businesses. And investment crowdfunding could be such an ideal tool. The real challenge are the existing platforms. And even though many say they are there for mom and pop businesses and Main Street businesses, they are not set up in a way to ensure small businesses can succeed. They have fees, processing fees or onboarding fees or different types of fees that set up an immediate barrier. And they also, like, one possible beauty of investment crowdfunding could be that businesses could set their own terms. But again, a lot of the platforms that are geared to these types of businesses, like Honeycomb, for example, will actually act like a mainstream traditional provider and say, you can be on our platform if you offer 13% interest, 15% interest. And Jenny, the business that you mentioned that is now raising on Honeycomb, who's offering 14.5% interest, that's not her top choice. That's not necessarily going to set her up for success. But for her to be on the Honeycomb platform, she has no ability to do that. Another small thing that really bothers me too about these platforms that makes it hard for small businesses is that they sometimes charge investors fees. So Honeycomb also charges investors fees. And for these small businesses that are trying to excite possibly low or moderate income people to invest in them, these fees also make it more challenging. So I feel like there's so much possibility in investment crowdfunding and so much room in the market for small local businesses to get capital, partially because there are no other choices, but also because it really could be so valuable for them. But the way most platforms are set up, it just makes it really, really hard.
Yes, and as someone who helped to co-found a crowdfunding portal, I really empathize with why it is that so many portals can't really do a lot for these smaller raises. It's very hard to have a successful business model for these smaller raises. So that is where a university could potentially come in. So Jason, tell us about Loyola and what it does with entrepreneurs and your students and how they want to get involved in entrepreneurship and why Loyola could be a good home for a crowdfunding platform.
Yeah, so Jason Cherubini, Executive in Residence of Finance at Loyola University, Maryland, Selinger School of Business. We also have the Simon Center for Entrepreneurship there that works with local entrepreneurs, small businesses, trying to give them more of the business tools that they otherwise wouldn't have access to or they would be priced out of. One of the things we see with a lot of these small businesses through our student consulting groups, our Baltrepreneurs event, is that the community rallies behind them. A lot of people want to support the local businesses. They'll show up when they have events. They'll spend their money there. They would love in a lot of situations to have a piece of that as well. They just don't have a means to do that. That's where crowdfunding comes in. And as you said, Jenny, some of the idea of the platforms, they are a business. They are to make money. They need the fees in order to operate, to make it lucrative for their own options. But that then prices out a lot of these small businesses who are looking for raises that are nowhere near enough to make it juicy for the platforms. If you're looking at a small restaurant, a small dry cleaner, something in the community that needs $100,000, $150,000, the fees for the platform are not going to make it worthwhile. I mean, you're going to spend as much in fees, setting up your financials, putting things on the platform, your platform fees, as you would raise. So the transaction, the friction costs alone push them out. But if we were to remove the profit incentive of the platform, really have it a community or nonprofit incentive, the mechanics would be there for a community to rally behind those businesses they always frequent. Most of my research into investor motivation and crowdfunding showed that your non-professional financial investors, your non-accredited investors, the financial motivation of investment is not their number one motivation. They want to feel connected. They want to be involved. They want to support the people they know. So those are the people who will show up to the local restaurant they go to all the time. They'll invest in the local hall where their friend got proposed to. They want to put the money behind it because it's part of their community. Now, that doesn't mean that the financial motivation isn't there. These people aren't throwing money down the drain, but that's not going to be their primary motivation. So that connectivity, that major force behind why so many people choose to invest in one crowdfunding project over another, really should be a major benefit for these small businesses. They just don't have the mechanism to do it because of the transaction costs, because of the friction, which is a necessary part of these platforms needing to be profitable.
Absolutely. So, Stephanie, as someone who has been working on growing the community, and someone talked about rebranding crowdfunding, and I like to use the term community investing. So as someone who has been working to grow the community investing ecosystem in Baltimore for quite some time, what would you say are some successes, and also what is still missing, and how might Loyola University of Maryland, if it is able to launch a local platform or even a nationwide platform with a presence in Baltimore, like what could that look like, or what should that look like?
I mean, to me, Loyola could be an ideal partner, because one thing that we've been working on the ground to do that Loyola could really amplify is the education. And I think we heard a lot this morning, you know, the lack of education is a barrier across the board. I mean, in Baltimore, one big hurdle is just business owners don't know they can get capital from customers and community, and introducing them to this model is really like the ground level, the entry point. And then on the other side, right, like so many people in Baltimore love the city, and they know, you know, I should go to a local farmer's market and I should shop local. They don't know that they can invest in local businesses. So that's something that we've been working on for the past many years to solve. We have a platform called the Maryland Neighborhood Exchange, and we do education to businesses, education to residents, and then we have this website where when people get excited for local investment, they can find the businesses that they can invest in. But it is such a small scale. We are a scrappy nonprofit. So it would be really exciting for an entity like Loyola to get involved, because they really can amplify all of this. And also just the students, right? Like the next generation of leaders, and to have this really tie to an entity that is teaching and educating, I think will help expand knowledge of this field, right? Like, so people that are learning can take this into their next phase. And then just on the other side too, like when we work with businesses, they do need a lot of help. A lot of businesses need help looking at expected revenue so they can figure out what type of deal could make sense. They need help on the communication side. So there's really a huge way to involve students that have a lot of diverse interests in this too.
Jason, I know even though you are Baltimore based, you probably would like to see something like this happen all over the country. Do you see, if we could build this in Baltimore with Loyola University, do you see a way that this could potentially scale to communities across the country?
Well, I think with proven success and then best practices, when something works, everyone's going to copy it. And I think for where that benefit is, there's benefits to the local businesses, the community, which is phenomenal. It opens up capital for them to grow where they don't have access to institutional or Wall Street. It's going to benefit the students, one, with the experience on that side. But I think it also benefits the entire crowdfunding system, because you'll be training people to understand this as its own asset class, as its own investment. So as we're pushing students out, they won't have just been exposed to the CFA curriculum or the CPA curriculum, but this will be seen in the same way. Move it from a fringe type investment. It's not a weird crypto thing, or it's not a scam. It's a viable alternative in small scale investment. So for a lot of these students who may have dreams of, I want to go investment banking and then into private equity, this is a whole nother asset class as they go out there, that they'll be trained, they'll be known, and that could open up funds in a whole other way. And I think if it works in one area, one school like a Loyola, there's 26 other Jesuit schools with their major mission of community development that would see this not as a financial reason or an educational thing, although that would be a component. It really would be a community development thing, because most Jesuit schools and a lot of universities in general really see themselves as a hub of a community in the locations they exist at. So Loyola in Baltimore, American University here in DC, my alma mater, Tulane in New Orleans. These are all institutions that believe in growing their community, because the stronger community makes for a stronger institution.
So when I ended up creating a project in Baltimore, buying a building in Baltimore that will be a home to support this movement. And somewhat coincidentally, I found out that Baltimore, as far as I know, is the only city where there is a nonprofit called Community Wealth Builders, run by Stephanie Geller, that has been working so hard to grow the local ecosystem and to educate local residents about the fact that they can invest locally, how to do it, maybe how to make it fun. So Stephanie, can you share how you have grown that? Like, as far as I think you have at least 4,000 people in Baltimore, if not more, who have committed to investing locally and to learning how to do that. So share more about what you've built so far.
I'll say, so we've had successes with 92 businesses that have been on our platform. They have together gotten about 6.6 million from, I think, 13,000 small investors. So it's, it numerically sounds somewhat large, but it's such a tiny fraction, right, of the businesses in Baltimore, and such a tiny fraction of the number of people there. Most of the businesses we're working with are looking to get 50,000, 100,000. They're really small businesses. And I feel like we've really scratched the surface. I feel like when we began this, it was a little easier. Mainvest existed, and their platform was clearly not a model that for-profit should emulate, because they folded, but they had no fees for investors, no fees for businesses to get on, and it was a lot easier. I feel like it's harder now. In the beginning, each year we worked with dozens of businesses, and now the businesses that actually can have success on the platforms are a lot smaller. For me, it's really a community development tool, though. I think we often talk about crowdfunding like in relationship to specific businesses. And one thing we're trying to do in Baltimore is to create a community of practice around this as a way to create a more equitable, inclusive, sustainable city, right? You give community members a small stake in business's success. They're going to shop there more. They're going to promote it more. And when we talk about, just what could help a city improve on its own, right, without relying on the government, like really through the love of the people there, this model holds so much promise. I just feel like the platform piece is something that is driving me crazy.
Yeah, so regulation crowdfunding, I have to admit, when the law first passed, as it was going through the process, I advocated to not require capital raisers to have to go through a portal. I loved the idea of everyone being able to just go out directly to their community without having to go through a portal. I think there are pros and cons about requiring a portal, but it is unfortunate that we are seeing a lot of consolidation in the industry. A lot of the smaller portals that were a little friendlier to small businesses have folded or been acquired. So we really need to find ways to serve everybody. And there is so much room for philanthropy, local government that wants to support community development to get involved to allow this to happen without putting these portals in a difficult situation where they need to make enough money to survive. So we are very much looking for supporters to help us launch this this pilot that could hopefully be replicated throughout the country. So Jason, like, what would it take for Loyola to actually be able to launch this, and how can folks in the room help?
Well, that's really the structuring of the platform and all the regulation side of it to be able to push it forward. And I think the benefit, wherever it happens, is it's an entry point for a lot of people for this as a new investment class, because it's a lot easier for me to convince someone to invest in something they already believe in. I don't know if anyone visits Baltimore at all, but to convince someone to invest in De Pascal's would take nothing. It's the single best Italian sub in the world. If you have an hour, go up there and get it. It's worth it, but it wouldn't take much. And for someone to put up $100 or $200 to invest in somewhere they go for lunch anyways, that's an easy conviction for them to get their toe in. For them to commit $1,000, $10,000 of their true investment into a business halfway across the country, to read through the financials, to develop that level of trust, that's a much heavier carry. So I think that starting point is going to be the big benefit to the industry as a whole. And I think a partnership with an existing platform would be the benefit there, because again, it's trust. And trusting with the institution name is beneficial. Trusting with a known platform is beneficial for all of the fiduciary responsibility that would need to be there.
Right. So Loyola could go ahead and start a whole new platform, but that is so challenging. Or maybe there is an existing platform, a broker-dealer, a portal that would like to white label host this platform and get a lot of amazing recognition in exchange for doing that. So if you have any interest in participating in any way, whether through philanthropy, through a partnership, we would absolutely love to talk to you. So any last words, Stephanie, about this, what could happen here and how meaningful it would be?
I would love to hear everyone's ideas too. I feel like this is such a huge gap, and these businesses are the blood of our country, and no matter what community you live in, ensuring local small businesses really have access to capital so they can grow, so they can survive, to me makes a lot of sense. And then, but on the community side too, right? If you live somewhere, don't you want to be the person who can invest in your local pizza restaurant's growth, or the businesses in your community's growth, so everyone sort of can rise together? So like, the logic model to me is there. We just need the infrastructure to make it happen. And I feel like, if the people in this room can't help us figure out how to do it, we're going to be in trouble.
Yeah, I would just add to it, I think it's a benefit both ways. One, it's going to benefit the industry by bringing more people into crowdfunding and seeing it as a valid investment source with that very little hurdle of trust. On the flip side, it's going to benefit the businesses. It's going to open up capital that they otherwise wouldn't have access to. Again, raising from Main Street is going to be the only option for a lot of these businesses, where they're not going to be able to get into Wall Street. And no matter how much money you have or where you want to invest, you're utilizing small businesses. They are still taking a portion of your spending. There's money to be made there for investors.
Thank you so much. We have some handouts with a little bit more information. If anyone wants to get involved or maybe try to make this happen in your own community, we would love to talk to you. And I think it's time for lunch. Do we need any announcements before lunch? No, I think we're good.
Let's see. Back at 1 on the dot.
Well, welcome everyone to this month's CfPA webinar. We have an amazing discussion here with Paul planned for today.
Yeah, Brian, before we get started, though, I just want to acknowledge how appreciative I am of you stepping up, going to Washington, and talking about nuance. This is so awesome. That never happens. It's either black or white, never nuance. And here you are saying there's a big difference between small businesses and startup companies. Yeah, it's crazy that, people don't really understand what's going on. So when I read what you went up and said, I was like, yes, it was so cool. I'm just thrilled that you're out there representing us. And, another thing I noticed is that the people who are making up these rules and the regulations, they're not really involved in what we're doing here. And it's kind of weird that the people who are making rules of the game aren't even playing it. They're not even watching. So again, to have someone like you come up and talk to them, I think that's so important, and I'm really grateful to the CfPA for even getting all this together, because I know it's not just your words, but it's the CfPA's too, and it was awesome. Loved it.
Well, thank you, Paul. That means a lot coming from you. And for anyone who's interested in learning more, that was we were able to take part in one of the SEC's small business forums that they held last month in Washington, D.C. So I went down there on behalf of the CfPA and met up with a few of the other CfPA members to actually sit on one of the panels where the SEC and the commissioners and everyone that was there was asking for feedback. What is working with investment crowdfunding today? What is not? What are the areas for improvement around capital formation, investing? So great discussion. But let's get into it, because I think the discussion today is another one that a lot of people, myself selfishly, very much interested in. And Paul Lovejoy is joining us today. I'm going to be giving a brief intro to him in a second, and the amazing thing that he did of making one crowd investment basically every single day for an entire year. But for anyone who isn't familiar with the CfPA, I want to give just a brief overview of the CfPA. This will take just a minute. I think that, as Paul was mentioning, we really are focusing on helping to advocate, educate, and advance the industry, both from the perspective of investors, democratizing more investment opportunities, giving access to new investment opportunities that have traditionally been off access to investors, off limits, and also helping on the capital formation side, right? We want those small businesses, those entrepreneurs, whether they are a mom and pop Main Street business, all the way up to, a new high growth startup. We want to be able to help them find the funding and the capital that they need. So the CfPA, we were established after the Jobs Act, but we really champion all of these different stakeholders, whether you're investors, founders, even the industry professionals. So we have lots of marketing experts, we have attorneys, we have lots of other people that take part in the CfPA. Now, one of the things we have coming up for our premier event of the year is on October 21st and 22nd. We will be descending upon Washington, D.C. in person, IRL, and this is the annual Regulated Investment Crowdfunding Summit. So last year we did this. We had SEC Commissioner Peirce, who actually attended. We had FINRA. We had a bunch of the funding platforms, as well as just a whole bunch of wealth of knowledge of kind of the who's who of the industry. So head over to cfpasummit.org. Make sure you pencil off that date if you are able to make it. The 21st is actually a day we go and we meet with regulators on the Hill, and we meet with the SEC, with different congressional offices. It's a really great and productive day. And then the 22nd is that day when we get into the actual event. So make sure you check that out. And just as a plug for anyone who isn't already, hopefully you are, but if you're watching us today and you aren't a member, $10 a month should be a no-brainer, I think, for most people on this call in terms of the value that you get out of that. Head over to cfpa.org, click the join button, and sign up today. You'll get discounted ticket to that summit for this fall, which basically will help pay for the membership over the course of the year, as well as a whole bunch of other benefits, access to the committees that we're on, and everything else. All right, I'm going to stop there, and I want to introduce our amazing guest, Paul Lovejoy. Paul, just super thrilled you could join us and grateful again that you're able to take the time today. Now, Paul is not your typical financial advisor, I think is the way that you would put it. So let me just pull up something real quick. All right, so Paul is not your typical financial advisor. He's a whistleblower, a system survivor, and a man on a mission to help compassionate people take back financial power on their own terms. To do so in 2022, Paul opened the nation's first registered investment advisory specializing in crowd investing financial planning. Basically, this is 100% free from Wall Street and the stock market. So today, we are going to be talking about something that Paul did and just completed recently, which is he made one crowd investing investment every single day for an entire year, which is amazing. Paul, I want to hand things over to you real quick to be able to just talk a little bit about what you did, and then we're going to jump into a discussion and really go deep on what you did for the year. So thank you for joining us.
Yeah, I'm thrilled to be here, Brian. And yeah, I'm going to go ahead and share my screen here, jump right into it. Okay.
Good to go.
All right, let's just go. Let's get it going here. I invested in 62 different small business loans, 432 short-term small real estate developer loans, 63 consumer debt consolidation loans, 12 regenerative agriculture loans, and 9 green infrastructure loans. I gained a portfolio of 10 single-family rental properties and 1 vacation rental, the buyer's house from Stranger Things. I made, I invested in 13 different clean energy businesses, made 29 CDFI investments, and invested in 24 different startup companies. I invested in AI and digital infrastructure, cancer research and unbiased media, vegan restaurants and cattle ranchers, and now have indirect ownership in large private companies such as OpenAI, Canva, and Databricks. I also invested in a worker-owned cooperative, 2 nonprofits, and 9 times I invested in a renters equity REITs where renters build equity alongside investors. Now, Brian, the incredible thing is that all of this was only $11,552. You know, that works out to just under $32 a day. And what's really incredible is, to me, the verdict's in. Crowd investing is far more safer, diversified, and can produce high returns than our public stock and bond markets, which are dominated by large concentrations of wealth, profit maximizing corporations, a magnificent 7, and a handful of institutional investors that whenever they buy or sell a position, it has a seismic effect on the entire market, which is becoming ever more volatile. And what's really crazy from my perspective is that crowd investing has organically adopted investor protection with way less regulation than our public markets. The internet has given us unparalleled distribution channels, which present the opportunity for market-based investor protection, such as low minimum investment requirements, crowdsourced due diligence, platforms performing underwriting and collateralizing loans, as well as allowing the investors to vote on modifying loan terms in an effort to work with businesses while keeping our investments intact. You know, to me, this isn't an alternative asset class. This isn't a side dish. Investors in public markets are starving, eating the scraps, while crowd investing is a full 3-course meal.
Wow, I could not have said that any better. That is a fantastic intro. And I think it's very true what you see. We look at the data a lot as well. And, you know, the number of IPOs, right, has kind of been declining over time. And the opportunities for retail, for the average investor to be able to get in, especially on the ground floor, some of those opportunities, companies are staying private longer. And you got to kind of look at the alternatives of where do you get some of that diversification from those public markets. So I think that is fascinating. If you don't mind, Paul, I think you have a pretty fascinating story just in terms of how you got to where you're at today. And it would really help people to understand the mindset of where you're coming from before we embark on, you know, what some of those lessons were. But would you mind giving us just a little bit of a brief background about what got you into this and like, how'd you hear about crowd investing?
Well, sure. So I am a former real estate investor, and I saw some pretty good success prior to 2008. But that's when everything changed. I was a defrauded investor and was financially devastated. The worst part was it wasn't just my money. I lost my family's savings as well. I mean, it was absolutely devastating. I had to fight through, shame and despair for years, sleepless nights. It was horrible to kind of think about, wow, I was responsible and I held myself responsible, and it didn't feel good. But there came a moment where I had two choices. I knew I did. I could stay broke, angry, and powerless, or I could do something. I could figure out how the system actually works so I'd never be in this position again. So I joined a wealth strategy firm, the type that allows clients with enough money to join, and those who didn't, we told them, sorry, you can't work with us. And so I hated that, honestly. I hated that, but I did learn a ton at this place. And one thing that I learned was about private market and all the opportunities that existed for the wealthy elite. And then this was all around 2016. So while I'm working at these things, I hear about regulation crowdfunding. What's this? And so it tuned me in and saying, oh man, this is exactly what I was looking for. Because in 2008, we had a too big to fail crisis. And with crowd investing, we could become our financial system by loaning people money and not consumers of it. So it's a fascinating approach. And so because of that, I started Stakeholder Enterprise in 2022. I wanted to teach people, hey, you don't have to be a part of this rigged financial system that just benefits the few while the rest of us struggle. That's my story. And part of it now is doing this 366 days of crowd investing to really demonstrate that.
Yeah, let's get into that. And I think it's funny, you talk to so many different people who are in this industry, and a lot of them had different reasons for joining, but everyone is so passionate and so mission driven. And I just feel that energy from you. So let's get into it. One investment every single day for an entire year. What drove you to think of that and to carry through with that?
Well, ultimately, this was about a diagnostic test. I wanted to kick the tires, so to speak, of the entire industry. What is it like as a customer to go in and invest on all these platforms? I wanted to have that experience. I wanted to know how regular people would feel going in and investing. Was it complicated? Was it crazy? Was it easy to understand? Was there good investor dashboards? Were things easy to do? All of that. I wanted to know all of that. And really just on a very fundamental level too. But something happened, Brian, while I was doing this. I realized something, that this wasn't just about investing. And it wasn't just about democratizing capital formation. This was about funding the future you actually wanted to live in. This is how we turn our money into real change. And the best part, you don't need a fortune to start. It's like we were led to believe that this type of investing's reserved only for the already wealthy and their exploitative ventures. I invested $10 in a clean energy project. The truth is, it's not about how much money you have to start with. It's about knowing where to put it. And that is the essence of why I did this journey of 366 investments. I wanted to know, can we redirect our capital into the projects and businesses that are actually creating the world that we want to live in? And to me, the answer is a resounding yes. And I want to share a quick example of this.
Please.
So, Brian, have you ever heard of PFAS chemicals, of forever chemicals? Have you heard of these?
I have, indeed. They're in your water.
Yeah, so
right?
when I first read about these chemicals years back, I was like, oh my gosh, look what humanity's doing. I'm like, not again. Something awful, horrible is happening. And you're feeling bad about yourself. Now, I want to live in a world where there are no PFAS chemicals. So last April, I invested in a company called Invicta Water, and they didn't have any revenue. It was pre-revenue. All they had was a plan. and they had a patent pending. And at that point, when you're investing in a company that doesn't have any revenue, you kind of have to more look at the people that are involved in this. And, you look at, I looked at them, and they all had experience in their industry. So at some point, I'm thinking, okay, yeah, I want to live in a world without forever chemicals. Can they do it? Maybe. They seem like they have a good plan. They have experience in the industry. Get this, Brian. In October, they did a pilot project in North Carolina in the Haw River. And you know what happened? Third party, independently verified, the forever chemicals are gone. And this is just remarkable. So what happened after that, 3 states now are using Invicta water to clean their municipal water supply of these forever chemicals. They were featured in the Nature Journal, and now 8 other states are contacting them to remove their PFAS chemicals. And this is insane because forever chemicals are gone forever. And because I invested in that company, I'm linked with them forever. And it's just a remarkable thing. So that is the impact side. Now, the investing side, the deal terms were fantastic. It was a priced round, $1 per share, $100. That's all I invested. So I got 100 shares at a $5 million valuation. This is the only round that they've ever done. They didn't even raise $1 million. This is a small raise, and that's it. And, the potential for a return on this investment is huge.
That's amazing. And I love that story because it shows you that you can potentially, and obviously the verdict is still out. We don't know if it's going to be a successful investment or not, but being able to have positive impact while generating returns. Along those lines, when you're looking at some of these opportunities, like how do you determine where you are on that spectrum? Do you look at it as, oh, this is more of a impact investment, this is more of a financial return, or do you try to find a balance between the two? How do you think about investment opportunities along those lines?
So it always comes down to, what is this investment going to do to the future? Is it going to create a future that I want to live in? So I want to think about that through. Okay, me funding this company, what's the long-term effect of that? And if it doesn't create a future that I want to live in, I'm over it. I don't care what the financial return is. That for me, I want to retire in a world that I want to live in, not just retire. So it's a big difference. So that's how I see, that's how I looked at my criteria, and then if it is something that I want to invest in, then I start looking at the financials.
Got it. Let's get into some of those nitty-gritty details of the logistics. I'm assuming when you started this, you maybe kind of set some rules for yourself in terms of typical investment amounts or sectors or different things. Walk us through a little bit what that looked like of kind of setting up your plan, and then did you adjust or change that plan throughout your time over the course of the year?
Yeah, I wanted to keep things very simple. So it was all had to do with asset allocation, classic financial planning. And my target was 50% income, 30% equity, and 20% mixed equity with income. And I also have revenue share in a different category as well, just because it could do equity-like returns, but it's not equity. So I don't know. I just see. Anyways, the end result was that it was 45% into income, 3% revenue share, 31% equity, and 20.5%. So it almost nailed it on the head. And honestly, it wasn't like I had to really plan it through other than because I wasn't just doing asset allocation. I was taking all the classic financial planning strategies like dollar cost averaging, bond ladder strategies, diversification, all of that. And I just brought it into the private market. I didn't reinvent the wheel here. I'm just doing standard financial planning stuff in the private market. And it makes my head explode at how much, way better it is. The returns, private credit has been outperforming our stock market since the 2008 financial crisis, and we barely have any access to that as retail investors. And so that's something I would like to see more of, but there is still a ton. As you can see, I already did half of it with my initial portfolio.
Wow. Now, I think a lot of investors maybe watching this might think to themselves or be investing at a rate of, say, 1 to 2 investments per month and think of that as a lot. But they think of something one per day. Like, how do you find those? How do you diligence those? Can you maybe just walk us through the process? Like, how did you find the deals, from everything out there? And how did you find the time to like make an investment decision in every single one of those every single day?
So when I first started, I didn't really know the plan other than I have an asset allocation strategy. And so what I was doing at first was like, okay, let me go on this platform and I'll invest on something here today. And I did that for maybe a week and I was like, this isn't going to work. And so what I ended up doing was, well, before I did it, I also took a list of all the platforms that I could find that allowed retail investors to invest on a platform through a crowdfunding model. And I got a list about 30 different platforms. And I said, okay, well, which ones do I think I'll be investing on the most? And these were the credit ones, the ones that offered private credit, like Ground Floor, SMBX. Those are two that come to mind, mainly because they have $10 minimum investment requirements. So I knew that some of these platforms that allow these low minimum investment requirements were something I'm going to be doing a lot. So what ended up happening is that on Mondays, I invested in Fundrise. On Tuesdays, it was kind of like it could be a real estate investment like on Arrived, investing in a single family rental property. It could be investing in a regenerative agriculture loan. It could be investing in an equity startup, something along that. That was on Tuesdays. On Wednesdays, I was on Prosper, which is our consumer credit market, which we don't really talk about we talk about capital markets. We don't really talk about consumer credit markets. And I think that's important because it's a huge opportunity for this industry to expand into these consumer credit markets. All that there is right now is Prosper. There was the Lending Club, but they went traditional route. And I'm gonna touch into this. They did it before the Jobs Act in 2005 through Regulation C, Rule 415. And the problem with that was they had to go state to state in order to get approved for investors. And here's the problem, huge problem I see. They're only approved in 28 states plus the DC, District of Columbia, to invest in. But here's the crazy part. If you wanted to borrow on Prosper, available in all 50 states. And it's like, we're sophisticated enough to borrow money, but somehow unsophisticated enough to lend it. It seems like that is a shame. So anyways, that was on Wednesday, was my consumer credit day, debt consolidations loans. That's all I did. And then on Thursdays were small business loans through the SMBX. On Friday, it was Ground Floor, which are small real estate development loans, it doesn't really get talked about the impact that these small business loans really have. I actually did due diligence on every single loan. It's crazy. I looked up the people of like, okay, who's the borrower? See if I could see. And I looked into their lives. And what I found was there are 3 main type of borrowers on Ground Floor. You have realtors, you have contractors / boutique home builders, and you have these financial freedom enthusiasts. And what they do is they borrow like $250,000 from, let's say, 1,000 people. And they go out and they use that money and they hire local roofers and plumbers and electricians. And they fix this house up. And then they have a realtor to sell it. And if you are an investor, and a lot of these are in the South. So let's say you live in the South. You're creating this local economic multiplier effect where a plumber, I'm lending this money, they're going to the project, and maybe a plumber's taking his family out to dinner that night because he got this job or something along those lines. So it spurs the right type of economic growth. And when people think Ground Floor, house flipping loans, I see it as like the exact type of stimulation for the economic growth that helps people. Yeah, so that was on Fridays. On Saturdays, again, it was kind of like a free day, and Sundays as well. So Saturdays, Sundays, and Tuesdays were like my free day where I didn't have anything planned or scheduled, which I ended up doing the week prior. Okay, so what am I going to do? Now, the other great thing that I did was got a King's Crowd account for these equity investments. There is no way I would have been able to go through each platform, figure out, okay, what kind of equity is this? And it's just no way. There's just way too many deals to deal with. So having a King's Crowd account was huge. So that's kind of the process I went through of doing this. And I got to say, I've been humbled. I went into this thinking I was a good investor. Like by month 9, looking back on day 1, I'm like embarrassed by myself. Like, oh my gosh, what was I thinking? You know, so doing something every day, you get good at it. And it also tells me that even though I think I'm good now, in another year, I'm going to humble myself. So it was a really great experience to see that, like, because I definitely went, oh, I'm a good investor. I had that kind of swag happening, swagger. So that's my experience of really how I did it and what my thought process was.
Well, we are absolutely going to be diving into some of those lessons and key takeaways that you had of if you went back to yourself a year ago, what would you do differently? But before we do, just to dive a little bit more into like your process, I think sometimes people think, oh, to invest in a private company, I need to do 20 hours or 40 hours of diligence on a deal. Obviously, that's going to change depending on the check size of like the investment that you're writing. But how did you think about that just in terms of how much time to spend versus the amount that you were investing?
So that is actually a really great question. And yeah, for these debt deals that I did on places like the SMBX, $10 minimum investment requirement, I didn't do a lot of due diligence. But what's really exciting is if you want to, you can go to Yelp, you can go to Google reviews and really get fantastic due diligence because these are like your local gym or your local bakery. And so they have that is already in business. It's not like this is a startup. So you could take a look, and while I'm looking at Yelp reviews, I'm thinking, oh, is this a fixable problem or is this more chronic? You could totally see that on Yelp. Now, my strategy though was just to invest in everything just because it's a $10 minimum investment requirement. And I really wanted to see like what the overall return for the SMBX is, because I think I almost see it as a way for just diversifying. You don't have to spend a lot of due diligence on that. So that's one level. In the future, I don't even think I'm going to be spending as much due diligence as looking at the Yelp reviews. It's just $10, and I'm going more for a power law approach to the small business loans. And the SMBX, they do some due diligence. I've seen that they've improved on who they allow on their raises. I could see that. I've been investing with them for years now, actually, and they've gotten better at it. I could say that without question. But on the equity deals, I spent more time researching. I wanted to it wasn't just, it would be an hour plus at least for these, probably more for the equity deals, because yes, you want to look at the numbers, but what takes more time is looking at the humans involved and who are their advisors. And you want to look at their networks. And LinkedIn is a great resource to kind of verify their history, their work history, their resume. Here's something crazy. I was about to invest in this, I forget, it could have been like a circular economy toy company, something like that. But doing my due diligence, I saw that their resumes in one site didn't match up with another site. And I was like, I don't know about it. It spooked me. And so I didn't invest in that. And this is a remarkable thing. Anybody can access this information. Digital footprints last. So as far as due diligence goes, now also some platforms like Steward, which I invested in regenerative agriculture loans. Now, they're not regulated by the SEC. They are their legal framework was established through precedent, through litigation. And so what it is that it's a private lender, and they allow people to participate in loans with $100 minimums. So you go on to gosteward.com, you see their campaigns. It's very reminiscent of investment crowdfunding, but it's not. It's loan participation. And since it's a bank, they do massive underwriting. They do due diligence reports that lenders, I should say, can take a look at. And here's the crazy thing. They often go on site to verify impact. Are they actually doing regenerative agriculture practices? That blew my mind. Like, I've never seen due diligence on impact before, but yet here it is. And these participated loans, I'm putting $100 to fund to contribute a $2 million loan that's going to buy organic quinoa from indigenous growers in the highlands of Bolivia that have been regeneratively farming this land for thousands of years. I mean, that's crazy. And I'm getting an 8.5% annualized return with amortized payments. Just gets better and better. So the due diligence I did on Steward, I only did because I was curious about the farmers, and like the stories were fascinating. I love that kind of stuff, and how they were improving, selling directly to schools and all this other stuff that was going on in that whole thing. So the due diligence on Steward was less than I would do on other ones. Other fundraises, their innovation fund, I didn't do a ton of due diligence. You're investing in big private companies. It's a fund for big private companies. OpenAI, you may have saw that slide in the beginning. Databricks, Canva, Anthropic. They got a ton of really
names.
solid private companies, and that's something I believe in. I believe in AI and our digital infrastructure, and I think everyone should own a piece of that because it's our infrastructure. When it's infrastructure, we all need to own a piece of that, and so that's why I'm really a big fan of the Innovation Fund. It did great through my year. It was 11% increase throughout the year. So, I mean, fantastic. Cool. Let me see what other due diligence. Yeah, so it was very platform specific.
Yeah. Well, I think that's a great point because, investors definitely need to understand that platforms may or may not perform different levels of diligence themselves, right? And if you're talking regulation crowdfunding, funding portals, it's kind of like basic bad actor checks, helping with filing stuff, but they're not necessarily saying, hey, this is a good investment or not. So it's really important to understand the nuance around that. I want to make sure we leave some time for the end for audience Q&A as well. So if the audience does have any questions, feel free to start popping them into that question and answer box. But I think one of the other big things, Paul, I just, for myself, want to know is like, how do you track these? Once you get 366 of these, every investor has some spreadsheet, right, that you manage, or maybe you use a portfolio tool, but like, how are you tracking all of these investments now that you've actually made them?
Yeah, Excel. There is nothing that exists for financial planners to aggregate all of this. So I had to create a spreadsheet, which I'm not like the most technical guy to do. I had to build calculators using Claude, which took me, I'm not a great spreadsheet guy, and it took me like 6 hours to build one calculator, but I did it. I went through the process to try and be able to track it. And ultimately there are things that are very trackable, like income, super easy to track, but the equity, that's very difficult to track, obviously. And another thing, I think the Reg CF dashboards for debt need huge improvement. They are ugly. There's no cash flow models. Climatize does it. They have the best for seeing the graphs and the charts, but it's non-existent. I think Honeycomb should do that. SMBX should do that. Anybody who has anything to do with debt, that's what we want to see. We want to see charts. We want to see graphs. We want to see cash flow. We want to see our annualized return. We want to see all that. I don't know if they can't because of regulations, or maybe it's just not part of their business model yet, but I would love to see that. I mean,
That's a great call out for any funding portals out there that are listening to this. So
Right, yeah, please do. I mean, I want to see that. And also, so if you want to get some ideas of how to have a really great investor dashboard for debt, look at Prosper and what they do. I can see all my loans. I can go click it. I can see which ones are performing, which aren't, which I'm happy to. I want to talk about that too, because things fail. And if you don't mind, Brian, I could briefly go into some failures.
Please, let's jump into it. Let's start into the results. Yeah.
So I did. So that for just the year on SMBX, 57 small business loans. One of them has stopped paying. And so it was a loss of $7.73. Okay. That happens. But I have already earned throughout the year $125 in repayments, which allowed me to invest in 12 more businesses. Or what I also did was just doubled up my investment. So you're able to get that back in there. So it definitely, failure is going to happen. But when you have this massive diversification, it's investor protection built in. That's normal to have failures. Another thing that's interesting is that when I compare SMBX to Honeycomb Credit, which are both small business loans mainly, one failed on Honeycomb too, which was a $75 loss. And so having a $10 minimum investment requirement, I think, is superior because a $75 loss is much different than a $7 loss. So that's something. With Ground Floor, 432 different loans. Think about that. 432 different loans with $640. That's it. 2 of them failed. And I lost no money because of the lien position. The loans are collateralized. And so I think I even gained 1% or 2 on the loss just because they sold the properties. And now, so having that type of protection is phenomenal. Prosper, I lost 1, invested just 50, but because I'm getting principal and interest payments every month, I was able to invest in 12 more or 13 more. I forget exactly how much. And so, I lost 1, but as of today, my annualized return is at over 11%. Prosper is doing good. Ground Floor, it's just under 13%. Climatize, it's at 10%. So these assets, they're performing. Roots, that's another one that's just under 12%. So it's not like it's performing. It's doing great. While everyone's having a crazy year in the stock market, I'm sitting here just being like, go local restaurants.
That's encouraging to hear. I will say, coming from the investor's perspective, I hear all that and I go, ooh, the tax filings to support all that. How do you think about that for those who maybe are filing their own taxes? Does this require them to get a CPA? Can you do it on your own for failures and income? Yeah.
So this is the greatest thing ever, Brian, because anytime you are selling off stocks, you're triggering a tax event. Well, that's not happening with these monthly amortized repayments. There is no tax event. I could use that income anytime I want. And so I don't have to think about, what's the tax implication? I get a 1099, an interest thing at the end of the year that I send to my accountant. Or if you do your own taxes, it's super easy to do also. There's nothing complicated about any tax event that's happening. In fact, it's a relief because that's the amazing thing about investing in all these private credit with the amortized payment. You have income if you need it and growth when you don't. Here's another thing, Brian, about having this income. It's shifted my whole paradigm of how financial planning should work. Currently, financial planning is more of an accumulate and stagnate wealth through equity ownership, right? Equity is ownership, so it's more possessive because you own it, so you're going to control it. Well, with the income model, it's not. You're able to get income and you're able to put it out back into the world, which stimulates economic growth. And if you ever have looked at how to calculate GDP, which I did, it's the super easiest formula. Here it is. It's money supply, which we all know, money supply. But here's the thing that nobody talks about. Times velocity of money equals GDP. So we have money supply times velocity of money, and that equals GDP. Now, all we talk about is money supply and quantitative easing and restricting the banks, because the banks, they're creating the money based on deposits of their account holders, and it's to stimulate economic growth, to improve that GDP. That's why the money supply is to increase. But no one's talking about the velocity of money, which is simply how quickly money changes hands, how quickly transactions happen. And when you focus more on this income model, you're harnessing that velocity of money. And so you're growing the economy in the best way possible, not with money supply, which does inflation and all this other stuff, but with velocity of money. And it's a fascinating shift in paradigm of how you can do financial planning. I don't teach people to have 6 months of emergency savings. I teach people to have 9 months of income that would replace your income through this income model. It's a total shift in paradigm, and it's possible now because of this access to private market investments.
Oh, amazing. I want to make sure we get to some of the audience questions as well, but before we do, let's say you go back to the start of your whole journey here, a year plus ago. You're talking to yourself on day one. What are one or two of kind of your biggest takeaways or things that you would tell yourself to do differently, kind of having gone through that whole year now?
Don't invest in candle manufacturers. That's number one, regardless of their Instagram following. In all seriousness, that is one thing that I was like, well, how big is their social media following? That was like something in the beginning. I thought that was important. That's not important. So that is a big takeaway that I won't do. Also, it's really incredible about just, I talked about it earlier about how just redirecting your capital. Something I would like to do and show is how you could take, and this is maybe I'll do this next year. I don't know how you can move your 401k or your IRA or whatever from the traditional into this new, what I consider a safer model, far more diversified. How can we do that? That's something that still kind of I question, and I have done a little bit of that, but I wish I did more of that, because I think that's the next step, really, is moving our money outside of these traditional, these institutional investors. There's 5 of them, State Street and BlackRock and Vanguard, whatever. They're controlling everything, and it's absolutely toxic for our economy. And so that's something I know I need to learn more about, just how we get our retirement accounts out of there and into something different.
Okay. Now, putting another hat on from the founder's perspective, you looked at probably not just the 366 you invested in, but probably all the ones you didn't. Do you have 1 to 2 key takeaways for an issuer or a founder or a small business who is going to make one of these offerings, whether it's for equity or debt, of like, don't do this or make sure you do this? Like, what did you see there?
Yeah, the safes, if I never have to invest in another safe, I'll be happy. Founders, stop giving away your company. You don't need to do that. You don't need to give away equity. I think it's way overused. Now, there are some cases where equity investments are good, but I see they should be replaced with revenue sharing notes instead of these safes, for a number of reasons. One, I just mentioned, for founders, you're not giving away your company. The other thing is that when you're doing revenue sharing notes, you actually have to think about, okay, well, how many units do I have to sell to generate that type of revenue so I can give to the investors? It makes you think about that so much more. So as an investor, I like that better than equity, because it forces the founders to really think things through in a different level. The other thing is what I talked about earlier, of this possessiveness of equity, because it's ownership. And there's going to be an exit problem. I can totally see that. You've talked about it. Other people have talked about it. And so we're now looking at these secondary markets. But I don't want the secondary markets to take the main stage. That should always be a side stage because Jenny Casson, president of the CfPA, she wrote a wonderful article about when you invest in the stock market, you're not actually investing in the companies. You're just providing an exit for another investor. And so there's no real economic growth that's happening through these exchanges, not the right kind of economic growth where we're still stimulating right at the bottom to create new jobs. And I don't want to see that happening in these private markets where it's just, we're now more focused on providing an exit for somebody else where someone's always going to need an exit. And so there's no resolution ever to that type of investing. And revenue sharing is the antithesis of that, where you're literally sharing and there's a built-in exit strategy for that offering. And I want to encourage anyone who mentors founders to really think hard on doing rev share notes with a higher return multiple so it attracts investors. If I see an investment, Brian, I invested in a 4X this year, and I was like, wow, a 400% return, and this company's already profitable. I was like, I'm in. It's certainly attractive to investors. I think personally, I would way rather have a rev share note than equity. I don't want to have to go to a secondary market to sell it. And as you said in the beginning about IPOs, people aren't really IPOing anymore. Being acquired, that's great. Sometimes, other times when companies get acquired, mission drift happens. So now I invested in this money and now this company's sold and they're not even doing what I wanted them to do. So we have to take a step back and say, okay, maybe we shouldn't do so much equity and we should start looking at some of these alternative approaches like revenue sharing.
Interesting. So one question that came in from the audience on revenue sharing, do you think that companies will be able to raise as much with revenue share notes though? So while this person sees the founder friendly argument, they're a little bit unsure if investors would get as excited for rev share notes that have constrained upside, whereas equity kind of has that, unlimited power law type potential. How do you think about that?
Yeah, that is a really good point. And that is a small percentage of the population, honestly, that will want that. So, and I'm not saying no equity. It's just that from a financial planning perspective, I want to know what they think their revenue is going to be so I can create a plan and have something to work for. And if it does, yes, it has a built-in kind of cap, but gosh, how many times would you own equity in a company and you just wish, I don't care, just give me a 2X return, just get me out of this thing. I mean, so yeah, there is this upside, but we also have to think of the big picture also. And, ultimately that can happen too. It's not about just either or. My point was, let's not have equity take the main stage. Yeah. There's going to be uses for it, but I think it's going to be too much. And yes, investors will do it. Here's another thing. When I tell my clients, hey, you can get a 300% return on that, their heads explode. When I tell them, oh, I don't know how much this is going to be, but it's going to take 10 years, there's all this kind of anxiety and nervousness. So for me, it's clear. Investors will absolutely invest in it, 100%.
Good point. Another question. So of all the platforms and kind of opportunities that you invested in throughout this year and that you talked about today, were all of those open to non-accredited investors or were some of those accredited only?
No, I'm over that. I think it's horrible that you have I get so many Reg D offerings as an RIA that come through my inbox, so many, and they're good. And they're not like complicated, crazy investments either. And they're all sitting behind a velvet rope that says, not for you if you're a retail investor. And that's just not right. It isn't right. People should have access to more private credit, to be able to crowdfund franchises and these other things. So I don't like here's another thing I saw. There was last year, there was 650, I believe, Reg A and Reg CF filings. There were over 32,000 Reg D filings. Wow. Wow.
That's a lot. Another one. So, do you have a favorite investment after the whole year?
Do? Well, I mean, I think there's a couple. I mentioned Invicta Water. That was one of my huge. I also mentioned how I was able to invest in indigenous growers. I mean, that's awesome. I was able to invest in nonprofits, which I loved. One was like a soup kitchen in Portland, and they feed, the needy, but they also have cooking classes and rent out their kitchen space. So it's an income generating nonprofit. And here I am getting monthly amortized payments from them at a 10.5% annualized return. It's just, it's so incredible. I guess I don't really have a true favorite. It's just awesome. All of them. I just love it. It's so hopeful. People, it's easy to get bogged down by, a lot of the negativity, but being involved in this for this year, I looked into the hopes and dreams of real people. Every day I was doing that. And if that doesn't make you optimistic, I don't know what will. I mean, it's so hopeful to step into the mind of someone else who has this vision of a better world. So yeah, I mean, it's a wonderful thing. I encourage more people just to do it. Scroll portals instead of social media.
That'd be great. And then one other follow-up from that same person. Did you have kind of a favorite investor dashboard or a platform? So thinking about maybe like just the UI, the user experience.
Yeah, Acclimatize. I think they have a great user dashboard. I like how they're one of the best platforms at vetting investments. Their only problem is deal flow. They also have $10 minimum requirements. So the investor protection I found on Acclimatize was probably the best for Reg CF as far as doing due diligence. And on top of that, having the $10 minimum requirement gives the crown to Acclimatize for those reasons.
All right. We only have 3 minutes left, but last audience question here. If you could try and do this within a minute or two, how do you deal with companies that stop communication and or payment when the platform doesn't step in as an intermediary? Do you do anything?
No, what I have done was go back on the portal and into the comments section and try and start some communication. But that's the thing. It's about diversification. You have to factor in fraud and business failure into your investment plan. There's just no way around it. And so you can't get too bummed on the losses. It's going to happen. It's going to happen. That's why you don't want to put too many eggs in one basket. And I think I've showed everybody you could put tiny little eggs in so many different baskets where you don't really have to worry about this type of this thing too much unless it becomes a chronic problem. Then just don't. Then this is the beautiful thing about crowdsourced due diligence. We're going to tell people don't use that platform. They allow fraudsters on it. And furthermore, it actually takes effort to do fraud on investment crowdfunding. If I was a fraudster, I'd just go to the crypto industry. Way easier to do fraud.
Awesome. I think we are coming to the top of the hour here. Paul, we cannot thank you enough for joining us today. For anyone who's just interested in learning more about you or, kind of what you do, what's the best way to connect with you or find you?
Well, you can always connect with me on LinkedIn. I'm active on LinkedIn. Also, you can go to my website, Stakeholder Enterprise, and you can find out more information about what I do and how I approach the investment world.
Fantastic. Paul, thank you again. Everyone here is just, echoing the thanks for spending time with us today, answering these questions. I think we all have something to live up to if we want to try and be as ambitious as you in taking on your investments. So thank you again. Thank you for your knowledge. And thank you everyone for joining. Make sure, as we mentioned, if you aren't already a member of the Crowdfunding Professional Association, head over to CfPA.org. We have lots of other great educational resources. We want to do lots more webinars like this. And of course, there's that Regulated Investment Crowdfunding Summit later this year. We'll sign off there. Again, I'm Brian Belay, Vice President of Product at King's Crowd and VP at the CfPA. Thank you for joining us.
From Capitol Hill to F Street's light, we gather where ideas take flight. At the summit, we're writing the code for the future of Capitol's road. CfPA stands strong and clear, uniting the dreamers gathered here. Voices rising, visions spun, the crowd's our power. We act as one. We are shaping the future together. Storms may change, but our bonds hold forever. Innovation, trust, and might will light in the dawn of investor rights. At the summit, we raise our aim. Came trapping now has a brand new name. From passion to policy, heart to purse, we're rewriting the story, verse by verse. From dealmakers spark to king's crowd's view, we measure what's bold, we build what's new. DNA drives the message clear that the people's capital starts right here. With purse at the table, the SEC its voice, guiding our growth, defining our choice. From impact investing to blockchain's thread, the crowdfunding.
It's going to be. Yeah, oh, that's fine. Yeah, we actually have to go.
All right. So we'll go straight to.
Okay. All right. Okay. Hello. Okay, let's find our seats, folks. I want to compliment everybody on their great time management, by the way. You all have been great. And also, we really need to give a big shout out to Elizabeth Eichhorn and Angela Barbash. She's on, but they have been making this all work. So thank you. Very quickly, 2 housekeeping things. CrowdCheck has been one of our very faithful sponsors. You even gave up time and said you don't need to talk about yourself, but CrowdCheck, very strong supporter. And GECA, Andrew really wants to make sure that we get involved. Just go to thegeca.org and sign up, and you will be globally connected. So next is James Murphy, who requires no introduction and told me so. So take it away, James.
Good afternoon, everyone. And thank you to Brian and the CfPA team for having me back here. We're certainly happy to participate. What an interesting time to be part of regulation crowdfunding and activities. I'm James Murphy. I'm Risk Monitoring Director at FINRA. My primary responsibility is overseeing the risk monitoring process for our 78 registered funding portals. It's been said a lot. You know, there has been some consolidation. I think Jenny noted that earlier today. But, you know, it's a story of growth. I've been involved in regulation crowdfunding and funding portal activities since it was incepted. Back in May of 2016, we approved 21 members. In 2016, we're up to 78. So we are growing, right? It's a growing industry. So it's important to note that. It's a very innovative industry. The landscape is changing with the onset of artificial intelligence, tokenization, digital assets, wherever you see it. You know, it's going to be part of regulation crowdfunding and funding portals. So it's really interesting, and it's a great time to be in this space to see how this industry has evolved over the last 9 years. I'm going to speak a little bit about sort of our regulatory operations program, for those of you who weren't here last year. But obviously, for our funding portal members, we have a regulatory operations program designed around their activities. So we have a membership process where if you want to become or launch a funding portal, there's a membership process associated with that. We have the risk monitoring program, which is what I'm responsible for. And then we also have our examination program, which obviously some of you are probably familiar with. I'm going to talk about things that, you know, how to operate sort of a compliant portal and another part of my comments are going to be talking about FINRA Forward. So FINRA Forward is an initiative that has been launched by our CEO, Robert Cook, and there's sort of 3 strategic pillars with that. I'm from New York, I talk fast, so I apologize. And it's really about rule modernization, member firm engagement, and crypto and cybersecurity and fraud risk, right? Those are the 3 strategic pillars. So I'll get back to FINRA Forward in a little bit, but I want to spend a little bit of time talking about how FINRA interacts with our member firms, right? And so for the membership process, you're not a FINRA member yet, but there's a number of things you can do to operate or to launch a crowdfunding portal. So the membership application program, which is a separate program within FINRA, you can have pre-filing meetings. I don't know how many people are familiar with that, but if any of you have gone through the membership process, you know, it takes time. We're reviewing your website, we're reviewing, the materials, we're reviewing the operational processes, design of your platform to make sure it's in compliance with the rules. So if there's any questions or concerns before you go through that process, right, and file that new member application, you can request to have a pre-filing meeting with FINRA, maybe to kind of gauge your operational readiness and where you are as a platform. So there are tools that are available. There's also a number of resources on finra.org, how to become a funding portal member. We have, written supervisory procedure checklists. There are materials that can be leveraged to help you through and navigate that membership process, right? So, and if you're not sure, reach out to me. I will connect you with the right people to have those conversations, right? Now, I'll dig a little bit more into sort of if you're an active funding portal. Also a plug, for the last two or 3 years, FINRA issues, or we've issued this for a long time, but it's called our annual regulatory oversight report. For the last 2 to 3 years, there's a dedicated section within that report to the activities of funding portals. So if you're not familiar with that, it happens to be for our 2025 release. It's on page 31 and 32. So I encourage you, again, there are resources that funding portals, active funding portals can leverage and utilize in this regulatory operations report. So what is that report? Really, it's a way for us, FINRA, to be transparent about the observations we're seeing in our member firms. And the section dedicated to funding portals is really talking about some of the things that we're observing either through our examination programs or our risk monitoring programs. And I'm going to touch on a few of those points with the time that I have. So books and records. It sounds, we expect the firm to have books and records about the activities that are occurring through the platform, whether it's transactional documents associated with investments, issuer-related documents, but we have issues where some of the books and records are not being kept. Now, the question is, or the thing maybe a funding portal should consider is if you're utilizing vendors, right? Which is very common in the funding portal space, right? We're highly reliant on, we have websites that are potentially being white labeled, you have vendors that are maybe keeping books and records, emails, whatever it might be. But best practice would be to ensure that if you're using a vendor to maintain your books and records, is do sort of regular check-ins. Are you able to access those records, right? Because when our examination program comes in to conduct an examination of the firm, we're going to be requesting those documents, right? So are you able to access those documents and be able to produce them, when requested either by us or subsequently the SEC, who, also does exams. Another issue that is common is we're seeing more and more platforms are sharing their funding portal platform with other affiliates, whether they're registered as broker-dealers or non-registered entities that might be conducting other exemptive offerings outside of regulation crowdfunding. So it's important that if the platform is sharing that platform with the affiliated entities, that there's clear delineation, right? The investors need to understand that if there's a regulation crowdfunding offering being conducted, that is being facilitated through the regulated crowdfunding portal and potentially other exemptive offerings, whether it's Reg A or Reg D, whether that's through the affiliated broker-dealer or potentially a non-regulated entity. But clearly delineating that sort of on the tombstone or somewhere prominently on the platform that, so investors have a clear understanding of which entity they might be interacting with. And we're getting old, so it's hard to see. But another thing we're seeing as well is credit cards. So investors are using credit cards. There's nothing wrong with using credit cards, right? I'm not stating that. What is important, though, is, are the fees that are associated with the use of credit cards being clearly disclosed to investors? And another thing we've seen as well is, if an investor makes a $100 investment via a credit card, is there the credit card processing fee on top of that? So is it 100 plus your investment? Or we've seen some situations where the fee is being deducted from the actual $100 investment. So understanding that is important. Having appropriate disclosure on your platform is important. And if an investor is investing $100, it's probably best practice to move the $100 into the designated regulation crowdfunding escrow account, right? So it's important. And, in this day and age, people use cards all the time, right? I imagine with the adoption, with credit cards or potentially tokenize that or, stable coin or whatever vehicle might be used to pay for securities, as we move forward into this future is critically important. Also, Form FP updates. So Form FP, for those of you registered firms, is a document that's filed with the SEC that contains material information about the portal, address, ownership, use of qualified third party. I encourage all the firms to take regular looks at the Form FP and make sure that information is up to date. because that's the information we utilize and helps inform as we go out and examine what we do in the risk monitoring process. There's a lot of talk, again, around digital assets and tokenized assets and the use of stablecoin. That potentially introduces different types of qualified third-party vendors into this space. So again, keeping that information updated is going to help us inform and drive, how we interact with our member firms going forward. I'm going to spend the last few minutes I have here talking about FINRA Forward. Again, I said there's sort of 3 strategic pillars with that: modernizing FINRA rules, empowering member firm compliance, and cybersecurity and fraud risk. So we execute this initiative in a number of different ways. I'm going to focus more on the second, empowering FINRA member firms. So we do this, and we've taken this on this year, and we've had business outreach meetings. Some of you may have been parties to those calls, but we need to understand how our firms are operating. And it's critically important to us because that informs how we regulate, how we understand, right? So if you're adopting a new practice or introducing AI or digital assets, we want to have a call about it, right? It's not a gotcha call. We're not trying to call you out, but we need to understand. And in this rapidly evolving landscape, it's critically important for us to gather that intelligence. We also do this in a number of different ways, right? Some of you may have seen FINRA has issued a vendor survey. Now, some of you might say, why does FINRA need to know who my vendors are, right? Why are they collating that information? But, these vendors are increasingly have AI tools embedded within them, right? There's cybersecurity and fraud risks that are associated with that. So we recently, if anyone here have an outage with AWS, right? So that's important information for us to know. So, our head of regulatory operations, Greg Grouper, right, sends out threat intelligence products. So we become aware of information where there potentially is cybersecurity and fraud risk. So, before we sent out these vendor surveys, we'd have to go out to our 3,000 or 4,000 member firms and try to figure out, do you have exposure? Do you have exposure? Do you? Right? We wouldn't know that. Well, now we have sort of a centralized repository of vendors across the FINRA ecosystem, so we can do targeted outreach to our member firms when there's potential risk, right? And then we can follow that up with business outreach calls to understand what that potential vendor impact might be on your firm. And we use that information for other things as well. Banking as a service relationships as well. We're seeing the increased usage of banking as a service. So, it's, the firm may not have a direct relationship with the bank. So understanding those relationships, where the investor money is being held, how it's being held, are critically important for us to understand. There's nothing wrong with having these types of relationships, but understanding the flow, the operational processes associated with that. And by us having dialogue around those operational processes helps us understand your firm better as well, right? Because that we can take that intelligence in, have conversations around risk. It helps inform our examination program. So when they're going, on site or making, requesting records and documents associated with your firm, they can be more targeted in what they're trying to achieve. Again, there's we have a number of resources on finra.org. We have a series of FAQs for those of you that are not aware of that. So there's also a set of SEC FAQs around regulation, crowdfunding, and funding portal activity. So I encourage you all to utilize those resources. We also want to hear from you, right? Again, part of those business outreach, we want to hear from you. What are the challenges? What are the frictions you're encountering, right? Because maybe we could develop additional FAQs to get the guidance out there that the funding portals are seeking, right? Again, as we enter into this, AI landscape, with this digitization of the financial world, it's more important to have these dialogues, right? Because, with the adoption of these tools, right, it's going to introduce a certain amount of risk into the system. So understanding where that risk is going to help inform sort of our regulatory approach going forward. I just want to make sure to see if this is one of the things as well I missed. One of the things we've seen as well is customer complaints from time to time. Not surprising that funding portals might come across customer complaints. There is a filing requirement if there is a customer complaint received under FINRA Funding Portal Rule 300C. So if you're not sure what to do with that, there's a mechanism within FINRA to file that customer complaint. Usually it has to involve, fraud, or someone's potentially complaining about, their investment or risk or whatever that is, whatever it might be. So just remember there's a process. If you're not sure, reach out to myself or your assigned risk monitoring analyst, and we're happy to walk you through that process to the extent. So I'll leave a few minutes for questions if anyone has open questions. Nice to see you.
That we get communications from FINRA, and you've given a lot of context around some of the communications that we've received recently. It would be so great if with the communications we got that same context, because that would be so helpful, because we got 15 questions about some of the things you mentioned, and it just came out of the blue. I didn't understand what it was, and just the context with those questions as you've given it today would be so helpful, and we'd be I think go a long way towards us understanding why you're asking these questions, etc., and make it much easier for us to answer them.
Great. I'll take that feedback. We're happy to have the conversation as well. So don't be afraid to reach out to us either, right? There's no harm in reaching out. We want to have the dialogue, right? We encourage it. Oh, wow, I got a lot of questions. Sorry, I don't know. Jenny?
Thank you so much for coming. It's always so helpful to hear from you. There is a perception of a lack of consistency of enforcement or, oversight across different platforms or portals. There are people that say that certain portals are allowed to do things that other portals have been told they cannot do it. So could you comment on that?
Yeah, without having more specificity, it's kind of hard to answer, right? Because there's could be a lot of nuance associated with that. Our aim is obviously to be as consistent as possible as we regulate across the industry. But again, if there's a particular member firm that there's a particular pain point or lack of understanding, again, I think the appropriate thing to do would be to contact us, and we're happy to engage in that dialogue. So. Yes, over there.
Thank you. Question is more around proactive, right? As we kind of continue with our platforms, right? What are some avenues to have this proactive, ongoing dialogue? So one, there's a feedback loop, but also so that we can really strengthen and really partner, right, in a meaningful way. Because right now, my experience has been one which is much more of a submitting stuff, right, as opposed to having a bi-directional relationship.
Well, again, as I said earlier, we started this year conducting business outreach meetings with the firm, which is, we're happy to do in Zoom or in person, whatever the appropriate vehicle we want to use. But I think that's the first way is, having that one-to-one dialogue as opposed to sort of a letter writing campaign. Our examination program does business activity calls as they prepare for an exam as well. It's another way to have dialogue. So there's just a number of ways to do that. If we're not reaching out to you directly and you want to have that dialogue, contact us. You should have your assigned RMA. As I said, if you're not sure who that is, my email is james.murphy@finra.org. So send me an email. I'll get you in touch with the right person, and we're happy to do that and sort of leverage across the FINRA landscape.
Thank you so much, James. Appreciate you taking the time.
Thanks, man.
Where in New York are you from?
Born and raised Queens, and I live in Long Island.
Okay, I've learned my lesson. So there is a break, but you're just going to stay right where you are and exhale. Say hello to the person next to you. Say hello to somebody you haven't said hello to yet. Where we are.
From Capitol Hill to F Street's light, we gather where ideas take flight. At the summit, we're writing the code for the future of Capitol's road. See, they stand strong and clear, uniting the dreamers gathered here. Voices rising, vision spun, the crowds are power. We act as one. We are shaping the future together. Storms may change, but our bonds hold forever. Innovation, trust, and might will light in the dawn of investor rights. At the summit, we raise our aim. Came trapping now has a brand new name. From passion to policy, heart to purse, we're rewriting the story, verse by verse. From dealmakers spark to king's crowd's view, we measure what's bold, we build what's new. DNA drives the message clear that the people's capital starts right here. With purse at the table, the SEC its voice, guiding our growth, defining our choice. From impact investing to blockchain's thread, the crowd funds hope where angels tread. At the Professional Association, we're the builders of a brighter nation. From community to regulations art, every rule begins with heart. We are shaping the future together.
We are going to start off the afternoon after Commissioner Murphy with Brian Korn, who is a partner at Manat Phelps and Phillips. All right. And we're going to talk about crypto regulation and how it relates to crowdfunding.
Thanks, Vincent. Happy to be here. I think we sponsored that last 2 minutes you had, so I don't know what that cost, but you're welcome. There was no food or anything. My name is Brian Korn. I'm a partner in the New York office of Manat. We are a full-service law firm specializing in financial services, entertainment, and healthcare, among other industries. I'm, as I said, in New York. I focus on capital raising, crowdfunding, Reg A. Most of the Reg A I've done has been on the debt side. A lot of repeat issuers doing recurring debt transactions in the real estate space and in the small business funding space. Also, on the equity side, REIT formation and other equity structures using Reg A. And then public offering work. I was a former in-house lawyer at Citigroup and at Barclays. Earlier in my career, I was at Sidley Austin and Weil Gotshal. We're really happy to have this opportunity to kick off the afternoon leading into Commissioner Peirce's appearance. And I think it'll set the table nicely for hopefully what she has to say and everyone else. But within the crowdfunding world, there's been sort of a side detour into digital assets. And a lot of people are either pro-digital assets or they're anti-digital assets, or they're on the fence, or it's opportunistic. And one thing I've learned about being involved in digital assets is that it's really hard to do kind of part-time. The Twitter universe or the X universe in this space is extremely active. People trade ideas. Sometimes you read comments upon comments of postings. I'm looking at Robin and Saz now in the crowd, who puts out a weekly, but it's an intense amount of work. And at its core, there really hasn't been very much in the way of digital assets legislation. Most of digital assets is being applied to the rules we had pre-digital, which makes for some very awkward analogies and applications. And so we have a great panel. who we're going to delve into kind of where we stand on digital assets, what the future will be of legislation and regulation, and where do we go from here. I'll ask Dina and then Julian to introduce themselves and give a quick bio.
Hello, it's good to see everyone. Thank you so much for having me today. I'm excited to speak to all of you, and this is kind of perfect because I was the lead staffer on most of the Jobs Act in the Senate, and I was with Senator Toomey at the time, but the securities lawyer who I was asking all the questions to was now SEC Commissioner Hester Pierce. She was sitting behind me, so you're going to hear from somebody much smarter than I am after this. But anyway, so I'm at Paul Hastings. We are a global law firm. Everything I say today is on behalf of myself and not Paul Hastings. I'm in the fintech practice, but I really help out our entire firm. Because I'm the only person that has, I worked on Capitol Hill, on the House Financial Services Committee and the Senate Banking Committee. I worked on, got started on bankruptcy reform originally. This is going to sound strange, but we were working on bankruptcy reform based off of a report that the lead, person that was making the recommendations was essentially Elizabeth Warren. But I go all the way back to Graham Leach Bliley, e-sign, Check 21, when we were having these same pain points with the internet. I was the lead staffer with most of the Jumpstart Our Business Startups Act. And I was in-house at Chrysler during 2008. Before that, I had done mostly consumer finance issues on the Hill and in Treasury. I was the Deputy Assistant Secretary for Consumer Affairs. So I went from subprime lending then into Chrysler to rescue Chrysler. I was in-house at Quicken Loans. And when I went to Paul Hastings, my first client actually, this was in 2017. And this is, you will see there's very much of an interconnection between, Reg A, Reg CF crowdfunding and Jobs Act and, the crypto space. But my first client was somebody who had lobbied me on the Jobs Act. They were a registered ATS and broker-dealer that were trading digital assets as securities, and they were trying to tokenize real-world assets. So if any of that sounds familiar now, we're now in 2025, and so I will say here, my expertise is, Congress, really policy development in Congress. I've worked a little bit on everything, so I know a little about everything and a lot about nothing. And I'll lastly say that one thing that you're really missing on my bio that's important is I have 4 kids. 3 of them are already adults and doing things in politics and college and stuff like that. They become more important than me. I've looked at my bank account. They are expert in terms of being in terms of, what was I going to say? Well, I always say they know how to get liquidity. They're certainly good at raising capital, exit strategies. I learn a lot from them, but none of them have a trust fund. So, they got into the meme coin stuff. I watched because they're my biggest investments, but if they want to invest in, a startup, they can. So even, with all my investing, that money doesn't go to startups. So.
But they know how to hit the Uber button and the DoorDash and Chipotle.
We can talk offline about all the things I've seen over the years.
So good afternoon. My name is Julian Hafner. I am also an attorney. My practice is primarily corporate. I operate generally as general counsel for a lot of my clients. I'm the first kind of legal look that they get when anything legal should pop up. As far as my background, I have extensive entertainment practice. I've represented quite a few athletes in NBA, NFL, and also Olympians, and quite a few musicians, and a bit of some film in there as well. So what's more kind of appropriate today is that I'm also wearing my hat as a CLO for a Reg CF platform called Cineblock Films, which is kind of representative of my practice in the sense that it sits at the intersection of some of the issues that we're going to be talking about today, entertainment and access to capital, which is something that I also am very passionate about. And the way that we kind of came to this idea was that some from friends from college of mine, we kind of came at this problem from different perspectives. As I mentioned, I had a background representing filmmakers, often acting as production counsel, and also kind of advising on capital. And one of the issues that we kept running up against was how difficult it was to raise capital for these projects in ways that made sense, that were efficient. At the same time, I had a friend, another friend who was coming at this who had just come off a film project, who was kind of, he was a bit miffed, I'd say, about the process of producing the film, and wanted to think about ways that we could be a little bit more efficient and actually create solutions for filmmakers. So Cineblock was born. And in its inception, Cineblock was actually, we created that about 2019, 2020. We were digital blockchain adherents from the start, right? So we were trying, intentionally leaning into the technology piece and wanting to build something that was compliant from the start. We were coming out of the ICO kind of debacle of 2017 and knew that as an attorney that that's something we wanted to steer clear from. And that to the extent we're going to build something, we want to do it in a compliant way from the start, and that's kind of been our ethos from the inception till now. So yes, I'm very excited about the potential and the possibility of where we are in the space and what regulatorily the signals seem to be pointing in positive directions. So I think we're in a really good space at a really good time.
So and those are great intros, and that'll lead to our discussion. I think in the digital world, with the SEC at least, and somewhat with state regulators, we've seen three eras: the Jay Clayton era, the Gary Gensler era, and now the Paul Atkins era. With Clayton, you had uncertainty over what was a security. There was an attempt to do a little bit of guidance through speeches and other statements. We learned that Bitcoin and Ethereum were not securities, but everything else could be a security. Proceed with caution. And that SAFs, so Simple Agreement for Future Token, which was an extension of the SAFE created by Y Combinator, the Simple Agreement for Future Equity, the sort of two-page subscription document that everybody loves, was problematic because the version of the SAF that went around that Chairman Clayton reviewed did not have any obligation for the company to actually produce a token. It just said, if there is a token launch, you have subscribed for one, nor was there an obligation to return the money if there was no token launch. And so he said, this is a pretty clear pathway to fraud. Under Gary Gensler, we had a tighter shift towards implying that almost everything is a security because it failed the Howey test, or it passed the Howey test in that it was an investment contract made using with an expectation of profit in a common enterprise that is based on the efforts of others. And you could think about almost anything that you invest in, including non-securities, artwork, theater tickets, anything, baseball cards. All of that has some, whether a signed baseball improves in value or not is really based on the efforts of the player whose career might do better. And then now we had a lot of enforcement cases brought up against virtually every platform, and the refrain coming from the platforms was, well, we're happy to be broker dealers. If you think we should be a broker dealer, where's the form? And we'll fill out the form. And then there was a long wait to get approved as a broker dealer, and ultimately, very few of them actually had the resources to go through that process or make it through. And then under Paul Atkins and President Trump more broadly, we've had more liberalization of what is and is not in scope. We've seen a lot of enforcement cases dropped against some of the parties that were sued in the Gensler era, but there has been a little bit of slowness in terms of actual clarity around what the rules are and how to proceed. Other than people think, well, there seems to be now a clear divide between non-securities and securities, and who regulates the non-securities, probably the CFTC, although that agency hasn't really done much in terms of addressing things or being clear. I'll ask you, Dina, just in terms of, are we in a situation now where you can advise clients that if they want to launch a token, that there's sort of clear path to doing so and, kind of a third rail to stay away from? Or are we still in sort of a cautious phase?
So as you know, I don't practice the securities law in the traditional sense. So as I gain in terms of something like that is by listening to the other attorneys throughout my firm. And I think there is not 100% clarity. I know I'm saying clarity, which is the legislative term, right? So there's not 100% clarity, but I think there's more of a comfort level to move forward because of the administration's position, which has been very, very favorably inclined toward crypto. And it's always been in the calls that I've been in, from the get-go, it's always been sort of a risk tolerance type of thing, and how much you give the client options in terms of how much risk they want to take. And there's definitely things have become a little bit less risky, is what I would say.
Julian, just your thought on the environment right now.
Yeah, I was going to agree that wearing my lawyer hat, not my CLO hat, that there are encouraging signs coming from Washington that I think are encouraging folks who are not scared by the risk to jump in. I'm finding a lot more interest in the space. I'm fielding a lot more questions about what is or isn't possible. So yeah, I think that generally speaking, the signals and signs that we're getting are encouraging, and I think that the space is growing as a result.
So just looking at the legislation, the leading legislative fix for blockchain, it looks like we're in an environment, at least, that there aren't going to be a ton of bills passed, right? Obviously, the government's shut down, but even putting that aside, the space that it needs for getting through usually is tied to being part of another bill, or maybe there'll be a pocket where you can get both sides to agree. We had a law passed, the Genius Act, earlier this year, was signed into law, and it basically allowed the stablecoin community to move forward under greater clarity. With respect to the Clarity Act, I'll just talk a little bit for those who aren't familiar. It was passed by the House in July. It classifies digital assets into digital commodities, investment contract assets, permitted payment stablecoins, and there's going to be an exemption for token offerings. Issuers organized in the United States can raise up to $75 million in a 12-month period via token sales without full registration. So it's sort of similar to a Reg A for tokens, although unclear whether the SEC rulemaking is going to allow for a review process similar to Reg A, where you could have an SEC style or an IPO style comment letter that lasts for months. What do you think about just the Genius Act, the Clarity Act, what you hear about their progress, and what are the main obstacles? And then I guess ultimately, for Julian, is it actually going to solve any problems or just create more?
The Genius Act was, clearly a huge achievement. Stable coins are obviously, a major potential in terms of use case is, new payments rails that are, faster, more efficient, remittances, when you talk about digital assets. So the Genius Act was, something that even I was surprised that it was able to get through with bipartisan support. We are seeing a lot of applications, to get approvals through the OCC and things like that. It's going to take some time for the Genius Act to be implemented, so there's still some uncertainty, but it's a very important signal to get that done. It also makes the dollar much more available in terms as a stable coin around the world. So it sort of is a way to protect the dollar as the reserve currency for those who've been worried about other digital assets. So it's going to take some time to implement the Genius Act. There are a little bit of bumps in the road in terms of the Genius Act. There have been concerns, obviously, from the banks about people being able to get interest on their stable coins. The language they feel is unclear, so they want that reopened. So that's a little bit of a tricky thing. There's been a little bit of a battle between I would say the traditional banks and the industry and the crypto native types. But Genius Act is a pretty big achievement for Congress. In terms of, you want me to talk about clarity?
Well, just so we've had, versions of the Genius Act and the Clarity. You had Loomis, Gillibrand in the past Congresses. You've had a lot of attempts. These bills come out, everyone gets excited. We write client alerts, and then the year ends and nothing happens.
Yeah.
It looks like we're headed in that direction, but give me your perspective. Yeah.
Yeah, so first of all, I want to say a lot of people when it comes to Congress, they'll say, well, I don't really need to watch it. Nothing's happening. Nothing's going to happen. Blah, 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 Well, first of all, I'm very numb to this shutdown is what I'm going to say. I shouldn't be numb to it because I am, because I came to Capitol Hill the first time we had the long government shutdown when Newt Gingrich was Speaker of the House. I was an intern in the Maryland office, and you can imagine, I did not have off with the level of people who weren't working it was like. But regardless, no matter what, a lot of people that haven't worked in Congress, even a lot of lawyers, they don't understand that there's very much an interconnection between Congress and the agencies. And so the movements in Congress, even if they don't get something done, a lot of times it can impact the other agencies. A lot of times there's coordination back and forth. When you're on Capitol Hill, you're regularly working with the agencies, congressional affairs, but also the leadership at the agencies. So it's always important to watch the movements in Congress. And when I say watch the movements for this crowd, there have been, I know some of these issues overlap, but there are been efforts in terms of what we call capital formation, which I know in a lot of in the digital asset space is also, part of it is also capital formation. So there's those bills you want to watch, like on, accredited investor and all those other provisions on the capital formation side. But at the same time, Clarity Act, it is a much more complicated piece of legislation than the Genius Act was. And the shutdown affects things in terms of when things are more contentious on Capitol Hill, it gets a little bit harder to get agreement to happen. And as you can see, the House doesn't need to pass anything right now, but the Senate right now, it's just been all about trying to get the government running again. So it takes, more time. That being said, there are discussions ongoing. They were happening today on Clarity Act. There are, barriers on the Clarity Act. So the group of Democrats that supported the Genius Act, the magic number in the Senate, that group of Democrats has a list of concerns that really are tied to DeFi and would undermine sort of the concepts behind DeFi. And so there are discussions ongoing. But again, you always have to get to that 60. So, even if you're in that room and, Senator Gillibrand is really the lead Democrat who's negotiating with the, Lummis, who's the lead Republican, and others in the room, you still got to make sure you get to 60, right? Because even if you get to that 60, even if you get an agreement in the room, if all of a sudden others come out and say, well, we're not for it, and you don't have the 60, you still can't move forward in the Senate. So it's a complicated bill. That being said, as those movements happen, and you'll hear more about this from others who are in the SEC, but even, maybe when, Commissioner Peirce is here, those movements influence the SEC. And I'm forgetting here that also the Agriculture Committee plays a role in all of this, and because of the CFTC, and the Agriculture Committee hasn't even put their piece of the market structure bill out there, right? Because it's all about what something is a security or a commodity or what, how we're going to characterize it, how we're going to regulate it. The SEC has a great deal of authority to move on its own, which others could talk to more than I could. But, the reason the Jobs Act happened was because we couldn't get the SEC to do. We were talking to the SEC saying, hey, raise the shareholder limit. We couldn't get them to do it, right? The SEC can do a lot without Congress. The benefit of the SEC is the flexibility, right? The benefit of Congress doing something is, so the SEC can do a bunch of things, right? But then if you have a different type of chairman, like the last chairman, for instance, they could be undone. If Congress does something, you have the benefit of at least having something in statute, right? And it being permanent. But you can also have it where it's too rigid, and it makes it can be so rigid that the law doesn't work very well. So in terms of whether it will pass or not, I would say it will be very difficult. That doesn't mean it's not meaningful. That doesn't mean it doesn't set precedent for the agencies or set precedent for the next Congress. But the closer we get to the elections, and we are in the election cycle for the midterms now, it gets harder and harder to get things done.
I think, and I'll let you go, Julian, but I think what's also important to remember is that the chief weapon against a lot of the industry is the Howey test. And if you're under Howey, then you're a security. And if you're security, then follow Reg A, Reg CF, Reg D. Most domestic issuers follow Reg D, or they go offshore and they form an offshore foundation. And under Reg S, you can issue to anyone you want as long as they're not a U.S. person. You don't make directed selling efforts, and you have immediate liquidity. The problem with Reg D has always been it's limited to accredited investors primarily, and you have this 1-year hold period. And so most of the token issuers said, I want this thing listed on Coinbase or CoinList or Sushi Swap or Uniswap right now, and it needs to be liquid, and I don't have time to wait a year, and I don't have time to only get the creds because I have an affinity group that's not accredited. See a lot in the music business, music royalty funds that we form, they want access to the non-accredited people, the fans, and it's very hard to do a deal that's fully for creds, and sometimes you do, but it's interesting. But the Howey test is a 1946 U.S. Supreme Court case, and actually, the SEC can't really overturn Howey, and neither can lower courts. So, even though it was from 1946 and just past World War II, and it dealt with something totally different than Orange Grove cooperatives and not digital tokens, still the law of the land, still respected. There's a companion case called Reeves, which deals with debt, Reeves versus Ernst & Young in 1990. Those are still the leading cases on whether something's a security on the equity or debt side. And, it would be an act of Congress that could overturn a case, just like, the Dobbs decision for abortion overturned Roe v. Wade. I'm sorry, that was another case. But you could have a legislative change in Congress that overturns the U.S. Supreme Court. Not sure we're going to see that and that level of agreement.
Yeah, and I wanted to say, I should, especially in front of this crowd, yes, the SEC can do a lot of things in terms of capital formation that were not done in the Jobs Act, but the reality is the Jobs Act was the first time that we allowed retail investors, for the most part, to invest in startups, right, through CfPA or Reg A. And there is always this fear of, and some paternalism in terms of retail investors investing in startups. And even an SEC chair can have some fear, because if a lot of people lose money that are retail, then they all complain to Congress and they get hauled up to the hill. So I would say that Reg CF and Reg A are still, they're important, because Reg CF is, there's some established precedent for it and experience for it. And when it comes to, when we talk about tokenization and fractionalizing things, you all probably know better, Reg CF lends itself well to something like that. So I think that these laws that have passed, they give some structure and comfort. And so I think that you all have a lot of opportunity and should continue to take that opportunity.
So Dina essentially stole my thunder. That's exactly where I was going with it. That while the Clarity Act is not necessarily directly affecting our business as Reg CF platforms, it does send a strong signal that this ecosystem is growing and growing in ways that I think can benefit issuers, investors, and platforms as well. And to your point, Reg CF does has provided us with a structure, I think, that works in large part, right, in the sense that it addresses the investor protection pieces, while also at the same time allowing for, depending on one's perspective, meaningful capital formation, right, in ways that wasn't quite available beforehand. And I think it's only going to grow and kind of bringing it back full circle to this panel, I think digital assets are going to play a key role in expanding that capital formation, the ability of retail investors and small businesses to really play in this area here. So again, while not necessarily directly impacting our business, it is an encouraging signal and one that we're very happy about.
So Julian, let me ask you, in the athlete space, we had registered income stream offerings pre-digital. So like, Fantex, a lot of people remember they were a registered broker-dealer. They did athlete IPOs through an S1. It cost them $1 million to put up a BD, and then they had to form an alternative trading system to allow themselves to have these shares traded. And they did 2 or 3 deals with some NFL players, and there was no liquidity because somebody wanted to bid $32. Somebody wanted to bid $8, and the ask was $32. And there's no specialist market. There's no volume that really drove that. What is it about digital assets that's attractive to your clients when you talk to them about engaging in that space versus the traditional security space?
Yeah, so I think the digital asset piece is exciting to some of our issuers, largely because it widens the pool, right? It allows for a lot more participation in these projects, and at the same time, it offers the promise of a liquidity, even though we haven't quite met that promise. So I think it's more perspective, excitement, as opposed to like what's happening today. But on the Reg CF side, what we see more kind of excitement about is given our client and customer base, is the ability to leverage the fandom, the ability to leverage the following, the ability to leverage the interest and excitement around content, right? Because content at the end of the day is emotional, and people tap into that emotion, but people haven't quite figured out how to leverage that emotion in ways that can allow them to continue to make more content, allow them to raise the capital that's necessary. So I think that's really Reg CF's kind of general appeal to our client base is the ability to leverage that which they've spent careers building in ways that they haven't necessarily been able to monetize. And on the investment side, obviously being able to kind of tap into the content that emotionally moves them and have the potential to actually economically benefit from that participation. So by and large, we're very sanguine on this area, this space. And all the signals coming from Congress are quite positive. And that kind of if you were to kind of compare that to what we saw prior, which was a lot of kind of dubiousness around it, right? Around the space, and it wasn't quite clear that the space had the legs to actually survive. So it appears that we're on the precipice of something quite exciting.
I mean, I think in the Reg CF space, if you had the limits raised and if you broaden the ability to use funding vehicles as opposed to pure operating businesses, it would be more useful. When I talk to clients, I say, well, you can use Reg A. Yes, there's an SEC review, but there's no need to have a broker-dealer, which is attractive to some of them that want to sell it off their own website. You can rinse and repeat. I mean, there's a company out there, Masterworks, which I'm sure you've all seen. They do fractional ownership of artwork, and they've done over 250 Reg A offerings. Each of those offerings can go up to $75 million. So you have this small offering exemption, and you could raise billions of dollars using this $75 million cap, as long as you're able to rinse and repeat and get more investors into each portal. Do we have any questions? Scott McIntyre.
Yeah. So we are at the phase now where we haven't actually launched any of our projects on Cineblock, but we have a amazing kind of pipeline of projects that I think, and part of our approach too, because as the operators in the space know, marketing is a key piece of the business, right? And to the extent that one hasn't figured out how to market, you're only playing, you're not playing at full capacity. So to your point, I think especially given what we do and kind of the high profile content that we have access to, that's a key piece of our approach going forward. And I think that generally, the excitement that's going to be created around some of the projects is going to benefit the entire space. So yeah, we're on it.
Question? So the question was, if you get an ATS approved, there's still a lot of issues. That is true. So, for those of you who don't know, the ATS is an add-on designation. Once you're a registered broker-dealer, which is not easy to do, but you can do it through FINRA and through an SEC concurrence. And then you have the alternative trading system application, which is added on to that, which requires you to be a qualified custodian, if I'm not mistaken, which means you need to have additional capital requirements and record keeping and all of that. There is a little bit of a gap in terms of how they are regulated. There's a traditional ATS regulatory space within FINRA where you'll have a cycle exam once a year, and then you'll have for cause audits or other exams. But at the same time, on the digital asset side, it's very difficult to track a lot of this stuff. Trading, tax, IRS is also extremely interested in digital assets. The tax people had a free ride for about the first 5 years of crypto, where no token transactions were tracked. And then for a while, as long as you never came out of cash, your transactions weren't tracked either by the IRS. So you could trade token for token as long as none of the pairs involved cash. It was impossible for somebody to really track whether you had a gain or loss or what your basis was. That is slowly catching up, but kind of everyone's sitting around still wondering, whether there'll be any real issues there. But again, yeah, there needs to be more clarity. I think the SEC has formed this crypto task force, and one of the parts of that within the Division of Markets is adding greater clarity. If we're going to allow more brokers and more ATSs, there has to be more clarity of regulation. The backstop, of course, is this is the regulatory environment. We already have rules in place. Please comply with them. And we understand you don't like them or you don't think that they apply to your assets, but that's something to deal with. Also, you should think about states too. The states are open. State regulators have been very active, especially California and New York in this space. Many are adopting these crypto and digital licenses, and California just adopted one. New York's had one for a while. Very hard to get to, probably only 25 licensees in the state of New York. So that's an important issue too, and money transmission laws. We are at time, so we'll have to leave it there. Thank everybody thanks everyone for listening. Thanks to my panelists. Great job, and we'll take it back
Thank
to
you all.
Vincent.
Wonderful panel. Thank you. Okay, I think that Commissioner Peirce, and we apologize for the typo in the program, but the commissioners on their way up. And one correction that we'd like to make is the live streaming is by E360 TV and Supercrowd, not by FinTech TV, although FinTech TV does wonderful stuff. We can stretch a little bit, and we'll wait and get ready for Commissioner Peirce.
from Capitol Hill.
Okay, back to our seats, folks. All right, well, we are very fortunate to have Commissioner Hester Peirce here for a fireside chat. Thank you for taking time out of your busy schedule. And Brian Christie will be moderating, so why don't you all come on up? Thank you.
I think this is good. This is good.
Thanks, everyone. Sorry, we just ran up the stairs, so we're out of breath. But I'm grateful that you fit me into your schedule here, and I apologize for being a little late. So I'm working without a staff now because of the government shutdown, and so you can tell I'm very disorganized when I don't have someone managing my schedule, so I apologize for that. I do want to give you my disclaimer, which is that my views are my own views as a commissioner, not necessarily those of the SEC or my fellow commissioners. Brian?
Sure, great. So I'm Brian Christie, co-chair of CfPA, CEO of BrainD, and co-founder of Biotech Social Inc. We are very pleased to have the commissioner come back to be with us again this year. She was very great, very generous with her time last year. It was great because she was very engaged, took audience questions. People were really excited, so we're happy to have you back. Let me read your bio a little bit, for there are quite a few new people who are here. So Commissioner Peirce was appointed by President Trump to the U.S. Securities Exchange Commission and sworn in on January 11th, 2018. Prior to joining the SEC, she conducted research on the regulation of financial markets at the Mercatus Center at George Mason University. She was a senior counsel of the U.S. Senate Committee on Banking, Housing, and Urban Affairs, where she advised Ranking Member Richard Shelby and other members of the Committee on Securities Issues. Commissioner Peirce served as counsel to then SEC Commissioner Paul Atkins. She also worked as staff attorney in the SEC's Division of Investment Management. She was an associate at Wilmer, Cutler, and Pickering, which is now Wilmer Hale, and she clerked for Judge Roger Andewelt, is that correct? How I pronounce his name? On the Court of Federal Claims. And she earned her bachelor's degree in economics from the Case Western Reserve University, thank you, and her JD from Yale Law School. So she's given her disclaimer already, so we can get going. But first, before we launch into questions, what's it like? The SEC has about 5,000 people on staff usually. Would you have 10 people working there now?
It feels like that. I think we have about 10% of the staff, so none of them work in my office, so it's very lonely.
So last year, let's go over a little bit of just how the commissions worked. And I would say last year when you came, it was about this time of year before the election. And my oh my, what a difference a year has made, right? In terms of what's happening. So last year, you explained to this group that there are 5 commissioners. 3 of them were appointed by the party that's in power. So, and then 2 by the other party. So last year, there were 5 Democratic commissioners and 2 Republican commissioners.
3 and 2.
3 and 2, I'm sorry, 3 and then 2. This year, we only have 4 active commissioners, of which 3 are on the R side and only 1 D. How has that sort of changed, maybe swung the sort of agenda of the commission?
Well, it does mean that I'm dissenting less than I used to. So that's one thing. I mean, I think that the commission is very different. The chairman makes a big difference because the chairman sets the agenda, sets the budget, and manages the staff, the bulk of the staff. And so when you get a new president coming in, you typically, I think you always get a new chairman. And so that really changes the nature of the commission's focus. And I think we're seeing that. We're definitely seeing that this year. We are down one commissioner, and two of us actually, our terms are over. So we're both in our lame duck period, I guess.
Okay. And so now one of the big things that has happened this year is that you have really been assigned to oversee the crypto task force, which is sort of a big role, an important role in terms of what's happening. And that's a series of roundtables. Now, it's beyond the scope of this discussion to go into the details of the roundtable, but a couple questions related. First of all, do you get any sleep? And then second, can you tell us sort of a little bit about that process and what the outcomes are as a result of it?
Yeah, so I in this role, we're really just trying to get to regulatory clarity around crypto, which is something that a lot of people have been calling for a long time. Congress is working on legislation, and we've been helping them. We also have been working on our own set of guidance documents and rules. The task force is relatively small. We have about probably a dozen people on the task force, but then we work with staff throughout the agency because crypto really does touch on much of what the agency does, and it's an interesting opportunity to look at rules through this lens to see whether we need to modernize rules more generally. And so I think it will have some, while I hope that one outcome is that we do get more regulatory clarity for crypto, I think it could also point us in the direction of maybe where we need to change rules more generally. And so that's the process that we've been working on, and it's been a lot of work, but also a lot of fun so far.
So can you tell us, really one of the questions that's come up, I think it's good to have someone from within the commission help to provide an explanation on this, is where does the authority of the commission to enact these sort of additional exemptions lie? Does it really depend? Is it contingent on something being a security by definition by the Howey, or can the commission sort of define securities more broadly?
Yeah, I mean, part of what we're doing is we're just saying there's some areas over which Congress has not given us authority. So meme coins, for example, the staff put out guidance saying that meme coins typically are not securities, and so people shouldn't expect to get the protection of the securities laws when they're trading in meme coins. So I think really what we are trying to do is stay within the scope of the authority that Congress gave us. Now, as you pointed out, they did give us quite a bit of exemptive authority. And so when we're confronted with a new technology or a new asset class, we can use that exemptive authority to craft rules that make sense. You can create an exemption that's a conditional exemption. If you comply with these conditions, you don't have to comply with the rule as it's written. And so we are thinking about how we can use that. We use that all the time in non-crypto areas, but we're thinking about how we can use it here. I think one of the big questions has been, how do you decide whether or not something is a security? And the Howey test has been the way that much of that analysis has been done with respect to crypto assets. It's certainly not the only it's not the only way a crypto asset could be pulled into the definition of a security. You could tokenize an equity security, and that's going to be a security, but you're not analyzing it through the Howey test. The Howey test, I think the concept is good. So the Howey test arises from a Supreme Court decision in the 1940s. It was analyzing whether or not if you sold pieces of an orange grove along with a contract that would promise that the issuer of that security would do all the work to maintain the orange grove and you would just profit from it. The Supreme Court interpreted investment contracts to encompass that transaction, which makes sense, right? You're handing your money over to someone else, relying on the efforts of that other person, and then you're benefiting from that. So we would want that to be captured by the securities laws. In other areas where we've applied the Howey test, is sometimes a little bit messier. And I would say crypto is actually quite messy because you're actually not typically dealing with a contract. You're dealing with someone out there saying this token is going to go to the moon. And then we grab hold of that statement and we say, investment contract. And I mean, I think that's a bit of a stretch, frankly. And so it will be helpful to have legislation where Congress tells us this is the type of crypto transaction we want you to pull in. But we can do some of that through rulemaking, and we're doing that. We're working on that.
So you mentioned legislation, and can you talk to us a little bit about the interplay? Because there's bills on the Hill, or on the House side, there's some proposals on the Senate side. You've got the president's working group that's focused on crypto, your own. I mean, there's sort of like a lot of cooks in the kitchen. How do you sort through all that, and how does the commission sort of navigate that?
Well, so the cooks are, sort of talking to each other, and maybe there's a little bit of squabbling, but mostly we're getting along. So the president's working group report was something that we were very involved in. We've been providing technical assistance to the Hill, and then we've been working closely with our sister agency, the CFTC, as well. So the idea really, I think we're all sort of aimed in the same direction of trying to figure out who's got responsibility for which pieces of this. Where are there areas where Congress might want to give us more authority? Right now, there's not a regulator for the spot markets. And so maybe Congress wants to create a regulator there. It seems like the CFTC will be the regulator of the spot markets. Although, we think if things happen on a platform that we already regulate, there's no reason we can't regulate that activity as well. So I think just figuring those things out. It is complicated. The Clarity Act is the House version of the crypto legislation for the market. It's called the Market Structure Regulation, which really does things like figure out who has to be regulated, when is something a security or not. It's very complicated to write legislation like that, and I think it's not a surprise that it's taking a little time to get the Senate to get their version and then to come to agreement. But I do expect that to happen.
So you mentioned that the SEC has broad exemptive authority, and I think there's been a concern among participants in the crowdfunding space that as the SEC and others start to look at the regulation for crypto, that there might be some sort of regulatory carve-out or some sort of free pass or something that would allow the crypto industry to move ahead sort of at the expense of the others, because capital goes where there's the least friction. And so the question sort of has come up, is this a potential risk? Is it an opportunity? There's an opportunity where perhaps the Reg CF platforms, the broker-dealers, are the required venue for ICOs in the future? And then finally, the question is, what can an organization like CfPA do to sort of weigh in on the processes of these rules as they unfold?
Yeah, well, to take the easy question first, you can weigh in by coming to talk to the Crypto Task Force, or you can write a written submission, crypto@sec.gov is our email, but there's a crypto webpage on the SEC website that you can go and find all kinds of information.
And we actually have been submitting some things. So.
Perfect. So that's the best way to do it. We're happy to talk to you. I think the questions around regulatory arbitrage are fair, right? We have a lot of exemptions now, and Congress keeps adding exemptions in part because there's a real fear that we don't have good ways for companies of all sizes to raise capital, and there are problems with each exemption, right? And so sometimes rather than adding something new, rather than fixing something that's there, you might add something new. And I think that we'll see what happens with the legislation, but it's not surprising to see Congress thinking about ways to make sure that people who want to do capital raising in connection with crypto can do it in a way that makes sense. That said, a lot of other people have suggested, well, you could take Reg A or you could take Reg CF, and really that is a way that people could do these offerings. Maybe we need to make some tweaks to Reg A or Reg CF to make that work. But it's certainly something we're open to, and I think it's how we're sort of thinking about things at the agency, trying to think about how these pieces all fit together as we write our own rulemaking. So those are very fair points to raise.
Okay. So CfPA has actually taken a strong position on one particular area, where we state that the exemptions really should be focused and used for capital formation. And one of the areas that came out recently was there was a company that was talking about using or launching mirror tokens within Reg CF. And for those of you not familiar with it, these are tokens that sort of mirror or reflect the performance of a private company, and they don't actually have any, there's no underlying sort of, there's no underlying asset that actually attaches to. It's just really reflecting the performance of the company, and there's no, really not a penny that goes to those companies that they're, quote, mirroring. So we see that there's a lot of counterparty risk potentially. We see that there's confusion potentially with consumers. So the association has come out sort of against the thought of mirror tokens being launched within Reg CF, because again, it doesn't lend itself to capital formation. Do you have a perspective on these sort of mirror tokens that are out there?
Oh, sorry. I think people are trying to figure out how to give retail investors access to all kinds of new things, new asset classes, right? And so whether that's private companies, whether that's hedge funds, private equity funds, private credit. So I think there's a lot of thinking about how to do that. And then there's a separate conversation around tokenizing things. And then there's a separate question around what's happening in the CFTC markets, which is there are a lot of new markets being created for all kinds of things. So all kinds of event contracts. So that is really outside of our space. But then when you start talking about things that are related to company performance, I think the questions around what that thing actually is are complicated. And I think people offering those products need to be very careful, because it is quite easy to get into the bucket of providing offering a security-based swap, which has all kinds of regulations that go with it. And so I guess I have a message for people who are interested in doing these kinds of things. Come talk to us before you do it, and then think about what it is you're creating, and make sure that you are complying with the rules that apply there, and that you're also disclosing to the purchaser of those things what it is the purchaser is actually getting. Because as you said, if you're not getting an actual share in the company, that's something that you would want to know. Do you have a right to any kind of dividends from that company? These are things where if you don't disclose it right, people could be confused. So I don't think it's my job to take a position in terms of the merits of these products, as much as to say we need to figure out whether they fit within, what bucket they fit within, and then who regulates that bucket, and then what the regulations are that flow from that.
Thank you, that's good. So Chair Atkins, he's talked about creating sort of an enabling environment for something he calls super apps. And this is something that we're hearing more and more about. Can you explain what those are? Explain what a super app is in terms of...
Yeah, I mean, a super app is really just the ability to go and buy a range of assets through one app that you get through one provider. And so it's a recognition that people are interested in buying crypto. They're also interested in buying equity. They're also interested in buying debt. They might want to buy futures, options. And so the ability to have access to all of that through one app. And then I think there's another piece of it too, is we have a very complicated regulatory system in the US. Lots of federal regulators, lots of state regulators. All of us regulators have limited resources. And so it really doesn't make sense to have one entity subject to multiple regulators if one regulator could do the job. And so I think that's another piece of thinking about the super app concept is to avoid duplicative regulation.
A couple more questions. Someone asked about what's the likelihood of making the 34 Act less onerous, that is, including sort of moving to semi-annual reporting.
Semi-annual reporting, that concept is definitely out there. The president has mentioned it, and so it's something that we're looking at. You know, the question is, even if you made it optional to do quarterly reporting, would investors demand it? But even if investors demand it, is there something that we can do to make it less onerous on companies to do the quarterly reporting? And then more generally, is there something that we can do to address the concerns that it's so costly now to do reporting as a public company, that many companies choose not to go public? It's not only the cost of the reporting, it's the distraction, it's the potential for litigation. So I think we are looking at ways that we can really assess the buildup of rules over time and see what needs to go and what should stay.
Question is, comes to the likelihood that the SEC will change the reporting requirements for inception companies. Now, this inception company is a startup company. Sometimes in Reg CF, it just may even be an SPV that's holding shares of the crowd. So, but they still have to go through an audit. They still have to sort of be held to. So is there possible that the SEC might reduce the requirements on that?
We're open to that. I think scaling requirements for companies of different sizes and types was less popular in the last several years, but I think it's something that we have the ability to do. I mean, we talked about the exemptive authority of the agency. That I think that's why Congress gave it to us, to think about the unique circumstances that different entities face. And so the idea of letting companies scale into the full set of requirements over time makes a lot of sense.
Okay, so we're going to do something a little different this year than we did last year. We're going to play a game with the commissioner. It's called Reg or Ruse, where we're going to ask the commissioner, we're going to make a short statement, and the commissioner can tell us whether this is really a regulation or it's a ruse, fake news. And so we'll get to test to see how sharp the commissioner's regulatory instincts are. And so 3 questions to go fast, and after that, we'll turn over and we'll have questions to the audience, if that would be okay.
Are they going to be able to test me also?
No. Life is a test, right? So the first one is called the Pinky Promise Provision. So under Reg CF, a non-accredited investor, which is someone 18 years older, can invest as much as they want as long as they pinky promise that they've read the Form C and they definitely understand the risks. So is this a reg or a ruse?
Well, I think that is a ruse. I think there is some value to having that kind of an option for people, right? If you read the disclaimer that says you could lose all your money, if you choose to put all your money there, why not? I think we're a little paternalistic, but anyway, I don't think it's the rule now.
So, right, it's not. And I would say there is another part of that, which is a bit of the ruse. That is, there are limits, of course, so the next one we call the $5 million ceiling and counting slowly provision. So under Reg CF, companies can raise up to $5 million per year, or 5.2 if they include a really inspiring video on their offering page that has ukulele as background music. So reg or ruse?
If you hadn't put the ukulele in there, I would have bought it. But
so actually, it's a ruse because there's a hard limit on the $5 million per year that we're allowed. Now, CfPA is advocating for $20 million. Any chance that might happen?
we have inflation, right? So people argue you need to raise those numbers. We'll see.
Okay, great. So I see some audience applause on that one. So number 3, and this will be the last one. So far, the commissioner's 2 for 3. Let's see if she can go 3 for 3. Funding portals are allowed to host investment opportunities, but they can't actually encourage anyone to invest. So someone said it's like being a realtor who can show you around the house, but isn't allowed to say, this is a great neighborhood. Is this a reg or is it a ruse?
I have to say that's a reg.
That's a reg. Indeed it is. So portals can display offerings, but they really can't pitch or recommend them. So,
and that is something that we do hear about, that people would like the ability to do more curation.
Okay, so so let's give the commissioner a hand for 3 out of 3, right? So with that,
now the audience comes, and this was just warming me up.
This is warming you up. So now we have questions from the audience. We'll go to the back of the room for the first question.
The SEC has oversight of the Public Company Accounting Oversight Board. Saw where they weighed in on their compensation levels, and it looks like the board's going to reduce their comp by 20%. A big issue now are middle market accounting firms don't want to do PCAOB audits for going public companies because of liability exposure, partially due to the experience they had with the SPACs. Is there any chance to see S1s revert back to a GAAP audit standard from requiring a PCA would be. Is that one of the things that, as you handicap it, a potential possibility?
I mean, I think it's really more likely that we will try to address the problems that at the PCOB, which would then make it more likely that auditors would be willing to serve that population. But it's a problem, and I agree with you, and I think we need to think about what makes sense there. Your suggestion is an interesting one. I have to think about that.
Commissioner, thank you so much for your insights. Question, comment, just reflection with regards to the criticality of the work that you and your team does. Any chance, remote chance, of your work being deemed essential and not being impacted with shutdowns such as the ones that we're experiencing right now?
I mean, I'm allowed to work, and so I have no restraints. But I think the people in the building who are actually doing the work on a day-to-day basis of reviewing registration statements, of providing guidance to people, that work I don't think is going to be deemed to be essential, though I view it as quite essential. You know, I think we need to just reopen the government to get this stuff going again. You know, we did try to do what we could do in terms of IPOs can still go forward, but people like to get the feedback of the staff and the comments of the staff. So it's a hard time, I think, for a lot of people to figure out what to do.
D.W. Farrell with booming voice, I guess. Sorry about that.
But I have no idea where you are.
Right over here with localfund.org. And my question is about revenue-based financing. And first part of the question is, and I've, speaking with attorneys, found disagreement about the oversight body for revenue-based financing. And then the second part of that is it always a security, or is the answer, it depends?
Well, sitting up here, I'm definitely going to tell you it depends. I'm not going to give you legal advice. But I do think that, that's the kind of issue that you should engage with our small business advocate on that issue. Not now, because the small business advocate is not working. So I should say, actually, our small business advocate just stepped down. So that spot will be coming open, and it's something that people who are interested in the policy issues for small business capital formation should think about. I don't think that we've started soliciting applications yet, but that's an area that people should think about. There is some good information on the website from them. I don't know that they address that specific question, so I would say that's one that it would be worth having the conversation about. And the facts and circumstances always matter on these kinds of things, so you do have to be careful.
Okay, thank you very much, Commissioner. I just want to actually refer to a question that Brian asked that I think got lost a little bit in translation. It was referring to the ICOs. So with the new laws that are coming through, it could be perceived that the new Stability Act will allow companies, early stage companies, to raise capital by issuing tokens that are not backed by equity, just on the promise of being some sort of credible currency in the future. Was I right in understanding that there is the potential for that? Because that could be quite catastrophic for the crowdfunding industry if all you got to do is pitch a token.
So the legislation is not fine. I mean, there was a House bill that had the provision that I think you're referring to. The legislation hasn't been finalized yet, so we will see. I think the point that you're raising, though, is an important one. People need to understand when they're buying a token what they're actually getting. You can create a token so that it's an equity token, and you could sell a piece of a company using a token. Many tokens that are out there are really giving you the ability to use the network. It gives you the coin of the realm for the network. And that is something that's very different. You're not getting a piece of the company that the developers who built the blockchain own. And so I think it really does point up the importance of underscoring the difference between owning equity in a company and owning a token that doesn't give you equity in anything. And I think part of the confusion has really come from the fact that the SEC was consistently saying, well, these are securities, without really addressing what the economic rights were that went along with that thing that you were buying. And I think we actually added to the confusion. But I don't know where the legislation will come out. I think there is definitely interest in Congress in making it easier for people to raise capital. But again, the people who are buying the securities need to understand whether they're getting equity securities or not.
I think we have time for just one more question.
Just a quick question. Something that I hear from a lot of investors is they would love to be able to invest in a fund, a venture fund. But unfortunately, under Reg CF and even Reg A, it's pretty much impossible to be able to do that. Is there anything being done to encourage diversified investment products for non-accredited investors?
I mean, that idea does come up periodically because obviously everyone who's involved in this area knows that a lot of companies run by well-meaning people don't actually end up succeeding. And so diversification is one way to address that problem. So I think it's an issue that's definitely worth thinking about. I'm going to make one more comment because I spoke yesterday to one of the members in the audience who actually wrote a paper on crowdfunding. It's an interesting paper, and one thing it suggests is that a lot of issuers are not actually complying with their disclosure obligations. And so I think to the extent that you all want changes, one obstacle that will definitely arise in asking for any of those changes is, are people complying with the rules as they're written now? If they're not, it's going to be a barrier because colleagues who are concerned rightly about investor protection first and foremost, and capital formation is sort of a secondary. I wouldn't say secondary, but they're worrying about investor protection. If they're seeing that the industry is not complying with rules, it will be a problem, an obstacle to getting changes that might make sense, such as the one you suggested.
And thank you for that. What the commissioner is referring to is that many of the companies that are issuers who have filed, when they have an obligation, excuse me, they have an obligation to file a Form CAR every year after they've done their crowdfunding raise, and some of them aren't bothering to do that. And so I think that the compliance, that there's Professor Burke here who's done some research on that, and so that is something we've had some seminars and webinars in the past, CfPA has, to encourage and make that people aware of that, but I think it's something we can do more on the education front. So thank you for bringing that up.
Yeah, I don't want to end on a negative note, but I do think there is appetite for making changes, and so let's put ourselves in the best spot possible to be able to have those changes.
Thank you for that. So everyone, let's join me in giving a round of applause to Commissioner coming in.
Thank you, Brian.
Thank you so much. And we're going to do our thank you. And hopefully we won't make you sprint up the stairs next year. All right. So we're going to do a group photo, and Commissioner Peirce has generously agreed to stay. So we're just going to come up here and get arranged. The photographer will get us arranged, and we'll take a quick photo.
We need to move the banner.
From Capitol Hill to F Street's light, we gather where ideas take flight. At the summit, we're writing the code for the future of Capitol's road. CfPA stands strong.
if you are, okay, I'm gonna say 6 feet and tall, back row, or 5, 10 to 6 feet. Side.
From Capitol Hill to F Street's light, we gather where ideas take flight. At the summit, we're writing the code for the future of Capitol's road. See, they stand strong and clear, uniting the dreamers gathered here. Voices rising, vision spun, the crowds are power. Professional association, we're the builders of a brighter nation. From Capitol Hill to F Street's light, we gather where ideas take flight. At the summit, we're writing the code for the future of Capitol's road. CfPA stands strong and clear, uniting the dreamers gathered here. Voices rising, vision spun, the crowds are power. We act as one. We are shaping the future together. Storms may change, but our bonds hold forever. Innovation, trust, and might will light in the dawn of investor rights. At the summit, we raise our aim. Came trapping now has a brand new name. From passion to policy, heart to purse, we're rewriting the story, verse by verse. From dealmakers spark to king's crowd's view, we measure what's bold, we build what's new. DNA drives the message clear that the people's capital starts right here. With purse at the table, the SEC its voice, guiding our growth, defining our choice. From impact investing to blockchain's thread, the crowd funds hope where angels tread. At the Professional Association, we're the builders of a brighter nation. From community to regulations, art. Every rule begins with heart. We are shaping the future together. Dream by dream, it's now or never. From DC's halls to Main Street's verse, all rise with CfPA's universe. We're shaping the future. The summit's our song. Together we build it where all From Capitol Hill to F Street's light, we gather where ideas take flight. At the summit, we're writing the code for the future of Capitol's road. CfPA stands strong and clear, uniting the dreamers gathered here. Voices rising, vision spun, the crowds are power. We act as one. We are shaping the future together. Storms may change, but our bonds hold forever. Innovation. F streets light. We gather where ideas take flight. At the summit, we're writing the code for the future of Capitol's Road. See, they stand strong and clear, uniting the dreamers gathered here. Voices rising, visions spun, the crowds are power. We act as one. We are shaping the future together. Storms may change, but our bonds hold forever. Innovation, trust, and might will light in the dawn of investor rights. At the summit, we raise our aim. Came traveling now has a brand new name. From passion to policy, heart to purse, we're rewriting the story, verse by verse. From dealmakers spark to king's crowd's view, we measure what's bold, we build what's new. DNA drives the message clear that the people's capital starts right here. With purse at the table, the SEC its voice, guiding our growth, defining our choice. From impact investing to blockchain's thread, the crowd funds hope where angels tread. At the Professional Association, we're the builders of a brighter nation. From community to regulations, art, every rule begins with heart. We are shaping the future together. Dream by dream, it's now or never. From DC's halls to Main Street's verse, all rise with CfPA's universe. We're shaping the future.
The afternoon with this panel on impact investing and crowdfunding. Jenny, of course, an expert in this, with Eve Picker and Devin Thorpe. Jenny, I'll let you take it away. Here you go.
Thank you. So, in full disclosure, I am currently doing a raise on Eve's platform. And I have to say, it's been an amazing experience. Let's see, let me find my document. My computer crashed. Okay, here we go. Eve is the founder and CEO of Small Change, a funding portal which opens the door to socially responsible real estate funded by everyday people. Her goal is to help build better cities by everyone, everywhere, through small change. And Devin Thorpe is the CEO of the Supercrowd Inc., a public benefit corporation that helps social enterprises and community-focused businesses raise capital through crowdfunding. He has been actively involved in the crowdfunding and impact investing space for over a decade, working with numerous issuers and investors. So, question for Devin. Why do you think crowdfunding is an important tool for impact, and how does that play out in your work?
Well, I love crowdfunding as a tool for impact investing because it opens it up to everyone. And, you know, I love Eve's portal. Oftentimes her deals start at $100. I love that because that's genuinely open to a lot of people. One of my favorite portals for investing for impact is Climatize. And their minimum investment is always exactly $10. So it is literally anyone. I mean, you can be a barista working at McDonald's. I don't care where you're working. If you have a job, you could allocate $10 a month to your impact investing portfolio. And you say, well, what's $10 a month? $10 a month over 5 years gets to be real money. And if you reinvest all the proceeds, it starts to really compound. So it really matters. So it's an opportunity for everyone to participate. I love that. And I see the impact is just huge, right? We see it in what Eve is doing. Eve screens so carefully for impact in every aspect of what she's doing, you know, helping you. But your work in this space has always been very focused on supporting especially diverse women. which Eve loves, which I love. And so what we see is an opportunity for all of us to support diverse founders, whatever they're doing. And so I've invested in all kinds of sometimes feeling like crazy businesses that don't necessarily align with my interests, but I see there's an opportunity. It's a valid business supporting a diverse founder who wouldn't otherwise have a shot. Disadvantaged going to the bank, disadvantaged going to VCs, and I get to play. That's why I love this space.
Eve, why did you decide to launch an impact-driven investment crowdfunding portal?
I think it was a crazy moment. I was a real estate developer in Pittsburgh, building a small and I think very impactful real estate portfolio that mattered to me. And there were a lot of people rooting for my projects. They were very, very difficult to finance. Really, my equity partner, if you want to call it that, was the Urban Redevelopment Authority. There were no private investors for my projects. And even banks were very difficult to convince because, first, I'm a woman. And secondly, the projects that we're doing were not something they'd seen before. So when I heard about regulation crowdfunding, I thought it promised the opportunity to open doors for developers who haven't had the opportunity for whatever reason, and also for investors to invest in the places they live in. So just to give you an example, I would back up and say cities are built by developers who get the same equity funds invested by the same people over and over and over again, and they look the same. And honestly, they're mostly old white men. So they're investing not because they want to make cities better, but because they want to get a return on their money. And then the banks follow them. And in order to get a loan with a bank, you must get an appraisal. And you can't get an appraisal if it hasn't been done before. So what you see on the streets of our cities is really the result of equity investment by the same people over and over again. And I really wanted to change that with small change.
I absolutely love that. I have a master's degree in city planning, and it really is amazing how ugly and boring so many of our cities are because developers who are purely profit driven are just going to do whatever's most simple and repeatable. And
I'm not sure it's even the developers that are profit driven. I think it's
the money, right?
It's
They're
the money
beholden
behind
to
it.
the money. It's all about investors come first. And if there's any benefit to other stakeholders, that comes second, and we're lucky to get it. So one thing about crowdfunding is it allows us to, obviously we want our investors to do well, but we want all of our stakeholders to be taken into account and cared for. So, Devin, you are an expert on storytelling for issuers. We heard earlier that it's so important for the issuer, and not just the company, but the individuals involved with the issuer, the leaders of the issuer, to really connect with people for them to be able to raise money and have a successful crowdfunding campaign. So how does an impact story affect issuers' ability to reach their funding goals?
I think fundamentally, one of the things we see in crowdfunding is that it's somewhat different than other aspects of the market. The impact oftentimes is a big advantage. If you're talking to a venture capitalist, a traditional angel investor, oftentimes if you hint at impact, they view it as some sort of a tax and they run. They run from the room. Oh, thank you for coming. Thank you for sending us your, the door is closed before they finish the sentence. And in the crowdfunding space, you're reaching out sometimes to people who don't even know you. And the opportunity to start with the impact can instantly hook an interest and bring someone to the table before they've ever heard the first word about deal terms, structure, and opportunity. With that said, I have to just compliment Eve on her website because she does, I think, just the best job of all the portals. And I love crowdfunding. I've invested in a lot of portals. Nobody does a better job of identifying the impact and the return potential than an offering on her website, which I just love. So it's just great.
Can I do that? I don't know if James Murphy's in the room because I'm really scared of FINRA.
Yeah, but I think that's the great advantage of crowdfunding is you can, and I think should, start with the impact. How does this make the world a better place? And I know some of you are coming and thinking, well, my business doesn't have any impact. And I beg you to step back. I'm not asking you to greenwash. I'm not asking you to pretend, but take a minute and think genuinely about how your work might benefit the community where you're located. Take a minute to think about who you're going to employ, how your customers will use your product or service. I suspect that there's more impact there than you think, and it may be quite genuine, and I encourage you to leverage that in your storytelling.
So that, we talk about return, and somehow people have in their minds that return on an impactful or sustainable project is going to be less. That is not necessarily the case. We have one developer who's listed multiple projects on our site, and they share the return absolutely equally with every one of their small investors. What they get, their investors get. And I don't think that...
Is that me? Oh, no, it's not me. I give more to my investors than I give to myself. Sorry. Go ahead, Eve.
And so I think we shouldn't gloss over that sometimes they're very generous returns.
Yes, you do need to invest in me. I'm definitely soliciting it.
So let me be explicit because I'm not offering anything. I don't have a portal. I'm not working for Jenny. The great thing about impact investing is you can, in the crowdfunding world, I think pretty easily, on a risk-adjusted basis, beat stock market returns. I believe you can do it. I believe I'm doing it with my portfolio. My portfolio is a little young to prove it, right? I've got some equity investments that are 3 months old. We don't know, right? But I'm convinced that in the crowdfunding space, you can, and I certainly see if you did a debt-only portfolio via crowdfunding, you could match the returns of the stock market, and I think you could build a portfolio with less risk that would perform better in a recession, perform better in good economic times. I think it would be a better portfolio all around.
I have a question for Eve. What still needs to change for regulated investment crowdfunding to reach its full potential to create positive impact in our world?
I made a list. It's not complete. I could go on, but these are some technical changes. So I think the $125,000 cap, for those of you who know this in the room, under $125,000, an issuer can self-report financials. Over $125,000, and they need to go get a third-party financial review, and that's insane. So I think that needs to change. The advertising rules are incredibly difficult for issuers to understand. We do our best to explain them, but I honestly don't know how they stay on the straight and narrow.
I actually just broke them a couple minutes earlier.
Oh,
I'm a lawyer.
I was trying to tell you that. So they're very, very difficult. I think, it's just very difficult, and it really should be simplified. There's something in these rules that require every single raise above $125,000 to attach a financial review, a third-party financial review, or a third-party audit. In real estate, typically, companies are inception companies. They haven't done any business. So these poor issuers are out there getting financial reviews of nothing. They haven't even opened a bank account yet. That's craziness. I'm sorry. That's craziness. And all of these things slow this business down, all of these really silly requirements. The regulatory burden on funding portals is huge. We're all small businesses, and it's like having a business on top of a business. It's really a lot. It's expensive and time-consuming, and none of us can really afford it. So, and I have to ask, why can't I invest in the offerings on my platform? Why can't my husband invest? He's seen as an extension of me. Or my employees, that is kind of crazy. Is it because we're giving a fake stamp of approval? I don't know, but I spend a lot of time looking at these projects, and I would really love to invest in them. And then I think probably the biggest thing is investor education. Again, we're all tiny businesses. I mean, no one knows about regulation crowdfunding. It's just a minute number of people. And how's the world going to talk about it? Like, media doesn't care about it. Like, I do. I'm the media. I need a New York Times story that gets out to millions of people, and they won't write about it. Like, so how do you educate people on this possibility when no one's really talking about it in a very large way?
No, you're right. It is a problem that the audience is small, but that's why I'm on the mission I'm on, right? And so I'm looking around at this room and saying, if you agree with Eve that you think that this ought to be a bigger story, follow my work, support my work, because we're doing the mission she's looking for, right? Expanding the audience. If she's got an issuer, that issuer is invited to be on my show. My show goes out, reaches tens of thousands of people every month. That's what we're talking about, trying to grow this audience, and that's how we can help do that. I'm the vehicle. I mean, I hate to make this about me for a minute, but here's where I play the role. Here's how I help Eve and Jenny with their offerings. Jenny's been on my show, I can't count how many times.
Actually, I have one more,
it.
and this is a really big one. And I think that the regulations that don't permit Reg CF issuers to solicit or to talk about their offerings in the same way that someone listing a 506C offering can talk about it are going to kill Reg CF. I really think they are, because I don't think that accredited investors will ever take Reg CF seriously unless they can have the same sort of conversations that they have with issuers for 506C. So I think that's a really big problem.
I'd love to open it up and see if anyone has questions or comments. I'll just quickly say, as you're thinking about something you might want to add, I've been in the world of impact investing for quite a long time. And when I think about impact investing, my number one tool for that is crowdfunding, because it's just so much easier for the folks who are raising money to design their offerings in a way that really fit their particular mission, goals, plans, values, projections. You know, they don't have to fit into a cookie cutter model that the funder creates. If they have good advice, they can design something that's really going to increase their chances of survival and making sure that their investors are well paid. And then with a lot of these organizations that call themselves impact investors, a lot of my clients chase after that money, and then sometimes they find that the impact investors aren't as friendly as their websites might make them look like they are. They often have lots of upfront fees and costs to even just be considered. The cost of capital can be quite high. So unfortunately, the world of impact investing really has a long way to go to be able to touch a lot of the businesses that can make really positive impacts. And whereas crowdfunding, we have everything we need right now to make it happen. So yeah, does anyone have anything they want to contribute, stories you want to share, questions?
My name is Tyre Shivers, Legacy Wealth Capital Group. I am local to Maryland, Baltimore, D.C. area. Yesterday, I attended a conference held by one of our larger PE firms in this area. 1,100 small businesses were there. They talked about bootstrapping. They talked about grants. They talked about loans. Of course, the major banks in the area were here. Every room that I went in and brought up crowdfunding, nobody knew. Or it was a negative comment from a VC saying that it was dangerous and that they're not sure that it has a place. The goal for me of broadening this message is I do happen to sit on a lot of panels. All of our counties have economic development centers. We have the chambers of commerce. So every conversation that I'm able to get in, every panel that I'm able to sit on, I'm talking about capital raising from a crowdfunding perspective. And I think if we all begin to infiltrate the grassroots and the organizations that are dealing with the small businesses in our states and counties, we'll be able to spread this message even further, not by having to recreate the wheel, but by being an auxiliary to what's already existing. So now I'm sitting next to the banks, I'm sitting next to the investment bankers, I'm sitting next to the PE firm saying, I'm not your enemy, I'm a partner, because there's a space for crowdfunding that can lend a business and help them get to where you want them to be, because sometimes they're just too small for you. They don't have the revenue. So let us help them at this stage, and then we can prep them for you, because all these businesses are looking for deal flow as well. And so we just become a part of the pipeline and the larger system.
So I just wonder, because part of where Devin comes in, which is really, really important, we need to do more of, is that you could do this and you could have people put up deals on all these platforms, but if the investors don't show up, it's not going to work. So that it's a two-sided platform. So I think like part of what we haven't really cracked fully is how to make sure that if someone puts up a decent deal, it gets. So I think if we can crack that, that's when it all opens up. And I've really thought deeply about it. I wonder if anyone has any ideas, like what Devin's doing a great job, but everyone else.
Yeah, you bring up a great point. I think we could really use some help from other players in the finance industry. For example, philanthropists, foundations, CDFIs, organizations that claim to care about making the world a better place and supporting small business. And there's so much that they can do. And I remember I spoke about this when I first became president. I talked about how this year is our year. We're going to bring in philanthropy. We're going to bring in CDFIs. And here we are. It's almost November. And to be honest with you, it hasn't happened. But we're going to keep talking about this, because I think when philanthropy does start to discover the impact that we have, and their money is going to go farther. And so the kinds of things I would love to see them do is co-invest with the community. That actually has happened to some extent on Honeycomb, but I would love to see them co-invest and maybe be willing to take a low or 0% return instead of asking to make the same return that the community investors make. They can afford to lose money. They're foundations. They don't need to make a return on their investments. And then loss reserves. They could create loss reserves where if something doesn't work out, all of the community investors, maybe those who are unaccredited, could get their money back. There's just so many different ways that these types of organizations could support our industry and help us be more effective. And it's not happening yet, but I think we will get there eventually. Yeah.
Hi, DW again. Thank you guys. I'll speak to one thing that our partners in Southern Arizona, Groundswell Capital and Aliados, and then a CDFI in Nogales, Nogales Community Development, they are doing the backstop if you lose your capital. And so how it's structured is the foundation put up a percentage, and then that took it to the state, and the state said, actually, we'll do the rest. So money going into our partner fund in specifically in the jurisdiction of Tucson actually gets 100% backstop if for some reason the underlying investments fail. So it is happening. But my question is about the structure. My organization is structured as a public benefit corporation, able to raise from angels, VCs, et cetera, but also the reporting. I'm really trying to push others to look at what happened with OpenAI, who started with the catastrophe structure of a corporation and a nonprofit. Meanwhile, over here, you had Anthropic and Claude AI that started as a public benefit corporation. OpenAI got sued each other, all that kind of stuff. Now they're moving to a public benefit corporation. Finally, you can have one board and a unified mission and model stakeholders in addition to shareholders, right? So what has your experience been with, there's a couple flavors now, Public Benefit Corporation LLC, Public Benefit Corporation, either Delaware or several of the states. But what has your experience been in that formation stage?
Yeah, I think I'm a lawyer. I work with a lot of public benefit corporations, Devons. Yeah, I think there can be a lot of benefit, but on the other hand, there's not a lot of teeth to the statute. So it's pretty easy to be somewhat of a bad actor and still be a public benefit corporation. So I don't know if it's a panacea. There is something that's becoming a little more popular these days, which is a perpetual purpose trust, which actually is much more protective of mission. Patagonia famously, the founder donated pretty much all his stock to a perpetual purpose trust to ensure that that business would stay mission driven for forever, theoretically. So I'd love to have a conversation offline about different structures that we can use to stay true to our mission. But I think oftentimes it's really the financing that dictates how mission driven a company stays. You could form as any type of entity in the world. If your investors are demanding high returns at any cost, the company's not going to stay mission driven if that isn't consistent with what they're wanting. So you have to set up with investors that not only are in alignment with your mission, but also so that the governance is such that they cannot control the future of your business.
But the thing to keep in mind, DW, is that setting up as a PBC does put your shareholders on notice that you have the option at every day to choose mission over profit. And that's really an important distinction so that you can tell your shareholders, sorry, we told you up front, mission first.
You're very right. That's a good point. All right, I think we're out of time. Thank you so much.
Okay, we'll move right into Community It's King. I think our moderator. Oh, 5 minutes?
From capital. From Capitol Hill to F Street's light, we gather where ideas take flight. At the summit, we're writing the code for the future of Capitol's road. CfPA stands strong and clear, uniting the dreamers gathered here. Voices rising, vision spun, the crowds are power. We act as one. We are shaping the future together. Storms may change, but our bonds hold forever. Innovation, trust, and might will light in the dawn of investor rights. At the summit, we raise our aim. Came trapping now has a brand new name. From passion to policy, heart to purse, we're rewriting the story, verse by verse. From dealmakers spark to king's crowd's view, we measure what's bold, we build what's new. DNA drives the message clear that the people's capital starts right here. With purse at the table, the SC sits voice, guiding our growth, defining our choice. From impact investing to blockchain's thread, the crowd funds hope where angels tread. At the Professional Association, we're the builders of a brighter nation. From community to regulations, our heart, every rule begins with heart. We are shaping the future together. Dream by dream, it's now or never. From DC's halls to Main Street's verse, all rise with CfPA's universe. We're shaping the future. The summit's our song. Together we build it where all From Capitol Hill to F Street's light, we gather where ideas take flight. At the summit, we're writing the code for the future of Capitol's road. CfPA stands strong and clear, uniting the dreamers gathered here. Voices rising, vision spun, the crowds are power. We act.
And Darren Marble from Going Public. Thank you all. Where's Shelley? Shelley around? Oh. Okay, Shelley Golan, who is from Potomac Growth.
Welcome to Community is the New Capital. We are so thrilled to have you all here today for this conversation. By way of background, my name is Maria Springer. I'm the founder and CEO of Capital Department. We are a fundraising advisory firm on a mission to open access to capital for all. To date, we've raised over $225 million for companies raising venture, and most recently, we've moved into the crowdfunding space, or what I like to call community investment round space. So with that, I'm going to pass it over to our panelists to each give a 1-minute introduction, starting with Shelley Golan.
Hi guys, sorry for being late. The networking was just too good in the other room. I'm Shelley Golan. I'm a co-founder of Potomac Growth. We are an equity crowdfunding marketing firm. At any given point, we manage between 30 to 40 campaigns. We work with many leading equity crowdfunding platforms, Start Engine, WeFunder, Dealmaker, always seeking to add more partners. And our goal is to provide the best possible strategy for our clients to be successful. I also, think it's relevant given some of the previous conversations that have been had on this stage. I also work at Mercury, which is a fintech So I kind of exist on both sides of the accredited, non-accredited investor aisle. And that definitely informs some of my thoughts on this topic.
Thank you, Maria, Shelley, Darren. Honored to be on the panel with you guys. Thank you to everyone at the CfPA for putting this event together as well, too. Privileged to serve on the board with you. My name is Jason Fishman. I run a marketing agency focusing on investor acquisition called DNA. We've worked with over 500 issuers and have collectively produced 9 figures of capital using content marketing, advertising, and outreach channels. I showcase many of the results on my podcast, Test Optimize Scale, episode 216 with Gregory Burke. Make sure to check it out. He talks about that study the commissioner mentioned, and try to be an open book in terms of the formulas we see working to effectively raise capital in this space.
Thanks, Jason. Thanks, Maria, Shelley, and the CfPA for having me. I'm Darren Marble. I'm the co-founder and CEO of Issuance. We're a white label online capital raising platform. We own and operate a FINRA regulated funding portal as a subsidiary called Issuance Express. We've processed about $400 million of capital over the last several years. I also produce a show called Going Public. It's like Shark Tank meets The Apprentice, where viewers can click to invest and buy shares in featured companies while they watch. We've put out 3 seasons of this show over the last 4 years, first on entrepreneur.com, then MarketWatch, and then earlier this year, our 3rd season was licensed by X. We've cleared about 100 million views across 20 episodes. The featured companies have raised about 15 million. And now we're looking to take it massively mainstream to platforms like Netflix and Amazon. Big believer in this industry. I've been in this industry since day one against my better judgment. So 10 years later, here I am, and it's great to be here with everyone.
Thank you so much. So we have 4 parts to the panel today, and we're going to start with the state of community rounds. Robinhood CEO Vlad Tenev recently said in a Bloomberg interview that the bulk of interesting investing opportunities are in the private markets. He also said that one of the greatest inequities of the capital markets is the lack of exposure for private retail investors. We're all here today to mobilize millions, billions, and I hope very soon trillions of dollars into this industry. So with that, let's start with Shelley. What does community as the new capital mean to you?
It literally is new, right? The access to retail investment is barely 10 years old, if that, a bit less. I think that it actually is more about agency to me. Community as a new capital is about providing the agency to formally to an entire population of folks that formerly were locked out of opportunity in this type of investment category, and giving them the agency. And our responsibility is to provide the education as well on if they choose to participate in this type of opportunity. And conversely, it provides agency to founders and capital raisers who are now having additional options other than the traditional VC route, which has a lot of cons in addition to the pros. And so it allows for them to have the agency to decide if they have an alternative, which is, could be retail investment, equity crowdfunding, community rounds, whatever we decide to call it by the end of today.
So Jason, with that, why should an issuer or startup even consider building a community of investors and evangelists?
Question I ask a prospective issuer group that is going to be going down the Reg CF, Regulation A Plus path is, how large is your audience? I then want to audit their marketing channels and see how engaged that community is. I talk about the formula that I've been able to identify, not just in our campaigns, but campaigns in Issuance, campaigns that Potomac runs, industry-leading issuers. And it's that first tranche brought in by their community. It's the social sharing that occurs from individuals who invest. Actually, Eitan mentioned earlier that only a percentage of the investors come from advertising. I've tracked about 20-50% from pixel data, and it's the social sharing that occurs afterwards. It's me telling my brother, hey, you should check this company out. It's me sharing at a golf course, hey, I just invested in this company. It's that growing community, and you want to put content out there to give them ammunition, to form the narrative, to make it easy for them to share. I even use that as a gauge for the content of not only is the audience going to understand this, but it's going to be easy for them to present it to the people around them. It then gets into traffic sources, just to wrap that up, where you are looking at publishers, financial email letters. Hey, how large is their community? How loyal, how responsive are they? How can we start to tee that up towards the traffic projections and the individuals that we need to get to the offering page by the time we're looking to measure our next milestone?
Thank you, Jason. And with that, Darren, what's driving the growth of community investment rounds right now?
Look, I don't know that it's growing like a rocket ship. There's going to be $1 billion raised this year. And, I think Chris had a slide earlier. Maybe there's been 6 or 7 billion raised between Reg CF and Reg A Plus over 9 or 10 years. I think there's a lot of room for growth. I think what will drive the growth of this industry is delivering returns to investors. That's the number one most important factor for the growth of this industry over technology, over audit, legal, anything. Investors have to earn a return. If this becomes ICOs 2.0, or every deal takes 15 years to see a return, there will be no more billions raised. And so I was on a call with the Robinhood Corp Dev team the other day. They see this industry as having a supply issue. They're looking for like a rocket mortgage for equity crowdfunding. Can you launch a Reg CF in 2 days? Maybe not, but that's what they want to see. But they also said, our users are interested in SpaceX. They didn't talk about $1 million a year revenue company. So I think collectively as an industry, we have to work to educate the A16Z backed companies and bring them into the fold now more than ever. And it's starting to happen. It needs to happen more. We need the highest caliber founders to offer securities in their company to their customers, fans, and followers, where the small investor has a real shot of earning a return. That's what I think will ultimately drive the growth.
Thank you, Darren. I couldn't agree more. In fact, over the short history we've had at Capital Department, we've had the privilege of working with a number of VC-backed founders to raise community rounds. And with that, we've learned that storytelling, part 2 of the panel, is really essential. So how do you craft a compelling, inspiring narrative that's going to move capital?
I've always been a big believer in storytelling. And, I think on one level, you can start with vision, mission, and values and the investment return. I've been spending the past 10 years thinking about storytelling, but even more importantly is distribution. So our goal is to get an interactive investing show on a platform like Netflix or Amazon or CNBC or Fox. And to me, this is an inevitable future. You are going to see 10 to 15 shows on these platforms in the next 5 to 10 years. Whether we do it, you do it, someone else does it, it is going to happen. And I think that's the moment this industry shifts. And to me, the key isn't telling retail investors about Reg CF. When you go and buy a product on Amazon and you click buy now, and it shows up on your doorstep the next day, you don't use any language, regulatory jargon, you click to buy and the thing is there. That's how this industry needs to work. A viewer needs to know that they can invest. They don't care about the financials, but they don't care about the infrastructure. They want access to the deal. When the Jake Paul, Mike Tyson fight happened, that was one of the biggest television events in history. There were 65 million people concurrently watching that fight. 108 million people watched it at some point, one or another. Imagine if you had a show on Netflix where there's 5 million people learning about a startup and have the opportunity to invest. To me, that's a game changer, and that's what we're building towards.
Thank you, Darren. I also watched the fight. So how can founders, Shelley, this is for you, how can founders keep a narrative interesting over the course of a multi-month campaign?
I think the key is to have a strong start. You need to have a very strong platform that you're going to base your entire narrative arc over the campaign. That's a lot of the planning that we do at the beginning. We work with the founder. It's often very difficult for a founder to see the forest for the trees. And, when you're living your own story, it's sometimes takes an outside perspective to kind of sell your story back to you. And they're like, oh, wow, that actually sounds really cool when you put it that way. And so that's that type of hype and that type of crafting is a lot of what we do at the beginning. And then I think the second part to that question is you really need to time out the campaign as if it's a battle strategy. You can't send all your troops out at once because they're going to be exhausted by the time you're even at the middle. And so we look at all of the materials that we have. And by materials, I mean the content, any upcoming milestones, any new updates, anything that could be an exciting kind of element that will add to the story. And we try to save some for, the middle piece. We try to save some really cool stuff for the end as like kind of a big kind of finale push when there's a lot of FOMO, and most of a round's investment often comes in the last 2 weeks from what we've seen with FOMO messaging. So we have to think about how to space out the narrative to keep it engaging over the entirety of the campaign and not kind of put all the interesting stuff, front loaded at the beginning.
Brilliant. And Jason, what differentiates authentic storytelling and narrative building from marketing hype?
Well, you have your self-publishing channels, and you really want to capture your brand voice there. You really want to speak to the target audiences you've put together in your strategy. I think what takes it to the next level is more social proof and third-party validation. I could tell you how great my company is, but if you hear it from other places, it's okay. We should pay more attention to that. The same way I was talking about social sharing, the more we're able to point at these same parties, the more we hear the same information from the more trusted sources, the more we believe it. I think it takes it to that more authentic level. There's obviously buzzwords. There's stuff that's lengthy. I like to condense everything into a few words. There's something I model off of, the 3-1-3 method, where you break what you do down in 3 sentences, then 1 sentence, then 3 words. It has that refinement to it. To me, it feels like less marketing language, where if I get an email and it's 5 paragraphs, I don't even want to look at it. Maybe the glance test, and it has to pass through that. But the more notable figures, the more trusted sources talking about that, the more headline-worthy announcements that are coming out on a weekly basis, and going back to that staggered content and making sure there's enough movement that's occurring from there. If people feel like the campaign's not moving and you're just putting out more language versus every time you go back there's more raised, it's a completely different experience.
Absolutely. And so moving into our third section of the panel is all about execution. Jason, I'd love to dig in a little bit more there and ask, what do you think are the biggest misconceptions about what success will look like? And where have been some of the biggest surprises you guys have encountered?
Sure. Misconceptions. I was joking around about this with a few people today. I'll get calls all the time of, hey, I want to raise $5 million. Do I need 2 months or 3? And I look at the King's Crowd metrics, and it's okay. In the 2024 insights, there were 5 issuers that raised 4.8 million, let alone 5. Only 7% of issuers in 2024 and 2023 raised $1 million or more. I try to put this out there and really explain, hey, you need to put together a thorough marketing plan that determines how you're going to get enough visits to your offering page that with a high enough conversion rate at an average investment value, substantiate your goal in the different timelines. And don't just launch a campaign. Don't just see what happens. Don't look at the expenses of the marketing versus what you're testing. You could pause, stop tests, but really you want to scale them as you're optimizing towards the pocket's performance within those. But when I tell them how much traffic they're going to need for a $5 million raise, when I give them figures of 250,000 visits, even 50,000 visits per million, 2 million raised, and ask how they're going to get there, there's usually not a well thought out approach towards it. So I'd say that's one of the biggest misconceptions is it's easier to hit these full goals. It's easier to be one of the case studies that the service provider, the portal, the broker dealer you're working with are pointing to. Surprises. I would tell you that there are founders who are constantly working their network, calling people from 10 years, 30 years ago that they haven't talked to, going after various types of groups to get 100K investments in, 50K investments in. And then with that, seeing their ad performance, seeing the traffic that's getting there organically perform. Someone who comes to mind, Brad Larson, CEO of Avadain, here today, had a $5 million campaign that completed in May, 43 days. Also sold out as 4.5 million. Before that, his first taste towards Reg CF, 1.375. Always remember, he said, hey, I'm having these conversations offline. These are the home runs, and I need you guys to get hits all day long. And then, intentionally moving what's working and being able to scale it up from there.
Awesome. Thank you. Darren, over to you. How does community ownership change accountability for founders?
Whether you raise, from 5 investors or 5,000 investors, you as a founder are a fiduciary. You have to act in the best interest of your shareholders, period. It doesn't matter if someone's coming in for $100 or $1 million. You should really look at them as all the same. I think the benefit of having dozens or hundreds or thousands of investors is that you now have brand ambassadors. You have an army of supporters and believers, and not just to go out and ask them to buy more product or promote, but there's people out there that can help you in ways that you might not be aware of if you don't ask. So I think accountability is literally identical whether the second you have one investor, you're accountable, right? Whatever deal you do, equity or debt. But there's an opportunity with Reg CF and Reg A Plus in particular when you have hundreds or thousands of people on your cap table, or maybe they're in an SPV, it doesn't matter. I think best practice would be, a quarterly webinar, an annual event. And unfortunately, most issuers in this industry are totally missing the mark. And Chris proved it this morning. He said 10 to 15% of Reg CF issuers actually send regular communications to their investors. That's terrible. That's a disaster. All of us should be demanding from our clients that they communicate and treat investors with respect and update them and leverage them. And that's going to increase the likelihood of their success too.
Thank you, Darren. And finally, Shelley, what does excellence look like when you're executing a community round?
In 2 words, it would be relentless consistency. We want our founders to be relentless in activating their network, continuously retargeting folks, but they have to remain consistent. And I think that really ties into what Darren is saying around, the work for building community doesn't start and end with a campaign. I think most of the work happens actually in between campaigns. It's not that you should launch a campaign and then you build a community. You really need to be focused on building your community. And once you have that, then you launch the campaign. And I think a lot of founders get that mixed up. And especially if they engage with an agency, some founders have this expectation, well, we're paying you to bring a community. And it's like, that's not how it works. And so that you can't escape that. And I think, fundraising, no matter how you do it, will suck. And there's no way to pay your way out of it. Or, if I pitch to VCs, it'll suck less than crowdfunding. It's a sucky process. People want to be focused on building their companies. And so it's up to you as the founder to decide, what flavor do you want? What are you willing to commit? And what are your trade-offs? And so the relentless consistency is actually everyone wants to know what the secret sauce is. There is no secret sauce. Usually the secret sauce is a founder's individual commitment to completely and fully activating their network and their community.
I love that. Thank you. The fourth and final part of our panel today is about innovation in the capital stack. So maybe we will talk about AI. Financial journalist Andrew Ross Sorkin just published a book called 1929. He's on a massive tour promoting it. But in a recent interview, he said that innovation and speculation actually go hand in hand. And I think we're seeing that in the age of AI, institutional investors and retail investors alike are taking big bets. So let's talk about it. Where do you think the biggest innovation is going to happen? And we'll start with you, Darren. How will media and or other channels play a role in shaping the next generation of this industry?
I think what this industry needs more than anything is a new format. So the format since 2015 is a digital format. You drive your customers, fans, and followers to a landing page, and at the top of that landing page, there's a 2-minute pitch video, and under that, you have a paragraph about your business, and under that, you have a paragraph about your team, and boxes for your team, right? That format is stale and it needs to evolve. And I think the way that this industry becomes mainstream is with a new format. In my version of the future, that format is a massively mainstream show that is seen by millions and millions of people every single week, where viewers around the world and investors around the world can learn about a founder in a new format. They can learn about the founder's backstory. They can learn about the founder's pain and suffering of their journey. They can see that founder go through challenges, overcome obstacles. They can see how investors in the real world react to their pitch. Maybe it's not a show, maybe it's metaverse, maybe it's glasses, but to me it's a show. So I think the industry is needing a new format to take us into the future beyond that landing page that has been our home and our MO for the past decade.
Thank you. Jason, what bet should founders be taking?
What bet should they be taking? Well, something I say a lot is test, optimize, scale. And we have assumptions going in and you need to test it to see if it's working. What types of tests? What types of bets? I like pulling from other industries, seeing what's working and taking it to this conversation between issuer and investor. A lot more podcast appearances is something I would encourage founders now, and tapping into drum of different podcast categories so that you're reaching moms who invest, college students who invest, Robinhood investors who are looking for public-private placements, crypto investment. You want to be able to tap into all of these existing communities and then repurpose the content for your organic channels and your paid placements. I would tell you get more creative with your advertising placements. Look to run social ads from publishers, social pages, something we've been doing a lot more, seeing a lot more success. I would be saying constantly be auditing your competitors, other issuers, the top performing campaigns. Devin Thorpe features them on SuperCrowd quite a bit. King's Crowd shows you the top rankings all the time. Look at how they're doing it. If you could answer that question and incorporate elements into your model and take those bets on those channels, I think you'll find scalable results.
Speaking of scalable, Shelley, how do we make community investment rounds mainstream?
We need a better track record on returns. And I think that's just the reality. Right now, it is still a niche product because we don't have a track record of massive wins to get a broader population excited about it. And I'm a big fan of this model, personally. But until we have a track record, until the industry matures, and at this point, I think it's in a positive place because we've been through kind of a boom and we've been through a bust, and hopefully we'll go through another. So there's a level of resiliency and credibility that this type of investment is earning at this point. I consider all the folks who have done these types of raises to be the early adopters of this. And many of them are also getting a crash course in what, traditional VC returns would provide to an LP, which usually is about 7 years. So this is not unusual, but I think until this matures and we have a better track record, we'll be a little bit outside of the mainstream for a while longer.
Agreed. Before we open it up to maybe one or two questions from the audience, a little closing game. In 5 words or fewer, what innovation or breakthrough will bring millions of retail investors into the fold? Anyone can go. 5 words or fewer.
100x returns.
What was Brian's game of red or pass? Oh, this one's tougher. I would say investor success stories. Published mainstream.
More liquidity.
I'll add VC-backed private market deals. All right, so we have time for 1 to 2 questions.
So I have a question for everyone, but I want to give a special shout out to Jason, as we're both marketing agencies competing in the same space It is great working in parallel with you. You are always super helpful, and you've given us amazing advice over the years. And I think that that's really exceptional when you're sort of competing on similar services. Anybody can answer, but I want to at least have you start, if that's okay. So we're seeing a trend where all of a sudden individuals with a little bit of capital who are, I would say, hybrid investors, right? They are accredited, but have also played around in equity crowdfunding, are starting to try to get initiatives off the ground that they're providing some, let's say, more substantive funds in order to get things moving. I was going to ask you this privately, but I think it'd just be interesting to see if this is a trend or if I'm just imagining things. Are you starting to see this movement where hybrid investors who have a foot in both worlds are starting to sort of try to push equity crowdfunding into the next step? Because it's something I've been seeing since, let's say, July, and I've already had several interactions like this. So, and Maria, I'd also love to hear from you. Is this something that you guys are also starting to encounter on your platform? Are issuers sort of moving in that direction?
When you say hybrid, can you clarify?
Yeah, so we have several clients and are in talks with several more whose initial funding comes from somebody who's an accredited angel investor who also really likes the retail investing space. So they're starting to provide seed capital to equity crowdfunding opportunities. And I'm seeing this almost systematically at this point.
I'll take it. We raise parallel Reg D, Reg CF rounds all the time. One of the biggest raises we've ever done is Purette. We raised 5 million Reg CF, about 2.5 to 3 million Reg D, side by side in parallel on the same platform.
I look at the portals, the broker-dealer tech platforms as tools, and it's all a matter of how you use those tools. And as I was talking about the community rounds, starting with that anchor investor, lead investor, yes, I've had individuals, groups of investors approach me about a variety of portfolio companies and being able to serve compliantly as the lead anchor investor, give a testimonial, even in some cases, being used on the offering page, even advertisements, messaging. So yes, if you're being able to show that stamp of approval and get it to a certain point, there's the optics to it. There's the empty restaurant sensation under 100K. There's more attraction over 1 million, 2 million. The gap from 4 to 5 is obviously much different in sales. So I've been in chats around that for years. Some of them come to fruition, but I definitely anticipate more of it because it says something that they're putting in their funds and you could then invest alongside them.
Absolutely. And I think we're at time, so please give a round of applause for these wonderful panelists. Thank you so much.
Maria, thank you.
Okay, we're going to move right along, and we're going to hear from our platinum sponsor, DNA. Jason was it? Oh, okay. All right. Okay, Jason did such a great job. We've heard from him. Okay, so sort of continuing on the line of scale, panel here is Reg A to the big boards. Are we seeing crowdfunding be the new starting line for going public? Moderator Andrew Dix from Crowded Media Group and also on the CfPA board. Mark Lenowitz from Digital Offering and Aaron Shafton from Dealmaker. Thank you.
Awesome. Thank you very much. First of all, I would like to thank CfPA for actually inviting me to come here and participate. You guys are doing a great job, even better than last year. So it's it's great that you were able to put this together. And I want to thank everybody who has decided to stay here for the last panel of the afternoon. Usually those can be kind of thinly participated with, so I'm happy to see everybody here. We're going to talk about Reg A today, which is obviously part of the Jobs Act and has gone through some iterations over the years. We have two experts here. We have Mark and Aaron, and I'm going to ask Mark to start things off and to do a little, infomercial about who you are. And you've done a lot over the years, but maybe you can, share with everybody here what you're doing today.
So thank you, everybody. I'm Mark. This is my first time being here, and it's very interesting to hear all the different panels today. So it gives me good insight because come from a different side of the business. I'm an investment banker, 35 years now going since I took my Series 7. And my kind of claim to fame is I created the methodology for Reg A to trade on a national securities exchange. Back in 2017, no one took me seriously. FINRA didn't take me seriously. The SEC didn't take me seriously, but most importantly, the New York Stock Exchange didn't take me seriously. And so I went down and spent time with them and explained that this really is a great way to bring back the small cap IPO and really modernize the way capital formation occurs and to allow everyday Americans the same opportunity that we really left only to the Wall Street elite. It really wasn't what you knew, it was who you knew and what kind of allocation you got in IPOs. And we felt this could change. So we did the very first one onto the NYSE American, which is a company called IOMO. It ended up opening the doors. We did the next one onto the NYSE American. We've done numerous on the NASDAQ, and we most recently did the first one ever onto the main board of the New York Stock Exchange, which was just Newsmax, where we raised over $300 million for them.
Awesome. So I want you to know that I take you seriously. So I know that nobody else did in the beginning, but I always did. And I also like to mention that Mark he's really an OG. He's been doing this for a really long time. I know he looks youthful, but he's been through the ringer, and he's been around since like almost the Jobs Act. So,
Yeah, the very first panels I was on, I was the only regulated guy. Everybody in the audience were crowdfunding experts, but I think before that they were either cannabis experts or aluminum siding, something, I don't know. They kept evolving. Now they're all ICO and SDOs and whatever new.
Whatever. Yeah, something happened. Yeah. So Aaron, tell me.
Aaron Shafton from Dealmaker. We are a leading Reg CF and Reg A platform. For those of you who don't kind of recognize our name or what we do, we come from a world a little bit like Mark, some traditional finance, and we wanted a way for companies to raise online that was a little more sophisticated. Rather than listing on a marketplace, which is often applicable, can they a white labeled page that works better for leading brands? Can they run a more sophisticated online marketing campaign? So we are, we have the highest average deal size of any of the online platforms, and very, very committed to continuing to bring more established brands and companies into our really robust category. And I will say, because I have the mic and I haven't been asked a question yet, it is really cool to be here. We do a lot of these events, seeing this industry grow up. I know I speak for all of Dealmaker when I say we're very proud to be a part of this community.
Yeah, awesome. So Dealmaker is actually a really cool platform because you're kind of a later stage participant in this industry, and today you guys lead the space in Reg A offerings. I think you don't have to respond to that if I'm wrong. Just accept it. But no, you are a serious leader, and they're from originally Canada, so I won't hold that against them. But actually, what you guys have been doing is really cool. So kudos to what you've done for the industry, and so what you've accomplished so far to date. So you really emerged as a big leader in the online capital formation sector. So Reg A, I have some data here that was from the SEC from last year. I think King's Crowd, Chris, if he's still here, probably gave more updated information earlier today, but when the SEC reported it, they had said that more than 14 offerings have been completed since you were allowed to use the updated exemption, and more than $28 billion in capital has been raised. Let's see, or they tried to raise $28 billion, $9.4 billion proceeds were reported by more than 800 issuers. Typical Reg A issuer was relatively small and young. Most issuers had not yet established a record of profitability. majority under tier 2. Most of you in the room understand there's tier 1, tier 2. Almost nobody uses tier 1. Some do, but mostly use tier 2. First, you could raise $50 million. Today, you can raise $75 million. And I have an expectation that that's going to get bumped up at some point in the future, I think, which would be good for the industry. Reg A actually peaked in 2022, and that was on both the amount of money raised and the number of issuers, and then has dropped the past couple of years. I believe it's rising now, but of course I've got two people who are actually boots on the ground right now, and so they're going to share what's really going on in the sector. And I wanted to start with the issuance that Mark mentioned, Newsmax. And the reason I want to start with this is because it was kind of cool, and it kind of came out of nowhere. I knew Mark had been working on it for a long time as a Reg D, Reg A, and it quickly listed on the stock exchange, and then it went through the roof. I mean, that thing was, had the turbochargers kicked into it. And today, it's still trading above where the initial offering is. That doesn't always happen. We know how the IPOs work in the United States. And so I wanted to ask Mark to kind of share that experience, how it started, how did you get into the mix, the genesis of this offering, and everything that got to be put together to do such a successful offering.
Well, first, thank you very much. It didn't happen overnight. It was a year and a half in the making. We ended up getting involved in the company in 2023 and started working on diligence. And kind of our methodology and what we try to do is we look to, as I said, bring back the small cap IPO. And the reality most people don't realize is the market as a whole for small cap underwriters over the last couple of years has been horrendous. We've seen the overall market go up, but the reality is small cap, sub 1 billion market cap underwritings have really fallen. And in fact, the size of the offerings have really come down to something more in the $4 to $6 to $10 million range, which really is not enough capital for these companies to be able to survive. And during this time frame, we saw this thing called the SPAC. And to me, SPACs are, in my opinion, completely worthless. They're just dilutions. In the end,
Don't mince your words.
Yes. Well, it's important to understand because Newsmax was originally looking at a SPAC, and the CEO recognized very quickly the reality is you go through all this time and effort, you go through an SEC filing in order to get the merger approved, but then in the reality, at the end of the day, there's no money because all the investors redeem. So he got wind of this thing called Reg A, saw some of the deals that we were doing. Most of our capital raises were in the 15 to 30 million range, maybe up to 35. And that was the standard size IPO that we were doing. But what we found was when we looked at Newsmax, this was a great opportunity because you had a passionate brand of followers. You had people that were committed and believed in supporting this organization, not only from a viewership standpoint, but also now the opportunity to be able to be an investor because they've seen all these great brands grow up and never got to be a part of it. And that's what we ended up doing. And we looked at Jobs Act and took Title II, which is 506C, and Title IV, which is Reg A+, and married them together because one of the constraints of Reg A is it's only 75 million. Now we look, in my industry, we say 75 million is a lot to raise in an IPO, especially small cap. So I'm not sure where I stand on some of this legislation suggestions of raising the cap, because the reality is most companies can't raise 75 million. It's not realistic. But what we found with Newsmax was that the demographic that views it and the people that follow it were accredited. And accredited means that you have a $200,000 income or $200,000 $1 million net worth, and you have to prove it in 506C. But we were able to attract over 9,000 investors. We raised $225 million, all from accredited investors. And then when we flipped to the IPO, we were able to bring in the non-accredited, everybody else that kept saying to us throughout the process, why does the rich get richer? But we said, be patient because we're giving you the opportunity to be a part of it.
Who decided to use Reg A?
We did. The banker. The banker suggested the capital formation process for the issuer. And we worked with them and structured the transaction to be two parts.
And they were receptive.
Completely receptive. And in the IPO, we had over 30,000 investors participate. 4 days we sold out. In fact, it was oversubscribed that we had to refund money back to everybody before we were able. In fact, the NYSE, and just to put to rest a myth, because people in, I guess, more traditional underwriters say, well, Reg A is a fast track. And the regulators don't look at the filings. FINRA doesn't look at the filings. The SEC, the NYSE doesn't. Not at all. It's a full IPO. It goes through full review. The NYSE main board is not listing a company without going through a review. So when we sold out so fast, because they're so used to deals getting postponed or market out clauses or something that happens, they called us up and we said, we're done. In 4 days, they said, we're not ready. We were going to list you in 30 days. How did you get it done in 4 days? So we ended up having to basically have a pause period where we closed, got everything ready, and then we had the official closing where we close and we list just like any other IPO.
So, and I know you want to add some things here. Yeah,
Can I?
Okay, quickly.
Wonderful.
All right.
I think on an earlier panel, someone was talking about the amount of traffic required to, raise this much money. How many people, eyeballs, hits does it take to get $75 million in 9 days? And we had the privilege of being part of Mark's selling group for the offering. Our platform processed the retail components. There were periods of time, 20-minute chunks after appearances on TV, where 5 people per second for multiple minutes were making purchases. And so when you think about a brand that people follow closely, their viewership is rabid for more content, and a financial upside in that it is a public offering that's going to list on an exchange, there's going to be liquidity. The ceiling for where our category can go is extremely high. I don't disagree with Mark often. I disagree on the 75 million. I think that can continue to go up because I think the world that we have the ability to create is where brands much larger than we'd ever expect are tapping into their communities to raise money.
Okay, so what you're saying here is a lot of the momentum was driven by the fact that everybody knew Newsmax, which is an emerging media company. I mean, it's one of these upstart, more right-leaning news outlets that is having some success, right?
Yeah, but I think what actually ended up happening is because of the IPO, more people became aware of Newsmax. Prior to my conversations with their attorney with the company, I hadn't even heard of Newsmax. I didn't know who they were. By the time I finished, their viewership has increased. There's over 40 million viewers per month, and that's rising. After the IPO, we had people contacting us from all over the world, other news organizations, other issuers, and we have some large issuers we're working with now that had never heard of Newsmax, and to put it on the map. I mean, people at CNBC were talking, what is this? And that was the irony. Their competitors were putting them on air and talking about it. And they had to put it on because it was so well received by the exchange and so well received by the street. You said something, though, it should not have traded the way it traded. That does no one any good to see a stock rise as fast as it rose. And so many investors saw that stock price go up. And a lot of people took advantage of it. But the reason that it did that, in my opinion, was that there was a passionate cult behind the stock that were not willing to sell. They bought this, in fact, throughout the entire offering process. Everybody indicated they weren't buying it for a flip or for a day or for a year. They were buying it because they wanted to be a part of this, and they were excited to see where the company was going to be in 5 to 10 years. That's why they were purchasing it, because they wanted to support that type of content and that type of news organization.
And the volume's holding up too. At least when I looked at it, the trading volume, they haven't run away. It seems to have good trading volume for a small cap, right?
Well, it ended up settling off to where we priced it, where it should be. It's a function of comps and peers. It's what do other companies in the industry trade at? And as a banker, it's more of an art than a science. We need to determine valuation, which would be basically realistic based upon earnings projections and what they've already done to date. The stock's trading right where it should. So it was priced in a way that I like to say everybody eats at the table. The early stage investors that put $150 million in a couple of years ago, they got benefit. The private placement shareholders that participated in the private and took the early stage risk, they got benefit, and the IPO shareholders got benefit. So
Awesome.
It was a win.
Yeah. So, Aaron, I want to ask you about some of the offerings you've done, but could you explain how Dealmaker played a role in this offering in your partnership with Mark? Because honestly, I didn't realize this was going on until I started to talk to you guys.
Yeah, Mark and his team at Digital Offering are some of our closest and most valued partners. We play a role whereby, we have a technology platform. Our broker-dealer is not an investment bank, but we have a technology platform. We have an affiliated consultancy that can help issuers set up their websites. So often we collaborate, whereby Mark is the lead banker. He's structuring a transaction. He's doing all the things a banker does, and we have the ability to support him, provide the infrastructure so that the company can capture all this great money and they can attract these great investors. Newsmax, very easy to attract investors. They just have to go on TV. Other companies, as we all know, are running more sophisticated campaigns, and it's a very natural partnership. I think one that is emblematic of where this category ought to go. We are all pulling in different directions. Some people in this room will make it easier for earlier stage companies to raise. I think that's wonderful. Some of us need to bridge, this world of retail capital formation with the traditional capital markets, and I think that's a very important part of continuing to grow what we do.
Awesome. Do you want to add anything to how your partnership works, since we're talking about how you work with other tech providers?
Yeah, I mean, so we, as a banker, at a point in time, we had invested in our own technology, but we're bankers. We're not technologists. We're not marketing agencies. Everybody here that has a different role in that ecosystem is important. So we try to work with service providers that can provide the best service. To be honest, we don't really trust a lot of the service providers because they're not regulated in certain functions, and we don't allow them to do outsourcing of accreditation verification and things like that. So we still keep that all internally, but we've gotten comfortable now to use these platforms that understand our compliance requirements that we are governed under and how to implement that in a secure manner, giving investors the protection they need. We've actually had a great relationship with Dealmaker on a success story, and if I jump into Monogram, if you don't mind.
Sure.
Because that is exactly what everybody here was talking about. How do you have success? Aaron and his firm did the original Reg CF. They did a non-traded Reg A. Our firm came in and did the underwritten, the IPO of the Reg A onto the NASDAQ. We then ended up doing follow-on offerings where we created a synthetic ATM product. We did an S3 product, and then we did another Reg A product. So we were able to do basically every aspect of Jobs Act. And then that company ended up getting acquired and had an exit. So everybody through the cap stack was able to see a different level of increase and ultimately have liquidity and then an exit.
Yeah, and I mean, that's a great example of success. Actually, two successes. So you were going to add something.
Well, I just, to put it a different way, like Monogram is emblematic of the story I think we all want to tell a dozen times. Doug and Ben, the founders, have an idea for a business. They have the expertise, and it involves a robotic arm, and they can't get the VC or whatever funding. So they turn to a community, and over, I should know the number, 5, 6 rounds, they build a community. They raise tens of millions of dollars. Then that community also takes them public. It's not a Wall Street whatever. It's their community that takes them to the markets. And then once they're traded on NASDAQ, they are again going back to retail in a follow-on offering before ultimately delivering an exit kind of again to their investors, public, and then they sell. That is the world we want, where the companies that start with us, even if they are a small company doing
and they started with the Reg CF. Do you guys do the first Reg CF?
We didn't do the very first. They did a number of rounds. We have an affiliated marketing agency that used to be standalone, and they supported them from the beginning. They did a Reg CF on our platform. We worked on the Reg A to trade with Mark, and then we worked on the follow-on offering as well. So.
Okay, so I mean, this is some serious traction for an exemption that was pretty young, the updated Reg A. Aaron, you've had some other interesting offerings recently that we discussed the other day. EnergyX, I think, was one, and Picasso. What's going on with these two offerings?
Yeah, a couple of people have talked about Picasso, which brings me great joy. We're very, very proud of the success they had with Reg A, effectively maxing out their offering, 17,000 investors. They're an example of, again, exactly what I talked about before, an established brand with a built-in community saying, we could raise capital other ways. We've raised from venture before. We have lots of options available to us, but building a community is important to us. And so we're going to combine that marketing with our capital needs. And when you look at the sophistication of their business, last year they did something like $120 million in top-line revenue. They are founded by the original founder of Zillow, co-founded. So these are established brands. I think it represents kind of where we're going. EnergyX, maybe not the same level of household name, but they closed a $50 million Series B led by General Motors Ventures, and now retail also has the option to invest in that same company. So there's some really exciting things going on.
So from an outsider's point of view, it's always been my opinion that what this industry needs to survive and thrive is that the issuer needs to be able to raise the money they need to execute and grow, and the platform needs to generate enough, revenue to become profitable, and the investor needs to get a return. And typically, I say a return on a portfolio basis because most early stage investing is risky. So what I'm hearing now today is we're seeing some of that traction that we need to see now to keep this going and keep it heading in the right direction. And when Reg A initially kicked off, there was a lot of excitement. People called it a mini IPO, scaled disclosure. Mark, I know you hate to say it's called a mini IPO. A lot has changed, and it also has to do with the fact that you guys have experience now. What has changed since Reg A was first enabled, a decade ago under the Jobs Act?
I might answer your question indirectly.
Go ahead.
I think, again, seeing companies life cycle through these rounds, enter the public markets, continue to raise from retail once they're public, is emblematic of what this type of capital formation can really be, which is kind of the rebirth of the retail investor. I think Mark talked about bringing back the small cap IPO. Crowdfunding can do a lot of things, but one of the things it can do is provide retail access to the growth of companies. I was looking at this earlier, and I probably should have memorized the numbers, but in the late 90s, Amazon went public. Does anyone know what their valuation was?
Very low.
It was less than
not $4 trillion.
It was less than $500 million. Uber went public in 2019. Does anyone know what their valuation was? It was $80 billion. So in 20, 30 years, the ability for an investor to get in early through the traditional public markets has severely degraded. Those are cherry-picked examples, but I don't think anyone would argue with the trend. And as our industry bridges the gap into traditional finance, the traditional capital markets, I think we're going to allow retail to reap the benefits again, and I think that's a very wonderful mission.
Yeah, and I want to come back to the point. It's an excellent one. I totally agree with it. But I want to jump back to Mark here. So you've been doing this a long time. When Reg A first kicked off, there were a lot of crappy companies that used it, and some people got burned. Besides experience, what has changed? What do you think has changed in your path?
Well, when we first did Myomo, I couldn't get really anybody on the street to participate. I think I had one syndicate firm be a part of it. We had one institution for $100,000, and it was all just retail driven. What ended up happening, kind of that negative aspect, I'm actually seeing it still today, and it's a concern of mine, is that some of my competitors jumped into the business, and as we started seeing the success of these deals, and we had a few successful transactions, the underwriters kind of looked the other way on valuation, because if the crowd was willing to pay a certain price, then who was the underwriter to turn away the money? And we're now seeing a reflection of that today with these, what they call direct listings, where companies that went through crowdfunding or went through Reg A were raising money at these obscene valuations, and now the stocks really have nowhere to go but straight down. So we've seen, I think, what I've seen at least, is now my competitors are coming into the business because they're seeing larger brands that want to get involved with this, that are being priced based upon, and I'm going to keep saying this, comps and peers, and what it should be fundamentally priced upon. When we see as underwriters that the small cap community and the number of institutional investors has really diminished quite a bit, by going out to the crowd and doing it in a responsible way and seeing the returns being able to be demonstrated through proper structure, we're now starting to find more banks getting involved, more institutions getting involved. And after Newsmax, every institution that I work with on the street all came in and said, what can I do on your next deal? Because they want to get the allocations. And in the way we work, is the answer is no. You weren't there at the beginning. You're not going to get it when it's doing well. That's where the little retail investor deserves to be rewarded.
Okay. So, and you also have some you got a good pipeline. We're just talking about LA Times.
Yeah, we do. So we're the underwriter. And by the way, here's the beauty of what the transactions we're working on. We can talk about it. Jobs Act allows you in a 506c to be able to have this conversation today. I know somebody talked earlier about not really supposed to solicit certain types of investments. Well, at Reg A and Reg D 506c, we actually have the opposite. We can be loud and proud and talk about it, and we are able to do what's called testing the waters, and we're able to communicate in real time about what's happening. So I can comfortably say we have some very large transactions. We're raising up to $500 million for the LA Times Media Group, and we'll be doing a Reg A onto the NYSE. Hope most likely, if everything goes well and we pass all the regulatory filings we need, sometime late next year. We're also working with Parlor. We're working with Sugarfina. We're working with some other large brands that you'll see
Twin
coming
Peaks.
out.
Twin Peaks.
Well, I sit on the board of the parent of that company, but he's doing it.
Yeah, again, talking about public companies, we are waiting for the government to reopen such that Twin Peaks, which is a publicly traded company, can launch a Reg A offering. So again, running a marketing campaign that they get to point at their community, and the people that go to their restaurant can now be targeted by this wonderful messaging that they've made to also become investors. And I think that's a really, really cool thing to do, especially when the company's public. It creates an opportunity for an emotionally led investment. I like the company and I want to support it with my dollar beyond just being a customer, and I might have the opportunity to make money one day.
That's good. So how these issuers coming to you? Are you calling them up? They calling you? Are they just like word of mouth?
We get a lot of inbound from attorneys, accounting firms, and just inbound. But we're really kind of the land of no. We mostly say no to issuers. They're too early. Their valuation's wrong. They're at $3.5 billion on $10 million in revenue, wouldn't fly, things like that. But what we're also seeing is new innovative products that we've created. And I think this is important to expand on the question that you had asked. We're also seeing that the exchanges now appreciate, and I've been lobbying them constantly for the last 10 years, trying to convince them that this is the future. And I've now won over NASDAQ and the NYSE. There are new rules that most people aren't familiar with. In order to transact these IPOs or transactions onto the exchanges, you have to be a member or a limited member of the NASDAQ. That happened last May in 2024, and the NYSE, the new rule came into effect on September 1st. Our firm was the very first firm to get this, not the big underwriters that were in the business, our firm. Why? Because when we come in do an offering, we bring between 3,000 and 30,000 investors, or 3,000 to 30,000 investors. It's the true definition of what a public offering is. What we find in most small cap IPOs, it's a couple institutions and maybe a few retail investors that just barely get over the 310. So the exchanges like to see that there's no control and domination, and that there's true diversification and true retail investors that are supposed to be exactly what these issuers want. Capital to be able to continue to operate and giving everybody the opportunity to participate. So we've now created a new structure. Like we just did, I think we talked about it on September 30th, we closed $54 million in a preferred offering using Reg A onto the NYSE American. So we didn't sell common stock, we did an IPO of preferred stock, which has a return, and it's good for an investor that's looking for that type of instrument. We also are doing non-traded convertible Reg A's for existing public companies. So we saw the SEC change that Reg A could be used for 34 Act issuers. Those are, if you don't know what 34 Act issuers are, these are companies that are already traded on the New York or NASDAQ. But the problem is if you do a fixed price deal, which Reg A is, if that's common stock moves up and down, you can't reset like in an overnight in a regular offering. So we created a new structure that's been very well received. We did it with Monogram. We just did it with WorkSport. We raised $10 million. We worked with Dealmaker on that, and we just did it with Hard Sciences. So these are priced above market without toxic features. So it's good for the capital markets because the stock's prices increased. They didn't get hammered down from institutions, and investors were able to participate in concepts they really endorsed and loved.
Okay, so I want to shift slightly here. What needs to be fixed under Reg A Plus? And we had this conversation before, and I'm going to start with you, Aaron, because we discussed raising that funding cap. I know, Mark, you're not as hot on it. Aaron, you say, yes, I think it's going to be raised, and I think it's a good idea. What are your thoughts?
So I believe the secret to our continued mainstreaming of what we do is largely going to be, the most successful offerings, successful being the most exciting brands and companies, and being those that ultimately deliver some returns to investors. So one of the reasons why I think raising the Reg A cap is a good idea is that I do believe there are companies who would raise this way, but for whom 75 million isn't really enough, right? And for whom a larger raise amount might open their eyes to what is really possible. The category, what needs to be fixed, we have to continue the very virtuous cycle whereby great brands take a risk, they raise money from their community instead of one big gatekeeper, they are rewarded for it, the investors are rewarded for it, and that attracts yet more and more, right? It is very much a flywheel. In that regard, I think we are early in that flywheel. It took this industry a couple years to figure itself out, and now the logos of like really great issuers who have raised from retail investors directly is starting to pile up, and that will become a self-propelling cycle. The more there are, the better they do, the better investors feel about participating, the more companies will turn to this as not just an alternative mechanism. I'm always amazed at, Mark's talking about SPACs, and I might feel similarly about the SPAC market, and somehow it's so much more well-known than what we do, right? SPACs are effectively mainstream. What we do is not quite there yet, and yet I do feel there's really a lot more value. So we just got to keep doing what we're doing.
Mark, what needs to be fixed, changed, improved?
Yeah, I think actually what you guys are doing as an organization is very important because that lobbying is going to be a key. But I also think that all the service providers that have come into the industry, one of the changes that we saw, and I was kind of being coy about it, but it's true, when I was giving these speeches back in 2015, almost nobody was in the industry. It was all early stage, and it was a lot of marketing guys, and they had some great ideas, but the things they would say were just complete violations of securities laws. They didn't understand that you can't do that. And now we've seen an evolution where there's been this whole new breed of service providers that have gotten involved, and they're licensed. They have the licenses to do what they need to do, but they don't take the responsibility. They say they're just the platform. They need to educate the issuer, because if we're going to have, and I think Darren Marble said it, and the other panelists said it, if they want to see this work, people have to have returns. Well, that means that you need to buy into these issuers at the appropriate valuations. And just because that flying car might be someday go to the moon doesn't mean it's there today and it's not worth $1 billion. Maybe on a good day, it's worth a couple million. So the entrepreneur needs to look in the mirror and be realistic on valuations, and the gatekeepers need to tell them, I know you can raise money, because people don't look, they think 30-cent stock means stock's going to go to $10, not realizing that 30 cents might be this astronomical valuation. So we need to do better education to the issuers as they come through the funnel, because if you guys do these Reg CFs successfully, then they're going to graduate to the next level to go to a Reg A and do a non-traded, and then they graduate to the next level where they'll be able to have an exit, because if there's no exit and there's no liquidity, what's the point of investing?
I totally agree with realistic valuations, and we had a conversation about that. We have all seen issuers who have had bullshit valuations, and makes you roll your eyes, and sometimes you're surprised who these issuers are. What about blue sky exemption preemption?
That's a big. So I heard a lot of talk today. People are talking about using Reg A for crypto transactions and digital securities, and that's great for the primary issuance, but I don't think anybody's recognizing it's one thing, again, to be able to buy stock, but how can you sell it? There's secondary blue sky rules. There's ATSs that have limited capabilities. How are you going to be able to solicit investors to come to your ATS to trade in a secondary market? You have to think about the exemptions of the holding periods. Securities need to be either registered or exempt. If we don't have secondary blue sky changing to allow the resale, not the primary issuance, but the resale of these securities, there's no point. So we need to see some state changes, and we need to see more adoption of disclosure and being able to comply with those disclosure requirements for the individual states, and maybe get some harmony there. We're not going state by state to file.
Yeah, the states always hate that. I wish Dina was still here. Maybe she is there. Why they didn't include that in the Jobs Act originally, because it should have been done. Is there anything else? I think you mentioned investing limits, like the caps on investing at one point in time. Do you think that's a big thing?
Well, what I was talking about is in a regular S1, you have a little bit of room in order to reprice a deal if the market was to adjust down for whatever reason, or the market was adjust up because of demand. Reg A is a fixed price deal, so it's a little harder to deal with. So if we want to use Reg A as an alternative mechanism for existing publicly traded companies, we need to have a little flexibility of that. And some other things that we've advocated to the SEC is trying to put in a green shoe or stabilization. Unfortunately, that doesn't work on best efforts transactions, which Reg A's are. So there's some things that need to change at the SEC's level. And I sat on one of their panels years ago and advocated for this. It was kind of, they didn't even know what a QR code was back then. It's funny now we all use that after
Some
COVID.
probably still don't.
Yeah.
But just give me one more minute. On an S1, you don't even have to really announce a change in the pricing. Some people just give a press release. So I actually agree that Reg A can be or could be a path to fixing the public markets. You really highlighted it really well as to when companies went public decades ago, and the decline of public companies, and it's because of this rule upon regulation approach by elected officials and regulators that has really increased the cost and made it more difficult to have more public companies. It's a good thing though that the SEC has committed to improving both private markets and public markets. Do you guys have anything you want to add to that?
I think the FINRA, NASDAQ and the NYSE are taking steps too. There's been some changes that happened here just recently where the minimum capital raises are now up to 15 million, and in certain jurisdictions it's 25 million. There are certain requirements for number of shareholders, and it used to be one round lot shareholders of 100. Now you have to have 2,500. There are things that are coming into play in order to improve the capital markets and make sure that the companies that are coming public realize that that's the beginning, not the end, and that you need to be able to have enough capital to be able to support yourself and really grow. So I think we're seeing a lot of positive changes from all the regulators across the board.
Yeah, and I also think that Reg A could be the path for digital assets too. And I know that you guys have discussed that with the SEC. There's other people, pitching that too. But that could be a path for that. We'll open it up to any questions from anybody in the audience. If anybody wants to ask Mark or Aaron any questions about Reg A, now's your chance. Andrew?
For when Newsmax listed and they had the big spike once starting trading, do you think some of that was due to now sort of expanding the pool of investors, that because now they can trade through their own brokerage accounts rather than going through other mechanisms, seeking it out, going to the QR code that they see to make do the primary investment? And did you see some of that as well, or do you think that some of that was in addition to just shareholders wanting to hold?
No, because the way we do all of our transactions, we believe and we trial and error this because we had our own platform where you could open an account, trade with us, buy the IPO, and trade it directly out. The reality is people are conditioned to their Schwab, E-Trade, Fidelity, whatever account it was that they wanted. So the way we do our transactions is you can what's called DRS, which is electronically transfer within 20 minutes your position to any broker. So investors, and there were rumors that investors couldn't sell. Well, that's actually not true. Quite many investors sold. They were able to get the benefit of it. So I think what ended up happening, just in that odd case of what Newsmax was it was just this passionate crowd, meme stocks, and there was, whether you believe in the conspiracy theory of naked short selling or not, I was on the floor. I saw size come in on shorts that I knew didn't exist, and the specialist bought them in. So we saw these things start to occur, and it became this cycle that, like I said, it shouldn't happen. Stocks shouldn't trade that way. We all felt that it should have traded between 14 and 18, and that was appropriately valued.
Well, if that's it, I would like to have everybody give a big round of applause to Mark and Aaron. And thank you for sticking around towards for the end of the day. And I think, Jenny, you're up, right? You're going to share some wisdom? Awesome. Thanks, guys.
Oh, in the other room.
Hey guys, we are near the end of our day, and Jenny has a little presentation, a quick presentation before we all head out to our hopefully meeting for some drinks after this. Wanted to just thank the CfPA for putting on this event. For anyone who didn't meet me earlier, I'm Megan. I'm the CLO from Dealmaker. Thank you so much to the CfPA for putting this event on. It's been a great event. We were really happy at Dealmaker to be able to sponsor it again this year. And thank you to all of you for participating and buying tickets and coming. We're here for you, so you make the day as well. So thank you so much for participating. Anyone who didn't hear or what Aaron was talking about on that last wonderful panel, Dealmaker is a fintech platform. We provide technology for issuers who are looking to run a Reg D, a Reg CF, a Reg A raise, and all of the support pieces like the digital marketing, the broker-dealer, the transfer agent that you might need to sort of make your raise successful on your capital raising journey. We've really had the pleasure of working with a lot of issuers over their life cycle. You heard from Aaron about a few of those, and Jenny is here today to really recognize some of those individuals and participants in the capital raising industry who have really made a difference with some special thoughts. So with that, I'm going to pass it over to Jenny and let her close up the day. And once again, thank you for coming. It was really a pleasure to spend the day with all of you.
Get scared on the stairs. All right. Well, thank you so much for staying. And, this is really an exciting moment that we're going to finally share our industry awards for 2025. And, we had some amazing nominees. It was a very difficult decision, but some people really have stood out this year just in making amazing achievements in the industry. So we're going to start with the Rocket Launch Award. So this is an explosive Reg CF debut that got up to almost the max in 180 days or less. And the award goes to Avadain. Brad Larson, come on up. Thank you very much. Do you want to come up and we could take a picture? And I want to quickly give a little bit of detail about Avadain. So, Avadain is a graphene technology development and licensing company. Their mission is to democratize the highest quality graphene so that it can be used as an additive material to revolutionize thousands of products. Avadain has the only known technology to manufacture industrial quantities of LTDF graphene. They raised $5 million in one raise, $4.5 million, and $1.4 million across 3 Reg CFs. Congratulations. All right, next we have the Cool Innovator Award. This is to honor a groundbreaking, first of a kind, or eco-friendly project setting the standard for a greener future and a cooler planet. And the award goes to Azure Printed Homes, Gene Eidelman. So Azure pioneered a patented 3D printing process that transforms recycled plastic into sustainable, affordable homes. In just 3.5 years, Azure has delivered units for fire victims, the unhoused, and families priced out of traditional housing, while securing over 40 million in pre-orders nationwide. Their vision is quality homes for all, built faster, greener, and more cost-effectively. And they raised over 2.3 million in CF campaigns from over 2,000 investors.
The goal is to get his award next year.
I knew those stairs were dangerous. Okay. The next award is the Trailblazer Award, and this is where we recognize a pioneer in crowdfunding infrastructure development, innovators who are paving the way for others. And because of the last panel, you might have an idea where this might be going. It goes to Mark Alunowitz of Digital Offering. So Mark was instrumental in laying down the framework for Regulation A+ crowdfunding offerings. The methodology Mark structured is what led the first successful Reg A+ IPO to list on a national securities exchange. In addition, on March 31st, 2025, he structured the Newsmax $75 million crowd finance public offering, which was the first Reg A+ to list on the main board of the New York Stock Exchange, again making history. The next is the CfPA Pay It Forward Award. This recognizes a CfPA member, so you have to be a member to be eligible for this one, who exemplifies the spirit of paying it forward within the crowdfunding community. And this is someone we love dearly. His name is Paul Lovejoy of Stakeholder Enterprise. Paul is a huge advocate for the industry. He showed that by making one investment every single day for an entire year, and I believe it was a leap year, so it was 366 investments. He truly embodies the spirit of crowdfunding, sharing his stories, helping clients, and publishing articles that keep the crowdfunding industry moving forward. And our final award is the Social Impact Award, recognizing a Reg CF industry player that has demonstrated outstanding commitment to creating positive, measurable social change. And this goes to Eve Picker of Small Change. I love Eve. I'm a customer of hers, and I believe she's the only woman still who runs a portal. So we need to support Eve. She's sticking with the industry in spite of the challenges. She's a lover of cities. She's an architect, an urban designer, a real estate developer, a fintech pioneer, and an urban change agent. Her platform, Small Change, opens the door for socially responsible real estate funded by everyday people. All right. Okay, so you're actually ready to move on to our after party, which is at Bad Habit. Is that right?
Dirty Habit.
Dirty Habit.
Just remember a habit. Yeah, you can get there very easily by walking out to the right from the building, and 2 blocks up, there's a white building. It's the Monaco Hotel, and it's right to the right there. It's called Dirty Habit, 555 8th Street, Northwest. All right, we look forward to seeing folks over there. There have been so many great conversations and just impromptu connections made, and I hope we'll continue that long into the evening. Anything else? That's it. Thank you. Thanks, everyone. All right.